Schnappen. Jetzt trinke ich noch mal kurz was. Da stehen wir auch. Sehr gut. All right, so let's get started. Welcome from my side. I'm Jonas, chairman of the Digital Euro Association, and with me today is Anne-Sophie, the vice chairwoman of the Digital Euro Association. We are very, very happy to welcome you to today's Digital Euro conference. It's actually our 4th conference, and it's so great to see a lot of familiar faces, but also new faces here at the Frankfurt School today. So we are very pleased to host this event, to bring a lot of different stakeholder groups together, be it a lot of central banks, tech provider, payment service provider, startups, experts from academia, etc., from actually all over the place. So today we are again having participants of more than 50 countries, more than 300 people that join us here on site, and even a couple of hundreds who join online. So I'm very hopeful that this will be a very fruitful, interesting discussion day for all of you, and that after the day you think, okay, it was really, really worth and really time spent well here with us in Frankfurt. So today we have 70 speakers, 30 sessions. We do have different rooms, so you might have seen this on the agenda already. This is obviously the main stage. There is also the innovation stage, innovation room, and a roundtable room, which is just across the corner, also in the first floor. If you want to join later some other sessions. We do have also, first time this year, a conference app. So we kind of bombarded you with a lot of emails about that, and I've seen even more than 50% are already using it. So this is your tool basically to ask questions, to rate sessions which you liked or which you disliked, so that we know for next year. So that's your tool also to connect with people, to schedule meetings. So you can do that. And if you are now just asking how we do that, either check one of the mails, or on the back of your tag you also see a code. So if you scan this, you can also set up the app. So just about this for logistics, of course, for this event, we know this, it needs great speakers, and we are very thankful for the speakers. It needs organizers, are very thankful for everyone from our team to put together this event. It's often a lot of manpower and also time, energy that is put into the event, but of course it also needs sponsors for that. And you just see some of them on the slide here. So for everybody who's supporting this also as a sponsor from a financial perspective, a very big thank you, and maybe also a big round of applause, because that's of course what's necessary to also have this event. As always, we want to keep the opening keynote rather quick and also interesting, exciting. So we want to do a quick recap on what happened since we have met and we hosted this conference, this gathering 1 year ago. And there were a lot of happenings. First of all, within our association. So we basically did foster, intensify our engagements with a lot of European institutions around digital money, around stablecoins, the digital euro, wholesale CBDC, tokenized deposits. For example, we hosted the Digital Euro Dialogue in Brussels in the Parliament. We really exchanged with a lot of different stakeholder groups, with members of the Parliament to bring in our perspective, to bring this forward, so that in the end we all have a European ecosystem emerging around digital money, which we also as the DIA has as some kind of a vision. So that was definitely a highlight for us since last conference, so in the mid of last year. We also established some internal working groups, so-called committees on CBDC and stablecoins. So our members will know that this is a good gathering to learn, to exchange, to also bring in perspectives that we then bring into the discussion with policymakers. So definitely very exciting developments that we appreciated a lot, that we become also more a platform for structured dialogue, which we want to become and are more and more becoming as an association. And we also provided way more strategic orientations. So the members also know we do have a member brief where whenever there are exciting, interesting, relevant developments that maybe due to busyness not everybody gets, then we try to collect this information, put our comments around it and also forward this. So this is just what has happened for us, and a very strategically important moment for us as well as the association, but it was also that we appointed Konrad Kraft actually as managing director, so I hope that Konrad is also here in the room. So that was really, very much in the back. That this was very an exciting moment, and it's really a great pleasure, Konrad, to have you in this role with us, which is very, very important and necessary. So maybe you want to stand up quickly that everybody knows who you are. So that's this nice guy in the back. Since the last conference, we are also super pleased to have a lot of key members joined that are also really shaping the discussions. And I just wanna name a few because we're really proud to have them as members. One is EuroV, so basically a company also at the forefront when it comes to digital money, digital euro, and related topics. We have joined Giesecke and Devrien, so G&D, Define, Deutsche Börse as a major infrastructure provider. Paynovus, also BitGo as one of the exchanges more on the crypto stablecoin side of things, Intellect EU, and also today we are very happy to announce two more members which are also with us today and also here present with a lot of different teams. One is Senacor, so also driving a lot of projects, a lot of infrastructure when it comes to the digital euro, CBDCs, so payment systems in particular. And then also super happy to welcome the Ethereum Foundation as a member. So basically also, more and more ecosystem players from the more crypto perspectives, crypto side of things. And that's exactly what we want to host under the umbrella of the DEA, really this perspectives of a lot of different stakeholder groups of fintechs, of the permissionless world, but also, of course, of the traditional finance world to ultimately bring this space together. So very, very happy and welcome to all the new members of the association. Okay, and I will definitely stick to my promise that we will keep it short. So now we look into the market, because that's also why you are here today, to learn what happened, where do we stand in the discussions. And basically what we have said last year, when we were standing here for the opening keynote, we said it will be the year of the decisions. So we said 2025, the year of the decisions. Turning to you, Anne-Sophie, did this really materialize? So was our expectation right?
Yeah, thank you, Jonas, and welcome everyone. I'm happy to see familiar faces as well and new actors in the ecosystem. So welcome to the conference. I'm happy to go into the discussion with you today. But just looking quickly backwards, we saw a lot of decisions last year. So firstly, the ECB announced the technical readiness phase for the digital retail euro, which means we are going from discussion and the rule book development into the implementation. We will see a pilot phase starting next year, and the application is now on for people and PSPs who want to participate in the pilot phase for the digital retail euro. That's very exciting, because we will see that we will actually use the money that we were talking about all the time. So in case you want still to participate here, until the 14th of May, you can apply to be as a PSP participant for the digital retail euro. So 10 to 33 PSPs will be selected. And then in 2027, the pilot phase and the pilot development will start. On the same time, we see that the legal process is speeding up. We saw that lawmakers are kind of discussing quite a lot, and there's still some discussion going on, but we feel that they're coming to an agreement, and we hope that this year will be the year of the finalization of the legal framework for the digital euro. Besides, the providers for the digital euro infrastructure have been selected. And you will meet some of them today at the conference. I'm very happy to meet them as well here today and to have them here at the conference. Talking about infrastructure, we also saw wholesale settlement development speeding up a lot. So the ECB announced the dual-track approach last year with Pontes, and the pilot is already starting here this year. So the short-term solution of the ECB for wholesale settlements is starting in Q3 in 6 months almost. And here you can also participate and become one of the stakeholders using the Pontes pilot. I think that's very exciting, and that's pretty much coming fast now. At the same time, we have just recently seen the focus session on the Appia roadmap. And the Appia roadmap is the long-term solution for the wholesale settlements in Europe. It's creating a new financial infrastructure, and it's called long-term, but we will see it within the next 2 years. So we will see a new financial infrastructure for the European market, which will be built until, by the end, let's say 2028. So I guess that's a very exciting news, and that's not the only financial infrastructure that is creating, right?
Yes, it's not just the public sector, but also the private sector. So when we look into other initiatives, there was just really a lot of happening this year. And if you zoom out, you always realize that this indeed was the case. So one example, a regulated layer 1 as an initiative has been launched and initiated by Swiat, which also aims to bring, to build one of the core infrastructure pieces, more from the private sector side. We did, of course, also see more and more news and positive developments in the stablecoin space. So we still know that euro stablecoins are, if you compare this to US dollar, yeah, there is still a long way to go, let's say. But we have seen very promising developments. As of today, we have 19 e-money tokens issued and also regulated, licensed out of Europe, which is, again, very positive from a lot of different jurisdictions here. We have also heard last year the launch of Quivalis, who's actually also here, part of the conference, and speak later today, which is basically a consortium, a lot of different banks from more than 10 different European countries that want to, jointly as a consortium launch a euro stablecoin. We have also seen progress when it comes to AllUnity, one of the also like consortia on the stablecoin side. And of course, also when we look at Circle, there was also a very good increase in volume. So we do see there is more and more stuff happening. Again, I think for euro stablecoins, a lot of stuff still needs to happen, but it's very positive to see that how the space matures and also how discussions with policymakers on this topic are maturing. So that is also seen as a potential, as a lot of benefits that also euro stablecoins can bring for Europe, which I think in the past years often has been a little forgotten, at least from the public sector. So this is great to see that a lot of industry players come together, they build consortia, they want to build initiatives for the key market financial infrastructure, and also that we with the Digital Euro Association are somehow kind of in the middle of that, or at least try to be in the middle of that, for example, with this event today. So to really round this up, we think after last year, we said the year of the decision, we think this year will be the year of implementation. So a little bit more from discussion to, as Anne-Sophie said, technical readiness, use cases, adoption, the development of standards, which you all need to really drive, planning of rollouts, etc. And that's also exactly the direction of travel we are currently conducting with the conference today. So we really try to put a heavy focus on adoption, use cases, how we can make this ecosystem mature. So not from the discussion if all this stuff is happening, because we have heard now it is, really to the how and what is needed to make it ultimately a success, and that it also benefits Europe and also all the stakeholder groups that we have part of this. So this is what we will discuss today. I can really promise you a lot of insightful discussions, a lot of panels. Again, we have a lot of different stages if you want to check out later on the other stages as well. And otherwise, just enjoy the conference. And I hope you will like it, and wish you a great day for the conference.
Thank you.
And to kick today's conference off, we start with a quick kind of video format from some kind of a market overview, market perspective from Jürgen Schaaf, advisor of the European Central Banks, who also shows us a little bit more the bigger picture, where we stand, that we are now all starting the day on a similar level and can then go into deep dive discussions.
Good morning. Ladies and gentlemen, technological progress does not move in a straight line. It comes in waves. Remember, we once stored music in vinyl records, Then came digital CDs. Today we stream. Access is easier than ever. But the changing technology did not alter the beauty of Beethoven's symphonies, nor did it change the brilliance of the Beatles' songs. And the same is true for financial markets and the way we pay. Europe's payment landscape is changing rapidly, also because of technological change. In retail payments, cash still plays a considerable role in the euro area, but its use is steadily declining. Still, the ECB is committed to continued provision of cash. Indeed, we are currently investing in a new banknote series. Electronic payments are growing fast. SEPA Instant enable real-time settlement. Card payments remain dominant in electronic payments. They rely on international schemes and complex networks of intermediaries. And fees are high for merchants, although invisible to most customers. In wholesale markets, large value payments are settled in real time via Target, our established infrastructure. Settlement is final and irrevocable. This is crucial for our financial stability. For securities, T2S harmonized settlement across Europe. It replaced fragmented national systems, and it ensures settlement in central bank money. But the environment is evolving. Cash usage is on the retreat. Mobile and embedded payments are rising. Big tech firms are gaining influence over payment interfaces and data. At the same time, blockchain and tokenization are advancing. They promise programmability and offer the potential for 24/7 settlement. Indeed, they may increase efficiency. In this changing world, central banks must safeguard trust and sovereignty. Now, this is where the digital euro comes in. A digital euro would provide central bank money in digital form. Public money for the digital age. A digital twin of cash. It would strengthen Europe's strategic autonomy. Dependencies in payments are growing, while geopolitical risks are real and mounting. The digital euro would preserve the singleness of money, even as cash usage declines. The design is clear. Economically, the digital euro would be cash-like, not interest-bearing. It would function online and offline. Offline use would offer a very high degree of privacy. The euro system would not access or store personal transaction data in daily payments. The digital euro would be accepted across the entire euro area for person-to-person payments, in shops and online. Distribution would follow a model with middlemen. Banks and payment service providers would serve customers. For citizens and merchants, this means secure settlement and broad usability. It will be free for basic use for citizens, lower fees for merchants. The digital euro also supports financial inclusion, and it ensures low-cost acceptance. All this offers standards for private European solutions to build on and scale up. For Europe, it reinforces autonomy. It preserves the role of public money, and it fosters innovation in a unified market. Now let me turn to wholesale markets. distributed ledger technology offers important opportunities. DLT can host the entire life cycle of an asset, from issuance, trading, clearing, settlement, custody, and asset servicing on a single platform. It enables smart contracts and automated execution. It supports atomic delivery versus payment. And it allows 24/7 processing. Tokenized bond issuance is gaining momentum. Public institutions, banks, and corporates alike are experimenting. The key question for us is clear. How do we ensure that central bank money continues to provide stability, a settlement anchor in this new environment? In the euro area, we are getting ready to capture the benefits of these new technologies, and we are moving fast. By the third quarter of 2026, we will launch a new service under our Pontes initiative. This will allow DLT-based wholesale transactions to be settled in central bank money. We will start by connecting our financial backbone, the target systems, to new DLT platforms. This matters because tokenized finance needs safety. It needs trust. It needs institutional credibility. And this is only the beginning. To unlock the full potential of tokenization, central bank money should ideally be more directly integrated into these platforms. This is where Appia comes in. Appia is our vision for the next generation of Europe's financial road network. We will design it together with market participants. As Appia develops, we will continue to enhance Pontes gradually, consistently, so it fits into this broader vision. But Appia is not just about what we build. It is also about guiding the market without imposing our solution to it. We want to encourage solutions that strengthen competition, that foster integration, that support innovation across Europe. The objective is clear: support innovation, avoid fragmentation, safeguard stability, and maintain central bank money as the foundation of trust. Ladies and gentlemen, let me conclude. Retail and wholesale markets are moving toward digital and tokenized formats. This transformation offers great opportunities, but it also raises strategic questions. The Eurosystem is responding decisively with a digital euro, with modernized infrastructures, and with the exploration of wholesale CBDC. Our goal is modernization without loss of stability. A resilient, competitive, and autonomous European payments ecosystem with public money as its enduring trust anchor. Thank you.
Good morning from my side. I think that was an exciting way to get us kicked off this morning. Let me introduce myself briefly. My name is Marcel Kaiser. I'm a financial services consultant at FinPlanet, and I'm also deeply involved with stablecoins and digital currencies. As was already said, we would be very, very grateful for your active participation. If you have questions, if you want to be part of the conference, please feel free to do so. Use the app to submit your questions, and we'll do our best to get them to our fantastic speakers. And speaking of our fantastic speakers, We are now shifting from a strategic perspective to a regulator's perspective. Stablecoins remain one of the most important and closely watched, obviously, developments in the space, and thus the title Stablecoins from the regulator's perspective is quite an adequate one to have early in the morning. So please welcome Stephan Mögelin from BaFin. Good morning, Stephan. Oh. Sorry. No worries. The microphone's turned on, you can just speak. The stage is yours. Enjoy, everyone.
Good morning, everyone. So, ladies and gentlemen, I'm very pleased to be at this important event to contribute actively to the discussion. So, and it's great to see the Digital Euro Conference grows in size, influence, and in confidence. To me, that is proof that the accelerating pace of the digital evolution in Europe, and it's an encouraging sign of the maturity and ambition of this community. The coming year is going to be fundamental in shaping the European Union's digital financial future. With the emergence of distributed ledger technology and the associated evolution of digital assets, commonly known as tokenization, financial market infrastructures and financial institutions were facing challenges to being fit for the digital age and contributing to future-proof business models, including by enabling the use of new innovative technologies. To fully take advantage of DLT and related financial innovation, financial sector participants started exploring, developing, and promoting the various types of DLT-based systems as new type of technological underlying infrastructure for both tokenized financial instruments and tokenized forms of money, including e-money token, as programmable smart contracts. In that context, the European legislator acted early with MiCAR and the DLT pilot regime. And to be clear, ladies and gentlemen, the DLT pilot regime, as one of its first kind regulatory sandbox in the European Union, introduced in aiming to exploring, developing, and promoting the use of innovative technologies such as DLT in the financial sector. In that regard, the DLT pilot regime acknowledged the specific characteristics of DLT-based systems for the operation of DLT multilateral trading venues or DLT settlement systems in relation to existing regulatory frameworks. To that end, it also introduced tokenized forms of money, including e-money token, as eligible settlement asset to foster new innovative settlement solutions for transactions in financial instruments, ensuring a delivery versus payment mechanism. And while there are still challenges in the adoption of DLT in capital markets, I am pleased that already 6 firms were authorized to operate a DLT market infrastructure and thereby driving competition and innovation in the European Union. But the technology's potential extends far beyond what we can foresee today, so our work has to be continuous. From a regulatory perspective, I feel that with the legislative proposal of the European Commission of the Market Integration Package as part of the vision of the Saving Investment Union, many concrete proposals of market participants and supervisors have been taken on board. To only highlight some of the latest proposals in terms of DLT and stablecoins in traditional capital markets. The introduction and clarification regarding DLT-based systems in European regulatory frameworks, such as the CSDR and the Settlement Finality Directive. The introduction of tokenized forms of money, including e-money token, for the settlement also in traditional CSDs. And last but not least, the introduction of a regular regime in the DLT pilot regime, lifting up the overall threshold to 100 billion euro. I would like now to briefly focus on tokenization, perhaps the most important transformation, which I believe deserves more attention. While the issuance and transfer of DLT-based financial instruments is already available in today's capital markets, I would like to take a deep dive on what should be considered next to benefit from the advantages of DLT and blockchain from a technological perspective. For me, tokenization is about rebuilding the machinery of finance, meaning that we are talking about the infrastructure layer of financial markets, which will be used for the digitalization of financial services, products, and consequently any payments over the entire life cycle of such instruments. In that regard, to the innovators here, Europe needs you. Yes, it needs you to further build and develop payment solutions to promote the uptake of DLT financial services and apps. But it also needs you to take into account regulators and supervisors' considerations and mandates to ensure market integrity and financial stability. At the end, building and keeping trust in capital markets and enhance digital sovereignty. Don't just strive to challenge the old system. Help to design a better one. In terms of tokenization, that includes, for me, develop and agree on standards for smart contracts or data to be included to enhance DLT-based financial instruments and build the basis for further services and increased automatization of processes through interaction of smart contracts. Consider the need for interoperability of various DLT-based systems or digital assets to agree on best solutions from a single European market perspective and to integrate the payment leg on DLT. Develop or support also innovative solutions for cash settlement that do not necessarily involve traditional cash. Ladies and gentlemen, from first-hand experience as supervisor, I would also like to highlight that we need an active engagement with you to address the characteristics of DLT-based financial services and products in the right direction. As the landscape evolves, we continue to refine our supervisory approach for all firms to ensure we are getting the balance right between mitigating risks to financial stability and supporting the wider economy by enabling responsible innovation. And in the same vein, there are currently strong signals, as we already heard at the beginning of the event, that support the ambitious vision of the European Commission on the future of DLT-based capital markets. The European Central Bank not only initiated Project Pontes as the Eurosystem's distributed ledger short-term solution that links market DLT platforms and target services to settle transaction and central bank money with a planned go-live in the third quarter of this year. The ECB also published its long-term vision called Appia to focus on the further exploration and development of an innovative and integrated tokenized financial ecosystem in Europe. To that extent, Appia will explore options that are more integrated into the wider new financial ecosystem, going beyond the operability model delivered by Pontes. Thereby, the outlined approach of the Eurosystem to take into account the views of all relevant stakeholders through a strong public-private cooperation to build a future-ready solution is greatly welcomed. With that outlook in mind, it seems apparent to me that adoption of DLT to build the basic infrastructure layer for more integrated and innovative financial markets by connecting and supporting both wholesale central bank money and digital assets is an objective for the coming years. It is not only for that reason that stablecoins, often criticized since inception, have a legitimate use. As privately issued digital money, they can contribute through an increased level of innovation due to strong and faster on-chain development as alternative settlement asset, not only for transaction in euro, but also for other currencies used for transaction in DLT financial instruments. Furthermore, such privately developed on-chain solutions may in the near future also provide for increased liquidity efficiency in overcoming instantaneous settlement, often referred to as atomic settlement. With rapid innovation in digital payments and the advent of tokenization, the Eurosystem's approach is also greatly welcomed, since it will ensure that the ECB remains its stabilizing role as anchor in promoting the singleness of money and supporting strategic autonomy. However, let me take the opportunity to highlight that innovation and implementation of DLT-based market infrastructures is often provided also by new market entrants, which might not fit into the current framework to access these target systems. Therefore, and beside technical considerations, I would like to suggest to also review the respective access criteria to fully support the public-private cooperation approach. With so much change ahead, it's worth reminding ourselves of what hasn't changed so far. By working together, we can achieve these goals. I look forward to further contribute to that work in engaging with market participants and innovators, keeping up with the latest technological developments and support innovation to realize this vision. Thank you.
Thank you. Yeah, thank you very much for those insights. I think the call to help design better systems is most certainly striking a chord with the audience and with innovators. And we will follow up with our first panel of the day. And for it, we gathered leading voices. They will be introduced during the panel on CBDCs in motion. And I would like you to welcome back to the stage our host, Jonas Gógl, and his esteemed panelists.
Great. So yeah, please, everybody from the panel, feel free to join me here. So I would like to welcome, first of all, Alexandra Hachmeister, Director General for the Digital Euro at Deutsche Bundesbank. And great to see you back. Then Agnese Gentile, Digital Euro Unit Advisor of the Banca d'Italia. And then we have also here Luca Cassetti, the Secretary General of E-Commerce Europe, so bringing more the e-commerce perspective in. Then to the very right, Jan Rosam, partner and European Digital Euro lead at EY. And last but not least, Jan Haas, who is the head of digital money at MSG for banking. So thank you all for joining. And let's go into the discussion. So I think we have set the scene pretty well in terms of where we stand today on digital money topics, right? A lot of initiatives are happening, a lot of progress. We are coming more from theory, from concepts to practice, as we laid out, with standards being developed, technical readiness being ensured, technical solutions being built. And this is what we will focus on in this panel, really on the digital euro and how we can also drive adoption, what's needed to make this a success. So maybe starting with you, Alexandra, as the first question, like maybe you can tell us a little bit more again on the why, So why is the digital euro being built, but also how can it maybe contribute to some strategic directions where the European Union is currently heading?
Thank you and good morning to everyone. And I know that everyone eagerly listened to what Jürgen Schaaf said, so I'll try not to be repetitive and basically focus on, I think, two aspects that are very relevant and that you don't see in the product. And I think that makes it tough because people always look at the features of the product, and this is a feature you can't feel. And the two I'm going to talk about is autonomy and resilience. And I think what Jürgen didn't stress, but is our reality, is the geopolitical challenges that we're facing. And in that sense, we're talking about strategy, that we're saying we need a functioning European infrastructure, right? You're not going to see that in the product, but you're definitely going to feel it if anything goes wrong. And we know these days the world is changing quite rapidly and unexpectedly at some times. So what I think for us as Europe to do is to ensure that we get this thing done. And I think you said that in your opening speech. This is, yes, we have come to the decision, so we are less talking about the if and more about the how, so it's implementation. But there are two sides to the implementation, right? One is definitely a political process that needs to be solved this year. I think we're seeing very strong signs out of Brussels that we're making progress, and we're actually counting on it. And the second thing is definitely the technical and operational side. Everyone in market infrastructure knows that you can talk a lot, but you need to build it. So I think we will come later to this in the panel, but there will be a lot of things around the pilot and how we are going to approach to really build a strong infrastructure and a successful product.
And let's maybe directly go deeper on that, Alex. Like when you say the pilot, right, which is currently expected or will be done next year. So I guess you prepare a lot on the back for that. You talked about building the technical stuff that we are talking about. So what is it that you currently, like you and the team, the Eurosystem also as well, have on the roadmap and is being done? So what's the stuff you are, you're working on?
You compliment me if I miss out on something, please. I think what we have done, first of all, and that was a deliberate decision, that was to really start the implementation phase on the 1st of December. And that means technically, as we are not building the infrastructure solely as central banks, which we do for the target services, for example, that's completely built by national central banks, we're using a different approach. So actually it wasn't only us that had to start the work, but it was also other service providers that had to start their work. So to be very, and I know they will be very technical, but we had before Christmas our first PPI planning. That means you basically get everyone in a room, and you need large rooms for that, to ensure that every component that needs to be built can really be aligned and that you can agree on what are the first steps that you do in your first sprint, right? So it actually is getting very technical, and on the development side, that means you need a development environment, first of all, before you can develop, right? And as I said, the second thing then is we still need to do a lot of work and explain ourselves on the political side. So it's two things.
Yeah. Okay. And to go a little bit more into deep, or do you want to add to that, or going into the next one?
I would say that we have started our, let's say, new phase of the Digital Euro project, thanks, of course, to the we have successfully completed our, let's say, first part of the preparation phase. The ECB Governing Council decided to go ahead in October 2025 with the second part of the preparation phase. And in this second part of the preparation phase, we have three main goals. We have the first goal that is actually to continue our development in terms of functional, operational development, technical development, and this is where the pilot is coming into place. So what we want to do is to go ahead with the preparation and of course assess on our side whether we are technically, operationally and functionally ready.
Great, and let's dive a little bit deeper on the pilot. Agnes. Like what is the key, key things you want to achieve out of the pilots? What is being tested and what is kind of the key outcomes you hope to get from the market and also from the tests?
Of course. Allow me to first, let's say, clarify a couple of points. As I said, the pilot will be the first exercise being conducted by the Eurosystem, so the ECB and the NCBs. And this first exercise, it's not preempting any decision to be made by the Governing Council on the first issuance of the digital euro. And this will be made only upon approval of the digital euro regulation. So let me just make this clear. The second part that I would like to clarify is that we will not be testing the digital euro as part, of course, as coming out of the legal framework, because, of course, we know that the legal framework is ongoing. So what we will be testing is the so-called beta digital euro, which will be having characteristics from a technical perspective, from, let's say, a functional perspective that are similar to the digital euro. But, of course, we will not have the regulation in place. So it will be a digital means of payment being issued by the Eurosystem, but it will not have legal tender status. As I said, it will have characteristics that are similar to the digital euro that will be in place in the future once approved, the digital euro regulation, but of course the legal framework is not yet there. So this is just to clarify. In terms of what we want to achieve in the context of the pilot, of course, what we want to assess is not only whether we can issue the digital euro, but what we want to see and what we want to test is actually whether we can actually make it work. What does it mean? It means that we want to see whether we are prepared from a Eurosystem perspective to a first potential issuance of the digital euro from an operational again, from a functional perspective. What we want to also assess is whether the ecosystem is ready. So what we want to see is actually whether there are constraints, there are problems, that there are issues, and we want to be there and see how we can support based on the outcome of and the feedback that we will be receiving in the context of the pilot from the PSPs, how we can support them and how we can collectively overcome them. Last, but of course not least, what we want to also assess is whether the digital euro is actually fitting for purpose, meaning that we want to see whether it meets what are the end user needs, and in this case, being simple, being usable, being straightforward and easy to be accessed. So these are the 3 key questions that we would like, let's say, to have an answer to in the context of the pilot.
Okay, and we also heard from Anne-Sophie that currently it's of course also possible when you're looking for participants for the pilot, right? Because we know here also a lot of banks, payment service provider, merchant, e-commerce companies, are here. So maybe the follow-up question to Jürgen is who can participate in the pilot, and also how, what do the companies now have to do to participate?
Thanks for the question again. Of course, as I said, this is the first real-world testing, of course, the beta digital euro. As Eurosystem being the first test, of course, we wanted to start small, focused, and of course, controlled. This means that we will be testing a prioritized set of use cases, person-to-person, person-to-business use cases. We will be testing for the person-to-person, both online and offline, and for the person-to-business, we will be testing remote payments, and of course also proximity payments, so point of sale, e-commerce, and commerce. We want to start from core functionalities being developed and of course tested in order to scale up in the future. And as I said, not being a first market rollout, we want to start in a controlled environment. And this means that the pilot will be run in the context and in the perimeter of the Eurosystem central banks and the ECB. We will be having a limited number of participants in terms of end users, merchants, and in particular the end users will be the employees of the NCBs and the ECB, buying food, goods, and services from the merchants within the perimeter of the Eurosystem central banks. When it comes to the merchants, of course, the merchants will be also those having a relationship and providing goods and services to the Eurosystem NCBs and the ECB. In terms of numbers, as I said, limited and contained number of end users and merchants and, of course, employees. Speaking of numbers, we will be having between 5,000 to 10,000 employees being involved. When it comes to merchants, we will be having 10 to 25 merchants. And, of course, the contained number will also apply to PSPs. We will have a limited number of PSPs participating, and as you mentioned at the beginning, we have ongoing the call for expression of interest which will conclude on the 14th of May, and of course we invite all the PSPs being eligible to be participating in the context of the pilot to apply, because of course they are the key players when it comes to providing and supporting the Eurosystem in distributing the digital euro. Allow me just to conclude. Of course, I don't want to forget the TSPs. So in this case, not being directly participating in the pilot, they can in any case support the PSPs in, of course, offering the digital euro service. So you can see that in the context of the pilot, we will be having quite a number of, let's say, actors involved of the ecosystem of the digital euro.
So definitely a call to PSP banks and merchants to be active and to apply. Okay. Last question on the pilot to you, Alex, before we go in broader discussion, talk about adoption requirements. Like, when now the pilot is run, like, what does success look like? So when do you think, okay, yes, this is working? So what's the desired outcome or the reality check?
I think the desired outcome is on several layers, and I think Ness mentioned some of them. I think, first of all, this is a public-private endeavor. So we are preparing for when reality or the introduction is going to happen, right? So this needs us to develop that trusting relationship to ensure that operationally, in the framework that we're working, that we try that out, right? I think that is very important, and how this will evolve during the time of the pilot will give us a good indicator how smooth it will be once we're in introduction, and we want a smooth introduction. The same thing is actually, when going through a pilot, it will allow us jointly to learn. We might actually adapt. I think everyone, we have done lots of research, how things should work technically, from a product design perspective, everything. But only once you try it, you will learn from it. And I think this will provide a great value to us to understand, is this actually fit for purpose, as you put it, right? Does it do what we want it to do? So it is actually, for me, it would be a success if we find things that don't work. It might sound a bit absurd, but you know what I mean, right? You want to find out in the pilot and not afterwards. And I think it will also ensure to develop the trust basis of it, right? It is really technically and operationally speaking, this is a huge endeavor, right? We're talking 21 member states in the Eurozone. We're talking all the different stakeholders that you have mentioned. There's a lot to gain for everyone, and we are really doing a bit of a dry run here, but trying to get, the product out. So I think success is that we, it will be a tough time, I guess, but success we will realize when we are through it and say, okay, now we feel ready to get it really done.
And this is a great transition to come to exactly that stakeholders, because we've heard it before. To make this really a success, we need the stakeholders to be involved, also to be aligned, also to be somehow happy on what's coming in some form. So Luca, coming to you. So we of course know that the e-commerce merchants generally are of course a very important stakeholder group around the digital euro. So what is kind of your perspective, and what can you or the stakeholder group of e-commerce kind of gain through the digital euro?
Yeah, thank you very much for the question. If I can maybe quote Ryanair's slogan, what we need is low fares made simple. If you ever flown Ryanair, you probably remember it. So low fares made simple. I thought about it just a couple of days ago preparing for this panel, and I thought, yeah, it might work also for today. So basically what merchants are looking into is low costs. And I have to say here that we are not alone in this. As e-commerce Europe, we are working as a merchant payments coalition. So the right name is Merchant Payment Coalition Europe, and in there you will find, besides us, also Eurocommerce, EACT, which is the Corporate Treasurers Association at EU level, IATA, Independent Retail Europe, and SME United. So it's a wide group that is very well aligned on the points that I'm going to mention right now. So we have proposed caps to fees, to ensure that the digital euro remains a sort of a cheap solution to be adopted by merchants, basically. We would not like to see hidden charges, and we want to have predictable pricing. So I think that's a fair ask from our side. And our proposal as coalition is to introduce an inter-PSP fee of 0.05% with a 2 cent per transaction cap, and a total merchant service charge of 0.1% with a 4 cent per transaction cap. And for offline transactions, we propose basically a zero fee solution, basically to reflect the cash-like nature of the digital euro. Why are we proposing this? Well, simplicity first. It will meet the requirements for a uniform fee across the euro area, in our opinion. It reflects also a little bit the legal tender status of the digital euro. It will be mandatory for merchants to accept it also. It reflects also the absence of ECB scheme fees, and it avoids a transitional period, which is something that was proposed by the Council, and in our opinion, it wouldn't make sense.
Maybe to double down. This one. Thank you. Maybe to double down on that, like if we look into merchants today, right? I know I mean, you made it very clear and simple, so it's basically about speed and about cost. Like, is this the key two things that currently is in the current payment world, like, let's say, unsatisfactory for merchants, that it's too costly and, it takes too long until you get the money? Or what's, are there other value propositions that you could hope to gain out of the digital euro as merchants?
Well, besides the cost, there are a few other elements that we can bring into the discussion, and also to echo what Alexandra mentioned before on autonomy and resilience. What merchants are also looking into a payment solution today is reducing reliance on international card schemes. The digital euro is, in our opinion, going to provide a unique solution across the eurozone that will make it simple, in theory, to do cross-border sales. So that's something we support. E-commerce is per se without borders, so that's something we definitely support. And it will be an alternative to international card schemes, which, as we all know, are very expensive and dominating the market, especially when it comes to cross-border payments. We're also looking as merchants into reliability. So we are looking into payments that can always go through with minimum downtime or failures, and we hope that the digital euro will be able to provide that as well, with immediate final settlement on the ECB public infrastructure, and that is going to improve the cash flow certainty for merchants. So this is also something very relevant for us. Of course, this has to go hand in hand with fraud prevention as well. It's also an important element for merchants. Conversion. We need smooth checkout experiences, and that has to be the case for both merchants and consumers alike, in a way that we are going to reduce cart abandonment. If your payment experience is not as good as your shopping experience, then your whole e-commerce experience will be not so great. Same for the delivery, by the way. So if the delivery is not going well, you might be really annoyed as a consumer. And at the end of the day, even if I'm representing e-commerce, I'm also a consumer. So, conversion, the digital euro should support frictionless checkout. That's basically what I wanted to say, and helping conversion rates. And finally, we need easy onboarding and seamless integration. So the digital euro will rely on standards, of course, and we should ensure that there is a quick setup basically for merchants, something that is easy to plug into existing checkout processes, so not too complicated for SMEs, and no heavy administration. So these are, I would say, the key points that I wanted to flag. Okay.
So kind of like speed, costs, independence, fraud prevention, user experience, that is really key to gain here.
Exactly.
Okay. Great, and let's then also talk to other stakeholder groups, and you both Jans, you kind of indirectly represent the banks today because you're working together with a lot of banks. And let's start with you. It's good that you sit here and here, so I can say Jan, and I hope it works out. So Jan, let's start with you. I mean, you work together a lot with banks. So what do you think is currently the kind of readiness level? So are the banks all ready, for the digital euro? Are they all ready to participate in the pilot? To go back to what Agnes said, to just sign up tomorrow, or where do you think do we stand? What are maybe challenges or also prerequisites that we need? So a lot of questions into one.
Yeah, I try to answer every one of them. When I look in the market, across the whole market in Europe, I see there's a mixture of readiness, I would say. So there are a lot of institutions that are already quite far. So they are already, mainly the bigger institutions and payment service provider. They invested some money and time to do pre-analysis, pre-studies, impact analysis to see how will the digital euro fit into their organizations, what are the implications on the processes, or also the IT infrastructure or the whole payment infrastructure. I think they are quite prepared, even if there are still some uncertainties, sure. But there's also a big part of PSPs. There's the readiness level quite low. The main reason is probably the uncertainty of the legislation, as most of the boards will not release the budgets and the money if you don't have like the clear political direction. And in addition, you have a lot of parallel projects and transformation projects, different payment in the payment and banking area, and you need the resources and the budgets. So I think they are more in the observative situation currently. But if you look into the operational readiness, I think that's one of the biggest topics for the pilot, actually. So the pilot, as you said, it's the first pilot. A lot of things will be tested. You will see if it works, and we learn with that. But I think it's important that you already prepared something. So if you are a PSP that did not yet anything or just on a small effort, I think then it's going to be hard probably to participate with the pilot. You need to have pre-analysis, you need to have like pre-impact analysis, and at least you need to have an understanding how the digital euro fits in your organization and where you need to adapt something. Because when you are honest, the digital euro is going to be one of the biggest projects for a lot of banks and probably for the whole European market, actually. And it will have an impact on each and every area in the banks. So not only a payment area, so it's like everywhere. And you need to be aware with which departments you need to talk, which processes, which vendors, and so forth. And therefore, I think to be prepared for the pilot, it's important that we have that the legislative is at least decided, or we have a political direction, so that for maybe some other, as you said, it's beside of the legislative process, but still. There will be more effort if you have like a clear political direction. The second point is, as I said, the operational readiness. You need to be prepared that you can really take part and have a meaningful impact from day one. And the third point, which is quite clear, and you mentioned a lot of stuff, is the clear scope, the clear timeline, and also the clear specifications that you can go into the project without any doubts and just do your work, let's say, like this.
Maybe just two comments to the political process. And I think what we get is during the year we will get clarity in steps. I think the first step that we will reach is as soon as we know we can go into a trilogue, it's very clear that we'll come up with a legal text, right? I think the whole point is now that Parliament needs to reach a final report so negotiations can start. I think the envisaged time plan is to get to a final version in May so that trilogue could actually start in June. There is always, some leeway in timelines, of course, it can take longer, but I think we are in March now, we are close to April, so things are coming along, right? That can be actually pretty fast that we are coming up in trilogue. And I see what we also see is that there are quite a few positions where they are not too far off, which also gives an indication how tough could then a trilogue be, just as a sideline.
Maybe to add to this, so I think the launch of the pilot was also really the kickoff on the bank side, to be very honest. So because so far a lot of banks were involved in the rulebook development, in the working groups. They have they studied the rulebook, of course, understood what the impact is on the processes. But I think now with the pilot, it becomes concrete. So, and I think at this moment, I think a lot of the tier 1 banks are chasing on board level for the money, to be honest, because the pilot, and I think this is not just on the central bank side, the challenge, of course, also on the PSP banks, because I think the requirements ECB set on the PSPs are still quite high, because you need to be able to fulfill all of the use cases, etc. So therefore it means they not talk about 2028, 2029, they talk about 2027. So therefore they would need to speed up their developments quite drastically. So, and I think the big challenge is, of course, there's no standard solution in the market, because I mean the platform is not developed yet. So the vendors they are using for their payment rails are not ready yet. Of course, why they cannot be ready. So therefore, I think for those banks participating or PSPs participating, it will be quite an effort to participate in the pilot, as for the ECB is. So therefore, let's see. I'm very let's see how many will participate. So I think So we decided to set up a pan-European digital Euro hub, which I'm leading. So we actually have good transparency across Europe. And I think it would also be interesting to hear from the central banks. Is there an idea, so do you hope that every country is participating, or is there some kind of structure you would like to see in the pilots? Or, because I think that's a question for me. And at the end of the day, I think it is a challenge, and even the larger banks are quite worried about the efforts they would need to spend to participate in pilot, but then also basically actively participating in this. But do you have a view on the structure of PSPs you would like to have?
Allow me just to start by, of course, saying that and remark the fact that the pilot is a very first exercise. And of course, when the regulation will be in place, we will have for sure chances in the future, to continue rolling out gradually the digital euro. So this is something that it's a first step, but in a long process, in a long rollout process, and it will be gradual. Of course, from a PSP perspective, we do understand what are the constraints, what are, let's say, in a way, the limitation on your side. We fully see the point. When it comes to and we also do see that perhaps at this stage, larger PSPs are those more equipped in taking part and being involved. I want to also be clear. The call for expression of interest is open to all the PSPs, licensed PSP in EU, being willing to participate and being involved. So in this case, as I said, I do see the point. But from our side, it is open to all the PSPs being interested and being licensed in the EU. When it comes to the final composition, again, a limited number of PSPs will be, let's say, selected at the end of the selection process. And what we will be assessing is also not only if they meet requirements like being a licensed PSP, but what we will be also assessing is whether the PSP, for instance, has experience in the context of pilot exercises, whether the PSPs have an operational structure in place to support the pilot-related activities, the geographical coverage. So these are all aspects that we will be taking into consideration as Eurosystem before making a final decision. Of course, the broader is the participation and the geographical scope, the better it is. So this is our aim.
Okay. Maybe a follow-up question to you, Jan, because I sensed between you two Jans, it's very difficult, like a little bit of different, I don't know, like let's say sentiment. So if I understood you, and please correct me if I'm wrong, was, you said there are a lot of challenges, for banks, also with the budget, but I heard a slightly positive twist to that, also given the progress on the legislation side. And for you, Jan, I more understood like there are way more challenges, and it's, so like where do we stand? Do we see a positive direction with banks getting ready, or is this really just being expected when the trilogue is entered or when the law is final, which could take time?
I think Jan said it correctly. So, I mean, of course, what I see, there is a difference across Europe. So we have some countries which were also more actively involved, maybe in the rule book development, in the political process. They started maybe earlier. So there were some countries, don't want to name them, which were more reluctant for a long time and maybe said, okay, maybe this will go away for whatever reason. So therefore, I think across Europe, you can see different maturities of countries on country level, but then also on entity level. So as Jan mentioned, of course, the tier ones are very much involved, but then we have a big tier 2 and tier 3 market, isn't it? So, and there it becomes a challenge. So, and I think if you look at tier 2, tier 3 market, none of them are really prepared. Maybe there was no need for them yet to be prepared. But I think that's why I said, I think the launch of the pilot was also the kickoff on the banking side to really get ready. Because people understand now this is going to happen in 2027. So, and therefore, I expect a lot of interest and a lot of activities now to the mid of this year. And then definitely banks need to get ready. Now it comes to the challenge. Of course, our power market is very big, so I think there's a big concern, of course, scarcity of resources. I mean, if you look at the scale of the project across Europe, if you look at how many PSPs we have and the implementation effort needed on central bank level and private sector level, so there's a big concern about, do we actually have enough resources to do this, etc. So that's why we also developed different tool sets for our clients, where we support clients with AI-based tooling to do quickly impact assessments. So we converted the rule book and digital assets so people can use to get much quicker impact assessments. So I think we need this kind of innovation, to be honest. So for the whole market to get ready and also to be successful in this big project. Because as I said, standard solution is probably unlikely we have in a very short period of time from a technological perspective.
Maybe to add something here to the point what you said with the tier 2 and tier 3 PSPs. I think they are one of the reasons why they did not yet prepare is also a lot of them are really dependent of their vendors, and as you said, the vendors are not prepared, so they are more waiting for the first pilots and that also their vendors are prepared, and then you will get a faster adoption rate actually.
We discussed about readiness of banks, and maybe one follow-up question to you, Luca, like more on the merchant side, e-commerce company, how ready, are those players? I guess there are also differences between countries, between tier 1, tier 2, tier 3, but do you have a feeling of a general readiness level? Because they are also welcome to participate, as far as I understood.
I'm not really sure if they are ready, because to be honest, the legislation is not there yet. And when you're a merchant, especially if you're a smaller one, what you're doing is focusing on running your business. So you will worry about the legislation once it is adopted. And that's a little bit unfortunate. For larger ones, I think that we have a couple of players that are actually willing into participating in the pilots. I don't know if they're direct members of e-commerce Europe or not, but we do have some large players active in Europe that definitely have the resources to try it out. So I cannot really comment that much on the readiness of these companies to participate.
I can probably add 1 or 2 sentences to that. Definitely, I think the larger ones, just as you mentioned, I think it's the same on the PSP side as well as on the merchant side, same pattern that we see. But we are already in exchange with larger merchants and they are getting prepared. So we actually expect them that we have enough merchants participating. I think what is really important is, of course, that we have the relevant number of merchants and PSPs participating, but what is really important for us is that at the end of a pilot, we have tested the different use cases, right? So, and I think you very clearly pointed out that we have a selection process where we have to make sure how we cover all of that. So that is also a very relevant aspect to us to see, can we do all of the use cases that are currently in the planning?
Let's now come to one, Jan, to you again, to one stakeholder group that we as an association is also very important, which is the end users and the citizens, right? Because they in the end are the ultimate users. So banks, they distribute, merchants, they provide the solutions as well. But in the end, if no end user is using it, it doesn't work. So maybe Jan, to you, what do you think on this level of end users? Like, what does it need for them to participate, right? Maybe also, are they ready? I mean, are you talking to people? What is your perspective on that one?
Yeah, thank you. I think a lot of things has been said by Luca already previously. From my point of view, so when I think with my payment behavior, so I like payments when they fits into my everyday habits. So it needs to be smooth, and from my point of view, new payment methods will not, so the adaptation with new payment methods will be reached with improvement and not really with disruption. And I think that's something what we are currently also doing. And the payment flows or the habits, they are really deeply convenience affected. So convenience is one of the most important argument, I would say. So therefore, if we have a payment system, a digital euro that fits into everyday's life situation, and I can pay everywhere I want to pay, it's integrated in my used and favorite banking apps or PSP apps, with my devices, what I like to use, if it's the mobile phone, the watch, or even the card. I think that's something which is the most important topic. Otherwise, it needs to be a good user experience that is similar or better than the others that I use today. The second point is for sure the trust, which comes with the privacy topic. So this is also something what you also mentioned earlier. So if you have a payment method that is really that protects your data within Europe, especially, I think that's really going to be a benefit, especially for the offline payment. If you have then also like an offline payment that has the same, let's say, resilience and reliability than cash, then it could be that it's really an emotional benefit for the users. For example, you also like to pay cash probably, so then it should be the same for the digital euro. And the third point, from my point of view, is the resilience and reliability of the whole system. So it has to be there when I need it. The offline, and if you have the capability to pay everywhere and any time, then I'm going to use it. And to round it up, I think that's also the topic what you said in the beginning, is like this European perspective. So for sure, this is maybe not really a political argument from my side, but it's more, in current times, it gives you more a reassurance for a user. You have your data in Europe, you don't know what happens, and you're not dependent of global systems. And I think that's, in the end, at least for a lot of users, something which currently they are thinking about, I guess.
And following up on the end users, a question to you from a central bank perspective, Alex, Agnes, to you, both of you. Like, I guess you also do, research on the end user side. What the product digital euro needs to fulfill so that it's adopted. Yeah, and you mentioned user experience. We talked about privacy, trust, resilience. Like, is this the core features you also have, like in your kind of requirements list, let's say, or is there more, or are they different?
Absolutely. I think absolutely, in the end, it's a product for our citizens, right? And in that sense, it has to be an excellent product. So it's about usability. And I think I made that in my first comments. The relevance of autonomy and resilience you cannot see in the usability of the product as long as you're not threatened. And we have, unfortunately, some Europeans, and we have seen that with the International Crime Court, that have been cut off of their payment systems. So they had the feeling, what happens if your autonomy is no longer fulfilled? I don't want our citizens to experience any of that, just to be clear. We don't want, that they love the product because they have to fear. That's not the point. But it's something that, as central banks, we have to bear in mind all the time, right? That's our duty. That's our duty to make sure. At the same time, we have to make sure that it is an attractive product. I fully agree with you. Still, I believe, if you look at the very different payment behaviors across countries in Europe, at the very different personalities all our citizens have. We have some that are very digital prone, we have some that are true cash lovers. We will see when we look at adoption, we will see sometime how actually payment patterns, how they adapt to the product. Do they like it, yes or no? And as always, you will have some early adopters who are just curious and try it out. And the moment they try it out, I would say it better works, because that is kind of the litmus test, where okay, if I try it out and I like it, good. Because if I already have digital payment methods, it has to do at least that.
What I can add on top is, of course, on top of resilience, safety, privacy, and so on and so forth, we also have financial inclusion. And this is something that we are deeply working on and looking at. For this reason, we want to make the digital euro really, really, really fitting for everyone. So nobody should be excluded, and everyone should be able and be in the position to use the digital euro.
Yeah, so if I take the customer perspective and maybe to steer the discussion, but I think everyone who's really interested to see how the digital euro could look like should go to India. So I don't know if I guess everyone who's in the payment industry has been to India and knows UPI. So I think UPI is very impressive, and I think all the criteria you described is met by UPI. And I can highly recommend this because it can be used by tourists. You don't need to have a bank account in India. It can be, you can pay your tax fees, your, I don't know, everything with UPI. So I think from if I would be a customer, if the digital euro would end up like UPI, that would be fantastic. But that maybe means that maybe we need to also merge the Vero initiative a little bit closer to digital euro, because if I'm a customer at the end, of course, it will be a little bit confusing. Why should I use Vero and why should I use digital euro? So hopefully, and UPI is a good example of, as you said, a private-public partnership, so that as a customer, maybe we see hopefully a convergence of both initiatives. And if the user experience is like UPI, so that would be fantastic.
Let's maybe close this panel with some kind of a quick fire round. So I like to always close maybe a very precise answer. I know it's always not black or white, and let's see if we all want to do that. But we talked a lot about requirements. But if you say for the pilot, like one thing that is a must, that has to be ensured 100%, that this is a success, and also people may use the digital euro subsequently. What this one thing be?
Maybe the commitment by the PSP, and so not only observation, but real participation.
True public-private partnership.
This is actually, you stole my words.
Two central bankers.
Exactly, we think alike. But this is what I would like to let's say, remark on from our side. What would be important is actually continuing our collaboration with our stakeholders. And from the pilot, we would like also to learn from them, to hear from them. And of course, it will be an opportunity for, listening and also adapting.
And I think also Jan stole my closing words, because I wanted to say convenience, but I will continue on convenience. I think the digital euro should be effortless to use. If paying with the digital euro is not as smooth or as even easier, ideally, than existing options, people won't use it.
I think, as I said, it's the kickoff. I think for the implementation of the digital euro as the pilot, I think would be good to see that now everyone is embracing it and starts really thinking about the implementation, the impact, and really gets started on this. So because time is short, and I think every hand is needed now. Yeah.
Very clear. So this was really a great discussion. Time really flew. So thanks so much. It really shows that we need all different stakeholder groups to participate in the pilot. And we also heard this from Stephan in the beginning, that it needs collaboration in this regard. And yeah, we as an association are of course also here to facilitate that. So thank you very much. And yeah, handing back over to, can we do one question? Yeah, okay. We have 2.5 minutes left. So Tony, you were first. So let's go to Tony and then.
Yeah, great panel. Thank you very much. Luca, you said you want the merchant service charge, I think, to be 10 basis points. Is that right? Did you say merchant service charge? You want it to be 10 basis points, 0.1%? Yeah. This is small carrot for PSPs, is it not? So is this sufficient motivation for PSPs to want to participate? And then I guess it comes down to then what is the cost for a PSP? So what's not clear in my mind is the modification required for a PSP, is it only software or is it software plus hardware?
Should I start? Yeah, I think it should be cheaper than existing solutions. If it is not cheaper than existing solutions, merchants won't use it and they will not promote it. Simple as that.
I think what we have seen is actually, depending on the size of the merchant, quite a wide spread of the costs that you can endure through the different schemes that might actually be used. So I think that's actually several things. It is standardization for the merchant, right? That makes life much easier for all of them. That is also comes in when it comes to hard-end software, so to say, right? If you need whatever devices or anything, if you can really standardize them. And I think the second thing is, and that is in the political process, is that from a Eurosystem side, the infrastructure that we are providing that then PSPs sit on comes at no cost. That's the cost that we bear. Nevertheless, you know, the next layer, so the merchant has to bear some cost to offer that payment mechanism as well as the PSPs. So we try to, you know, take a strong part of the bill, and the rest have to then, you know, fit it in there.
Maybe to comment on your second question. So I think the cost is going to be high. That's the reason why you should prepare early and start early. Because it's not only the infrastructure and the software, it's about processes. You need to think about your business model. Maybe you need to think about your payment strategy. Where can you include the digital within your payment strategy? And then you need to talk with your vendors. And there you have the hardware for offline payment. You need the correct hardware with maybe secure elements or whatever. So there are a lot of different areas you need to touch. And that's the reason why we always say, better start early to think about it than too late, actually.
Okay, let's do one more last question. Here we have the microphone. Please, quick.
Yeah, I'll be brief. So thank you, very interesting panel, really comprehensive coverage in terms of the pilot and the retail side. I just want to bring out one other aspect, which was last year there was really good insights from the innovation partnerships which are done on the digital euros about the potential value to businesses from things like conditionality, and therefore that maybe this could help unlock some elements of further economic growth. So I'm just curious about how the central bankers are thinking about taking those insights forward.
Thank you so much for the very interesting question. And of course, as you said, last year we conducted an innovation program. 70 participants from all over Europe were participating, taking part. And of course, we have taken this exercise so seriously that, of course, we will continue along this line. So we will be, let's say, promoting in the upcoming future a new program for continuing exploring and experimenting together with the market, including the scenario that you mentioned. So we will continue along this line.
Perfect. So thank you very much for the great discussion. Thanks for the great questions. And yeah, handing back over to the moderator, Marcel. Thanks, everyone.
Thanks everyone. It was a very insightful and cool panel. Lovely. We are, before I can send you off to the networking break, which is well deserved and which a lot of you are probably very much looking forward to, I wanted to briefly take a chance to give the people that are online viewers, but also the people that might be a little bit too shy to raise their voices, if they have a question. If you want to submit a question in the app, you can hit the currently running keynote or a panel discussion. You can it is indicated by a timeline or progress bar, basically. You hit it, and you can hit live discussion, or in German, I think it's in English, it's a live discussion. In German, it's in English, live interaction, German, live Diskussion. And then you can just post your questions. Everyone can see them, upvote them. You can upvote others, and we'll do our best to forward them to our panels and speakers. And also, one quick note. When we continue at 10:40, this main stage will, of course, continue with an exciting topic. We are going to continue with offline payments, which is quite the relevant feature in the realm. But I also wanted to inform you that the roundtable room as well as the innovation stage are also opening. And the latter is also available on the stream. And with that, I am happy to invite you to take a walk, get some fresh air, and of course to network. See you later. Ladies and gentlemen, I would love you to rejoin the Audimax so that we can continue with our next fantastic keynote speaker. We'll wait for a few more seconds and then we will start. All right. Welcome back. I already teased you before the break with offline payments at scale, and now it's finally time to welcome our next speaker. Right here with me is Joachim Samuelsson from Crunchfish, and I am thoroughly excited what he will talk about. Conditional payments, identity, he has it all, and of course offline payments, which are crucial features for the digital euro, for the topic at hand, and I am excited. And with that, Joachim, I hand over the stage to you. Enjoy, everyone.
Thank you. I'm excited as well. Thank you so much for having me here. Today I want to challenge one of the most important assumptions in digital payments. We have for long treated offline payments as a feature, something you add to the edge of a system. But my message today is very different. Offline is not a feature. It is an architectural choice. And the architecture determines everything. It determines where liquidity sits in the system. It determines how risk is managed. And it also determines who captures economic value when payments move offline. I will show you that the industry has been working with an incomplete model. There is sort of two legacy offline architecture, but I will introduce today a third one, which we call governed offlines. And it is the governed offline model that does allow offline payments to scale without breaking the system or the structure of digital money. And if this holds true, this will not really just be about resilience. It will actually be about how we design digital money itself. When payments fail, society pauses. That is the reality we are now all operating in. Digital payments is not just a convenience. It has become embedded in our daily lives, commerce, and public infrastructure. So when digital payments stop working, the impact on the society is immediate and visible. And that's why offline is no longer optional. it is an architectural responsibility. Offline is really where systems are exposed. Failures do not happen in isolation. It could be connectivity failing, but even worse, a black swan event where a whole backend system goes out or the whole payment rail fails. And these failures tend to cascade. And this is why offline matters. It's not an edge case. It is the moment where the true system design is being revealed and tested. Here's the two models I've been talking about. It is the deferred offline, where money is placed on user devices. It is deferred offline, where validation happens later. And these two models has actually defined the entire discussion. And because of that, the design space has been severely constrained from the start. So if we look at what these models actually do, the patterns become very clear. Immediate offline moves money out of balance sheets onto devices. That's what ECB went with a big tender on for offline payments. The card model is somewhat different, but they move risk forward because it's like a personal check and you don't know whether it can sort of be banked. So continuity has always, in these legacy models, required a trade-off. You want to solve resilience because online payments, they don't work all the time, but it's always been a trade-off. We're going to move risk somewhere else. And that trade-off has always been accepted in the industry as unavoidable. So the hidden assumption has been that offline always requires a trade-off. But it only holds with legacy models. If we instead treat offline as an architectural choice, something new appears. There is a missing category, governed offline. Offline is not a trade-off anymore, it's simply choosing the right architecture. Once you see it, you really can't unsee it. The picture becomes very clear. There are really three offline principal architectures. Immediate, money goes on devices. Deferred, delayed validation. And then governed, controlled execution. And the third model is fundamentally different because governed offline preserves system integrity and it keeps risk bounded. This is how it works. It's kind of simple. Money stays central all the time. You don't move it onto the devices. You don't. Execution, though, moves local. Funds, you start with reserving funds centrally. So the whole capacity you can pay offline is reserved. It's like a smart contract, or it's a conditional payment, or programmable payment. Then you execute locally with defined limits, and settlement becomes then deterministic, because it's bounded by what has, in the first step, been reserved. So we're not moving money out to devices, we are moving control execution to the edge, while keeping money in the banking system or in regulatory institutions. This is not theoretical. This is happening all over the world. India leading the world with half of the world's volume when it comes to real-time payments. They gave us regulatory approval already back in 2023 for this. We're working with MPCI now to implement governed offline in their digital rupee system. They started with the immediate model, moving money to the devices, but they realized quickly, don't do that. Do it with governed offline instead. We've already shown it on the digital euro rail because luckily they defined not just that they're going to do offline, but they also said let's do conditional payments. And we have shown that this is a type of conditional payments. You essentially reserve money to yourself when you set up a smart contract, not to a third party, with yourself. And that capacity is what you can use offline, and then the system waits until a signed transaction from you comes back to the back end, and that's the condition which will settle it. Bank of England have officially said that they're not doing the immediate model. they are going for deferred. But they selected us as the only offline player in the Digital Pound Lab, and we are now finalizing our work with the Digital Pound Lab with a governed offline approach, and I think they like it. We also, when we published the white paper, we got global endorsement from the Central Banking Standards Organization saying that this will define a new standard for offline payments. We believe that the discussion should be about institutional alignment. And to evaluate this properly, we have developed a lens, we call it the big analytical framework. And we believe any offline solution should be tested against that framework. It needs to be bankable. If you don't make it bankable, the banking sector will not like it and they will sort of fight that solution. They just have to be forced to do it, otherwise they won't, because this is not good for banks. It needs to be implementable, and that's on the wallet side or the application side. It needs to scale, it needs to be interoperable, and ideally also vendor neutral, so you don't have vendor lock-in. And last but not least at all, it needs to be governed. You should not create a digital parallel money system that is completely outside the supervisory perimeter of a central bank. You should keep it as digital money. And that's important for the system, and it's important for the role of the regulator as well. And you need to have real privacy. Yes, you can believe that you have privacy with a system that looks like replicating cash, but any system will put up central reconciliation, and they have token chains. That kills privacy. This is how it looks, implemented with a big analytical framework. Immediate model scores a red light on all three. The deferred model, which is common on the card schemes, yeah, it's somewhere in between. But it's only the governed model that has all three. It's banking friendly, it's implementable, and it can be governed. Now I have to turn on my glasses now. Can't read anymore, so I probably have to take it up now, because this is my snow glasses from Nepal. They are extremely dark. Do you want to know what it is? It is an innocent design decision very early that determines everything. You can feel it when you go to work, when you go to church, or when you pay your taxes. If you let form come before function, you may think it is about let's make physical cash work digitally. But really, what the problem to solve is how do you make digital money work offline? It may on the surface sound the same, but the outcome, if you start with the right decision, you start with a function, then you come to form, you get to completely different consequences. Unfortunately, you can be told what these consequences are, and you can see it for yourself. And when you see it, there is no driving back. You go on green. The story ends. Money still sits with regulated institutions. Offline can be implemented at scale and governed as digital money. But if you drive against red, you will stay in Wonderland, and I will now show you how deep this rabbit hole is. Remember, all I'm offering is the truth, nothing more. Follow me. Sorry, I didn't change it. We are now looking at 3 categories: bankable, implementable, govern. But let's go down to sub-dimensions for that. What do we mean with bankable? What does that mean? It means that liquidity, money, stays on the bank's balance sheets, number 1. Number 2, it means that we don't deteriorate the funding efficiency of banks. We rather should improve it. Then they like it. And you don't put on implementation costs which are sky high. I've heard that the Digital Euro project is spending more than half of the budget on offline alone. Why? Implementable, it needs to scale. It needs to scale on all devices and not regulate that people have to use certain devices. Otherwise, you can't really be allowed into the euro area. What is that? It needs to be interoperable. And that means interoperable within the system, but also cross systems. And it needs to be interoperable with POS systems. This is requirements that any implementer would like to see. And it should be competitive. You should create a vendor-neutral system. And look at governed. You shouldn't move the systemic risk for online payment. You shouldn't move it out to devices. You should have bounded risk. Authority should continue as it is today with digital money. You shouldn't have to devise new rule books for a new form of digital money that resides outside the parameter of a central bank. And lastly, you should have real privacy. Not tell people that we're going to do it like cash and still keep centralized reconciliation and token chains, which really kills it if you really understand how the system is working. What's interesting with the governed offline model is that at its core, this is why it's so fantastically interoperable. Because interoperability, anyone who worked with India, they had a lot of different PPIs, prepaid instruments, with a lot of QR codes. And then they had UPI with another QR code. And they said, no more of that. Everything has to be now interoperable. And then they said, any PPI, any prepaid instrument, they have to guarantee 2 things. Authorization from the user. They have to be able to show that within their system. And they have to show solvency, that the money is there. Then they can push the payment on the UPI rail. These 2 are the requirements. The immediate model has money to pay. That's what you have in your wallet, but has no cross-system interoperability because it's bounded with a token. It's not interoperable but with anything except within the system itself. The third one, it scores on the other one. Yes, there is authorization to pay. You certainly have that, but you have no solvency. It's sort of like a check which may not be covered. But governed offline, within an offline wallet itself, solves both authorization and solvency. And that is what makes it so fantastically interoperable. We have patented this architecture. We filed the first patent in 2020. It's already granted in Europe, it's granted in the US, and it's granted in Taiwan. And I may have got it, I just haven't got it confirmed yet, in India, today actually, being here. We have it now in India as well. It's just then pending in China. That's the only thing we're waiting on. And when we work with MPCI, as a system operator, they don't want to lock in with us. And they don't have to, because we help the system to accept offline payments. That's what systems do. They don't make payments, they accept payments. So we build a vendor-neutral offline acceptance system. Anyone who can pay online should be able to also accept the payment offline. That's what we help MPCI doing with the governed model. And then anyone can deliver an offline wallet. There could be, yeah, we provide that, and we can license that to on the issuing side. But it's a vendor-neutral system. We don't lock them in. No additional transaction fee whatsoever. And this is what we're aiming for in India. Let's look a little bit about the economics, because online, if you look at that, it's cost neutral. It has a systemic risk that if a black swan event happens, everything goes down. But what offline in a governed model does uniquely is to offer economic value, because who holds those reservations? They are the one who control the funding of the system. And that could sit on for your own users on your own balance sheet. That is to become a driver. You hold your own reservations for basically your customers. But even better, you could become an ecosystem hub, and you could facilitate for others that you can hold their reservations as well. But you could also, if you are so daring, you could just become a passenger. You pay for a ticket on the train, and then you have the capability. You just pay for an offline wallet, but someone else has done the system. But I don't advise that. You could stay on the platform, not doing it at all. But when we now have shown that offline payments is possible, I don't think it will take long before this sort of wildfire will hit the whole world, because we have really moved the market from something which was a compromise to something that even makes economic sense to banks. Moving beyond payments, because really what we are creating is we have a trusted client execution. That's what we can do in our offline, and we do it in software. The strength with this, if you look at an open banking environment, we could, and we are working with another startup here in Europe to coin the word, not just open banking, resilient open banking. And that means that they have their open banking. They already integrated with over 5,000 European banks, and they have 100% of the Brazilian banks already with open banking. We add our layer 2, to that system, and then we can create governed offline payment as well, but also, interestingly, native authorization without any dependency on a national EID system. So it carries over, because we solved that as well, digital identity, and that will be important for maybe for the OID wallet here. So it's essentially about verifiable credentials and client trust. From insight to action, we could take our offline wallet or our offline system anywhere. We can do it with a single bank, a leading bank in any market, as an on-us system. We can do it for a closed-loop wallet in a market. We can do it for a national payment system. We can do it for a regional euro system. We can do it for a global payment system as well. And we are here because ECB, they have announced a call for participations of PSPs into the digital euro rail. Any banks who are here, partner with us. You could show offline payments without taking money out of your balance sheet, and you sit with the reservations, helping your funding efficiency. We would love to do that. And ECB are telling us, please, you have already shown that what you can do, be with us. And I said, yes, fantastic. So that's why I'm here today. So to sum up, there are 3 offline architectures. The industry have incorrectly framed it as only 2. But today, yeah, there is another one. It's been around for 5-6 years, but we haven't really been able to articulate it really well, so no one really got it. But governed offline is the 3rd one. The architecture that you choose for offline payments will determine everything, the outcome. And the interesting thing with the offline payments, it's sort of that the holders will hold the reservations of this value. And as I said before, this carries far beyond just offline payments. Thank you very much.
Joachim, thank you for this valuable contribution. It was straightforward, clear-cut, and a pretty solid value proposition. Thank you. Our next panel looks at the infrastructure layer as well. It looks at the infrastructure layer behind the future of the digital euro. Please welcome Lead Digital Money at KPMG and DEA's very own Vice Chairwoman Anne-Sophie Gógl, together with her esteemed panelists. Please come on the stage, everyone.
Thank you very much. And hello, thank you for the welcome to the panel. It's the Euro Settlement Stack, Pontes Progress, Ambitions for Appia. And I welcome Adeline Bachery de la Banque de France, Marco Kessler from SIX6 Digital Exchange, Christoph Hock from Union Investment, and Bert Staufenwil from KfW. Please come to sit with me. Oh, can we have a slide? There you go. Now you can read the names as well. Great. Yeah, welcome to stage. So as we heard today, we are moving from experimentation to implementation. And yesterday, the ECB just published the service description for Pontes, which seems to be some kind of implementation guide for market participants to Pontes. And I guess that's a strong sign that we are not longer in discussions, but moving into implementation. And I'm very happy to have a panel here with me that reflects the full ecosystem: central bank, market infrastructure issuer, asset manager, and issuer. So to start first with the first question, I would like to short introduce yourself. Answering the question, when you first entered the world of settlement infrastructure, did you ever have the moment where you thought, wow, the system is incredibly complex and maybe a bit old-fashioned? This definitely needs modernization. Or what originally drew you into this field? We start with Adeline.
Thank you. It's a difficult question. So first, maybe you know at the Banque de France, we regularly switch departments within the bank. So when I entered the Financial Market Infrastructures Directorate, FMI, so Financial Market Infrastructures, were completely new for me. And yes, my first impression was, wow, it's so complex. So this wonderful innovation, I think, has helped me to cope with this complexity. But maybe also it was useful for me to learn about the background of financial market infrastructures and how it works in the current world. And looking beyond the technical side of plumbing, it's very important to understand the concepts of our job. So, for instance, understand why optimizing liquidity is so important is crucial. So, I'm not saying that we will only replicate the current market into tokenization. But we need to take it into consideration when designing the future.
Thank you. How about you, Marco?
Thank you, and hello, everyone. Yes, definitely. Although I would say at the beginning, settlement looks like, well, you just move something from here to here, right? I mean, what can be so complex about it, right? And then you learn about matching, instructions. Oh, right, there is a good reason for that, right? And then you learn about, the actual life cycle of assets, and how they interplay with settlement assets with money. And then you learn about the stack, right? The stack of market infrastructures. And you're still just at the plumbing level, you're not even yet at the actual policy levels or investor protection level and all of that. So yes, definitely, I keep learning about complexity still today, I would say. Yes, but my background being in transformation, even prior to joining 6 Group, always digitalization, digital transformation, now with new technologies, DLT and blockchain related. So I think it's about managing complexity. And to the last point about, complexity, I think if you look at today at systems which were designed maybe 20, 30 years ago originally, or 10 years ago even, I think it's normal to see historically grown complexity, because I'm pretty sure whenever somebody designed a system which is, let's say, traditional today, they didn't think of it as being complex. But complexity grows, keeps growing, and this is just part of the game.
Thank you. How about you, Bert?
Thank you for being here. We started in 2016 looking at blockchain and understood you have a token, you have an asset, you put it in a smart contract, and then it's exchanged. So that's in an ideal blockchain world. Then we decided to do a real project. And usually when you start a project is you draw the current system. And the current system is you have, in our case, the dealer, you have Bloomberg, you have us, You have CSD. Usually the CSD also is having an IPA, so an issuing paying agent with him, and so on. And so complexity grows. And the unfortunate thing is that everyone has their own data silo, and they can't agree which data basically is right. So therefore you have someone in the middle. So that creates complexity and time. And for this, basically, we understood what could be done on the one hand, what needs to be done. But in Germany, the framework was not ready in 2017. So it was rather difficult to do something on this. So therefore, we decided to do a simulation trade, which is clearly traded because you had to have the physical document for a trade, and the physical document on a DLT is not possible. So therefore we looked, what kind of steps needs to be done, and fortunately, and I think we come to that also during the panel, some regulatory things have changed, some law things have changed, some mindset has changed, and therefore it's interesting to see how it developed in a rather fast time, at least for an adoption standard.
Thank you. Yeah, Christoph, what was your way into that ecosystem?
So when looking at my career in financial markets, Anne-Sophie, I think it's fair to say the only constant factor in financial markets is change. And my original DNA was in trading, and I was in my first years in markets open outcry trader for Dresdner Bank here on the Frankfurt floor. Then I was part of the development team of Deutsche Börse, setting up Xetra, the first electronic trading platform. Then during my times, while I was running a hedge fund, we've been one of the first users of algo trading. And when looking nowadays at financial markets, you really question why on earth do we need in paper format a physical global document? Why do we have settlement cycles when going into a new bond issuance of T+5, of T+7? Why does it not work in a quicker way? Why do we take risks? Actually, we do not want to have. And then when looking at the settlement of transactions, why do we need reconciliation processes in a fully automized world? Does it not work in a much better, easier, less costly way? And I guess when raising all these questions, you easily come up with the tokenization topic. And it's not only about tokenization of assets, but to really raise full efficiencies, you also need digital cash rails. And that's our topic here, and very happy to discuss wholesale CBDC.
Thank you. Yeah. Before we deep dive into Pontes and Appia, the dual track strategy of the ECB, we will just have a quick recap. We had the Eurosystem wholesale experimentations going on, involved with financial institutions, infrastructure testing, DLT settlements, and central bank money. What were the key learnings the Eurosystem took away from this experimentation that you did take your choice to move on into Pontes, and that influenced your choice?
Yes, so maybe the first, I see three lessons maybe. The first lesson to be learned from this exploratory work in 2024, the first lesson is a success. Between May 2024 and November 2024, so on a very short period of time, we brought together 64 participants, including central banks, fintechs, industry, banks, and DLT operators. We conducted 50 plus trials and experiments. And so trials, yes, involved real settlements in central bank money, and nearly 1.6 billion euro in central bank money was settled. So this is the first lesson, success. The second one is the high demand for central bank money in the tokenization sphere. It's not just mandatory for financial institutions to settle financial transactions on systemic markets. Financial institutions do want to use central bank money to secure their interbank settlements. And so actually we pose an old but fundamental question of the role of monies in the economy, with central bank money and private monies. And trust, I think, is at the heart of this relationship. And central bank money brings trust, and so we need trust even in the tokenization sphere. So this is the second lesson. And the third one, so beyond the technical reasons we could have, but we like to focus here on the collaboration we had between private actors and public actors, and between private actors. So as you know, post-market is crucial, and it's a very competitive sector. And it was very exciting to work together and to bring together, to align stakeholders on the potential benefits of DLTs regarding the functioning of markets, for instance, the fundamental function of an exchange, from trading to post-market activities, to custody, for instance, or on cross-border payments. And so with the success, with the role of central bank money, and with this incredible collaboration, we have the foundation for Pontes and Appia now. Yeah.
Thank you. Marco, do you agree, or is there still something missing for infrastructure like SDX to settle these transactions systematically in central bank money?
Thank you. Well, first of all, at SIX Group, we have to clarify, we operate two financial market infrastructures, for two markets, for the Swiss market, for the Spanish market. So, and obviously situations are different across geographies, right? We have a live pilot in Switzerland with the Swiss National Bank for the usage of central bank money in the infrastructure, and in Europe we have participated in the trials and experiments mentioned earlier, and also in the Pontes program in the contact group. So having said that, I think it's, the pace is fast, I have to say. I know from private market, private sector perspective, it can never be fast enough, so to say, but I think from my observation point, the pace is fast. What is important, I think, is to continue on that pace, and also to come to a realization following the roadmaps that have been also published very recently about the contact groups. I think I want to make something clear, though. It's very important from the point of view of a market operator like SIX Group. We need central bank money to have the safest possible way of supporting interbank settlement. That's clear, that's been mentioned before, and I fully agree with that. At the same time, we stay a bit in the middle, because we need the market as a whole to develop and think about use cases leveraging these settlement assets. So, so to say, the story doesn't end there, basically. And I think this will be very important for general adoption. It's one thing to have the enabling factors, and central bank wholesale, central bank digital money is absolutely required for that, but it doesn't stop there, because to really see the benefits in action and the full picture of this mosaic, basically, you need to also have the market participants, including banks, issuers, investors, to focus on effective use cases that bring those benefits to life, leveraging central banks, so digital money.
So it's a call to Christoph, I guess, yeah, as an asset manager. So where would tokenized settlement create the real value then?
I'm more than happy, Anne-Sophie, to share my thoughts on this topic. So I think first, to start with what's from our perspective the very big picture, where will financial market industry go to? So I believe on the one hand, tokenization, looking at the asset side, going forward will become the standard. So no global physical document anymore. Tokenization, the key benefit is also programmability of assets, programmability of cash. So that's point number one. Point number two, we see a tendency going into 24/7 trading. So imagine you are a treasurer and you have cash inflows on a Saturday or on a Sunday. Why to wait until Monday to let your money work for you? So that's the second point. And the third point, I was already addressing it in my brief introduction. We will have significantly shorter settlement cycles. I'm not sure whether we will have atomic instantaneous second zero settlement, but I'm a strong believer that we will have a near time instantaneous settlement. So that's the basis thesis we have for the future. And then what benefits does it bring for individuals in the ecosystem when we're looking from a treasury perspective? Going forward, you will have the ability to collect interest not only on a daily basis, but on an hourly basis. So as a treasurer, when you are long cash in the morning at 8, you know you have to make a payment in the afternoon at 4 o'clock. Today you are stuck. You keep your money in your box, not earning interest for you. Going forward with the 24/7 trading, with a near second zero settlement, you can earn yield on a minute by minute, on an hour by hour basis. That's point number one. Point number two is collateral. Big theme in our industry, collateral mobility. So even in a world which is not fully tokenized, going forward, you will have the ability, and these are offerings coming from DEC26, the US ICSD, and also Euroclear and Clearstream fairly soon. Just by clicking a button, you can tokenize a fraction of assets you are holding, and you can instantaneously transfer these assets as a collateral. So today, when pledging collateral, fairly often you make use of cash. Cash is, so to say, the kind of most important asset, regardless for a treasurer or for an asset manager, because we want to invest cash in assets to earn, generate performance for our investors, and you do not want to use cash as a collateral. So going forward, by making assets smart, so to say, you have the ability to pledge, easily pledge assets you have in your portfolios as collateral. And most important, when having these near second zero transactions, there's a requirement to have digital cash. And that's where wholesale CBDC comes in play. For us as an asset manager, we do not have direct accessibility to target 2 accounts, so therefore we indirectly benefit from wholesale CBDC by making use of tokenized deposits, for example. We have with our custodian, and that's one of the key benefits I see from an asset manager's perspective. I was addressing the shorter settlement cycles, taking out significant risks. Also to share here some examples. A couple of years ago, we've had German pharmaceutical company Bayer. They were issuing a bond in the US. This was on a Thursday. Settlement was T+5, so a Thursday later. And Bayer, they had to come with a profit warning over the weekend due to some medicine which wasn't properly working, and the stock opened on Monday, Frankfurt Stock Exchange, with a minus of 20%. And asset managers, having subscribed for this bond, given the fact that there was a T+5 settlement, they were stuck. They couldn't make anything. They couldn't sell. They just were stuck. And another example, when looking at the Credit Suisse crisis, which also was occurring
Makes
over
it very obvious what you're saying.
a weekend, having sold bilaterally transactions, bonds with Credit Suisse on a Friday over the weekend, so T+2 settlement, Tuesday over the weekend, you haven't had any clarity, will this transaction settle or will I still left with a long position in bonds? And therefore, Shorter settlement, immediate permanent accessibility to the assets is a key requirement, and DLT will be highly supportive in this case.
Yeah, thank you. From the perspective of an issuer like KfW, where do you currently see the biggest gap between what is technically possible and what is actually used in practice?
So maybe to give also one example, if we trade, for example, a bond in Australia, we usually have also a T+5 settlement. And what we do basically on the trade day is we enter a swap, because we do not want to profit from the currency margin. We decide it's the right currency to issue in, and then we swap it into euro. For the 5 days, we are paying for the swap, so the market to market, although we are not having liquidity yet. So that's something we have to hold equity against, and so on. So this is something which is, a timing problem, and as Christoph also said, you can't do anything in between in the times. You just have the risk to accept it and to pay for it basically with regulatory capital. But in general, I must say, as I said before in the first example, is what we are seeing is usually a trade done between two parties. So it's very easy, very uncomplex, of course. If we are really looking at the world, it's more complex, so more parties involved. And I think we have to come together as an industry in order to understand basically what should be common and shared and what should not be common and shared. And I think a network where we don't need to reconcile is something worth to think about. And therefore, having a network where we can work together, it doesn't have to be one, it could be several ones, especially looking at regulatory aspects. I think there will be a European one at least, and a US one and an Asian one. Doesn't make sense to have everything on one thing, but there could be alternatives, like a private one, a public-private one, also a public shared ledger. And one thought is, if I found a bank, or if I would found a bank now, would I think, do I have to buy a power plant now to power all my electricity? No. It's a commodity, and I just go to the socket. I just have to pay for it, basically, but I don't have to produce it. Do I have to create a new internet? Probably not, because it's already there, so I build on this. So the question basically is, what is the commodity in the future? And the network where we operate, where we do not have to reconcile, could be one of the things where we come into commodity space.
Thank you. And there we come to Pontes, right? The bridge between the settlement infrastructure and the DLT. Adeline, do you want to deep dive a little bit into Pontes and maybe have an outlook to Appia?
Yes. So, as you know, during the exploratory work in 2024, we tested 3 solutions to settle financial transactions on DLT in central bank money. So the first one was a trigger solution to directly trigger a payment in target 2. The second one was the hashlink solution to directly trigger a payment in tips, which is also part of our target services. And a DLT-based solution to make a payment directly in central bank digital currency, so with a token of central bank money. And this is an interoperability model with DLT markets. So the Eurosystem, we issued in 2024 our CBDC on our DLT, and we had transactions with DLT market operators, and the industry could issue their financial assets on their DLTs. So this is an interoperability model with DVP in between, and so we will continue with Pontes with this model first, as we also have a time to market constraint, and there is an urgency to provide central bank money in the tokenization area to the industry could leverage the central bank money and provide their own services. And that's why, as I mentioned before, based on the success of this exploratory works, by the end of this year, and by the end, actually, of the third quarter, the Eurosystem will provide central bank money on DLT to directly settle financial transactions issued on DLT and for your business. So we are going into production. That's important. It's very important. And so meaning that the ECB and the Euro system will be one of the first central bank in the world to provide central bank money on DLT with Switzerland also. And so, for instance, in France, we have a project called Pythagore with our CSD, Euroclear France. And this project aims to tokenize short-term negotiable debt securities and to modernize this short-term debt market through an interoperable DLT platform and settlement in wholesale CBDC, with Pontes. So this is by the end of this year, end of the third quarter. We will go into production, and that's why you mentioned in introduction, you mentioned this service description document, about 90 pages, and so this is a very important document to connect to Pontes. But I would like also to mention that in relation to what you said before, that this is the foundation with CBDC to prepare a global tokenization market. And of course, we will provide CBDC by the end of the year, but we will not change the policy access to central bank money. And CBDC is central bank money. And so we will have, it's crucial to have an appropriate central bank money in the tokenization sphere to support the development of tokenization. But central bank money is not intended to meet all the settlement asset needs. And as we have today, we also need commercial bank money and private settlement assets in the tokenization sphere. So that's why we also need commercial bank money to ensure the financing of the economy as it is in the current world. So it's important in relation to our sovereignty to have these tokenized deposits or euro-denominated stablecoins issued, of course, by a regulated financial institution. So yes, I fully agree with you.
Thank you very much. So Marco, if Pontes were available tomorrow, how quickly could SDX connect to Pontes?
Tomorrow? No. Well, I mean, okay, let me abstract a bit away, because as I mentioned earlier, I think there are differences, of course, across geographies, and obviously also differences across market infrastructures, in terms of readiness and operational, technical readiness and all of that. And let me take, I mean, obviously one of the first criteria is obviously, as usual, about regulation, having regulation available and enabling certain models, business models, and tokenized models, so to say. But let me put that aside for a moment. I think, I mean, this dual track strategy, I think it's very good to enable something, some results and some connectivity early on, while having a long-term view, a long-term plan, also for more seamless interoperability in the longer term. I think it's obviously there are differences, as I said, on the market infrastructures, but many players have, especially financial market infrastructures, not only SIX, but also Euroclear, Clearstream, and others have collected a lot of experience in this space in the past. The DLT market operator, obviously by nature. So I'm hopeful that this can be, can be happening in short time in that sense, with obviously differences in that space. And no, I think, I mean, coming back to the point, I mean, there is a strong demand from the private sector to have a solution in place. There is, I think, the public sector with a lot of activity and I think recognizing also that demand out there. So as long as I think the work is harmonized and aligned between the two spheres, then I wouldn't see big obstacles in that space, which is good.
Yeah, thank you. Looking at the time, I would like to look a little bit at Appia as well. So if Appia succeeds in creating a new settlement architecture in Europe, what would make it competitive globally? What would need to be in place for international financial institutions and markets to connect to it? And I would ask Bert first.
Thank you for the question. To be honest, my understanding of Appia is that it is a process, basically, rather than a product, and it's supposed to enhance, Pontes. Maybe, coming to another, product in the end, but it's not as such as a product. It's more a way to arrive at an infrastructure which could be, future-proof. So
I see Adeline has something.
Yes.
She wants to say something.
Yes, yes, you're right. Pontes is a product. We will be in production by the end of the year. And Pontes, okay, is a long-term track, but starting now. And so with Pontes, we will have CBDC. We will have also services around CBDC, with Pontes also.
I think we agree.
With Pontes.
Pontes is a product which is integrated into.
And Appia is to design the future of financial market in Europe. So we will not do it alone. We need because the ECB with T2S we focused on the settlement, but here with Appia we need to look at the whole value chain, so from issuance to custody, and so we will not do it alone. And so Appia will leverage Pontes, and at the end we will combine both, because it will be the same. It's the same project.
I think that's what we have learned from the experimentation phase, that coming together as a market and to understand basically what one needs. For example, the safety and as well as the policy measures which needs to be implemented via the Eurosystem. On the other hand, the demand from the market, especially clarity on timing and stuff like this, is very important. And I think this is very helpful that we are coming together, that we are working together in one direction, especially for us. And regarding Appia, we need to make sure that we see where it goes, in which direction, especially looking at our IT systems. If we need to change anything in the IT, it takes a lot of time before we can really do this. And therefore, it's very important to know in which direction it is going and what are the key features on the one hand, so where we can use it, and on the other hand, you have regulatory certainty. That's very important, and therefore we are looking forward to see basically what's brought out, and our request is basically to make it as concrete as possible in order to make decision now, which can be now helpful in the further stage.
Thank you, Christoph. What is your opinion on that?
I think here in Europe we are absolutely on the right path with wholesale CBDC, and with this, it's not really a two-track approach as the ECB was saying. It's one single program, Pontes and Appia, and I think it's a clear competitive advantage that we do not go like the Americans all in on stablecoins, which from my perspective carries significant financial market risk, and that we have a highly trustworthy anchor by the ECB, by the public sector, and then we have private solutions, tokenized deposits and stable coins around it. But as a key economy here in Europe, there's a clear requirement of wholesale CBDC, and it's fantastic to see what the ECB has delivered in such a short period of time. And also important is the communication with the market. So as Union Investment, we are also part of the contact groups of Pontes and NTW, so where we discussed Appia most recently. And I think this consultation to get input from all the various market stakeholders and then to put it into a product, that's really key for this great success story.
Thank you. I would like to open up for questions. Are there some thank you. No questions, so I have a closing question. If we met again in 5 years, what would the headline be of today's panel?
Ladies first. the success of Savings and Investment Union with Appia, of course. And yes, maybe yes to mention that I fully agree, of course. But yes, Appia, we start now. It's important, and we need all the industry to progress. And that's why we published at the beginning of this month our roadmap for Appia, and we will enter now to exploratory works with the industry. And yeah, because we have this interoperability model with Pontes, and as you mentioned, we can evolve to meet the objectives of the Savings and Investment Union, for instance, to an more integrated model. But we will not do it alone, and we need a public-private partnership, and we need to work on it together to avoid, yes, investments and yeah.
Thank you. Christoph, what would be the headline of this panel?
I would like to rephrase what Trump says in MiCAR, Make Europe Great Again. I think we are absolutely on the right path here, looking at the payment side, looking at the asset side, and it's a fantastic collaboration. We have public and private sector, and we would just have to speed up and to stay on this track.
Thank you. Bert?
After the successful implementation of Pontes, how Appia basically has enhanced the beginning of the service, of the paying service.
Thank you. And Marco?
I would say experiences collected in a resilient and future-proofed European financial system, I would say. I think, yeah, by then, plumbing will be there, use cases will be demonstrated, and actually daily life, and so there will be more demonstration and experiences sharing, also in combination not only with DLT and tokenization, but AI, for example, agentic AI, how does it combine to provide secure services?
Thank you. So I guess we have a date in 5 years. Thank you.
Thank you. Thank you. Thank you. That was our panel on the progress of Pontes and the ambitions of Appia, and it was quite interesting. Thank you for the insights. One of our panelists will remain on the stage as we turn our perspective a little bit to the role of market infrastructures in shaping the wholesale digital euro and a new era for CSDs. Please give a warm, still welcome, I guess, to Marco Kessler from Six Group. And Marco, I think they are warmed up with you already. I'm happy to hand over the stage to you, and have fun.
Thank you. Wait a sec. All right, okay, already. Thank you, and well, hello again, I guess. So I'm here today for a keynote, and this keynote is without slides, so old school. I hope it will be interesting. And I want to talk about a new era for European CSDs, and speaking, as I said before, as Six Group, we cover both the Switzerland, obviously, as a financial center, but also Spain, and therefore our presence in Europe. So let me start. Well, thank you for the opportunity to speak, and with a simple mental image. Europe is building 2 bridges and a road. The bridges, called Pontes, just heard before, will connect today's distributed ledger platforms to target services, so that we can settle in central bank money without waiting for a full rebuild. The road, Appia, is the long-term route towards a truly tokenized European financial ecosystem. Together, they anchor innovation in the safest settlement asset we have, wholesale central bank money in DLT. Keep that image in mind, because I will return to that at the end. 2 bridges for immediate connectivity and a new road for the journey ahead. With central securities depositories and other financial market infrastructures acting as the interchanges that keep all traffic flowing safely and efficiently. We heard just before from the colleague from Mögelin that over the last 18 months, Europe has moved from proof of concepts to market-grade experimentation, with, in 2024, the Eurosystem coordinating the largest exercise of its kind. 64 participants conducting more than 50 trials and experiments, settling or simulating nearly 1.6 billion euros in transactions across 3 interoperability approaches, the ones mentioned. The message from that work is clear. Tokenization and DLT can compress the asset lifecycle from issuance to servicing to custody, but safe settlement in central bank money must come with us into the digital world. On that foundation, the ECB's Governing Council approved a dual-track strategy. Pontes in the near-term bridge linking market DLT platforms to target services with a pilot slated for the third quarter of 2026. And Appia, as a longer journey, a collaborative roadmap to design the tokenized wholesale ecosystem with a blueprint expected by 2028, subject to governance and consultation outcomes, obviously, which are currently in progress. So Pontes means we can connect DLT assets to Euro central bank money without forcing the market to pick a single technology stack. I think it's very important. It focuses on interoperability with Target 2, so T2, T2S, TIPS, so that participants can transact in central bank money with the operational, legal, and technical standards that we know. Appia looks further out. It addresses the governance standards and operating models needed so we don't end up with dozens of incompatible islands. So think of Pontes as the working bridges to get the traffic moving, and Appia as the road that we will pave together as a market infrastructure, market structure, to make that traffic seamless at European scale. Now, if I think about what does that mean for European CSDs, the implications for European CSDs, I can think for CSDs about 3 implications standing out. First, the cash rails, obviously. Wholesale central bank money will reach DLT transactions, either natively on-chain, where permitted, or via synchronized models, reducing settlement risk while preserving monetary policy transmission. Secondly, programmability. I mean, we heard some good examples before from asset managers and treasurers and issuers. Issuance, delivery versus payment, coupon, and redemption can be, for example, event-driven and automated through smart contracts with control functions embedded by CSDs, supporting safe and scalable models. Thirdly, interoperability. The bridges to target and common standards under Appia mean DLT can scale pan-EU rather than fragment jurisdiction by jurisdiction or by platform. So let me bring this a bit more to life now with what we've been doing across Switzerland and Spain. First, in Switzerland, the Swiss National Bank's Helvetia pilot has provided wholesale central bank digital currency on the SDX, digital exchange platform since late 2023. This has operated in a production environment under central bank oversight, obviously, and we've supported multiple digital bond issuances, delivery versus payment settlement in wholesale CBDC, and even the first monetary policy operation was executed on-chain. In May 2024, the World Bank issued a 200 million Swiss franc digital bond, settling the primary leg in wholesale CBDC by the Swiss National Bank on SDX, while maintaining investor access through traditional custody via 6SIS, Euroclear, and Clearstream. And I think this is a powerful demonstration of digital cash working hand in hand with established post-trade networks rather than against them. I think it's very important for adoption, especially, I mean, to kickstart this properly. Now, secondly, in Spain, through BME Iberclear, we served as a DLT market operator in the Eurosystem 2024 program alongside a broad group of Spanish custodians. Together, we tested full bond life cycles, issuance, secondary settlement, coupon, and redemption, with delivery versus payment against Eurosystem cash models. Iberclear made a significant effort to lead an initiative involved in the Spanish market community with the aim of supporting its clients in understanding a new ecosystem that has now become a tangible and evolving reality. And those lessons can be carried now straight into the Pontes pilots. And thirdly, a pan-European integration. This is separate from the DLT work, but Iberclear, together with LCH, is expanding settlement so that trades in Italian government bonds cleared at LCH will settle in Iberclear via T2S, targeting 2026. So when we think about, as I mentioned earlier, I mean, one thing is digital money, but the other thing is how do you employ it, how do you use it? So where does the value show up first, basically? And we feel a good case that was mentioned also earlier is the tokenized collateral and collateral mobility. So moving collateral in near real time with time precision, actually, more than just immediacy, enables intraday optimization, faster substitution, and better capital efficiency to basically leverage your assets much better than today. These are all practical wins for Treasury Desk and CCP-cleared businesses alike. Lifecycle automation is also a big topic. I mean, corporate actions, again, coupon redemptions, and other events, even complex ones, voluntary events, can become data-driven, on-chain processes, cutting reconciliation effort and reducing failure risk. Less effort, fewer breaks, faster time to cash. Another example are cross-CSDs flows at EU scale, at European scale. So as bridges to target mature, with initiatives mentioned earlier, CSDs can remain the account governance anchors while delivery versus payment flows travel across borders with central bank money finality. Innovation without compromising safety. Speaking of safety, we should also be candid about risks. Fragmentation is the first one that comes to mind. Multiple ledgers, multiple tokens, and no share standards is a recipe for duplicated cost. Appia addresses this explicitly through governance and standardization. But another area for risk is regulatory sequencing. The EU DLT pilot regime is evolving, and the proposed market integration package, MIP, looks to adapt CSDR and related rules so that FMI-grade DLT services can operate at scale. Raising or flexing thresholds and widening eligibility where risk allows. We must keep policy and market developments in lockstep, basically. I think it came out a lot during this morning's speeches that it takes both to work together to collaborate. And thirdly, speaking of risks and mitigants, it's operational resilience. Whatever the ledger, CSDs have to deliver neutral, supervised, and end-to-end control, data integrity, recoverability, and investor protection. That's our job in both the traditional and digital worlds. So what will we do with our partners over the next 6 to 12 months in the near future? Well, first of all, we will collaborate with Pontes and increasing our onboarding readiness. So we are actively and effectively supporting and contributing to the definition and testing of DLT to target flows and participant roles. So that's famous 90 pages document mentioned before, working in close coordination with the Eurosystem. Secondly, we continue the exploration of production level use cases. Together with willing banks, we will explore the use cases applying the tokenization of securities, for example, in the areas of event-driven corporate actions or tokenized collateral scenarios. These initiatives are designed not only to test feasibility, but to generate concrete evidence on how digital assets can potentially reduce failure rates and cost to serve, translating innovation to measurable market outcomes. I mean, especially speaking of Switzerland, now not so much on the Iberclear side yet, but on Switzerland, we have announced last year the integration of SDX into the broader SIX group, security services, and this is where we are looking at enabling tokenized securities at scale. So basically allowing all the assets which are currently held in the established FMI, basically to be seamlessly tokenized and seamlessly accessed by the market without or removing the complexity of ensuring that an asset is tokenized at the right time and the right place, so to take over this complexity. Thirdly, standards and policy input, we are working on this as well. So building on hands-on operational experience we collected in Switzerland and Spain, we will continue to feed evidence, insights, and operational learnings into Appia's consultative work and related new rule-making processes. Under the governance frameworks defined by the Eurosystem, our objective is to help shape a future-proof blueprint, one that reflects how markets actually operate and ensures that digital assets are embedded into the financial system in a safe, scalable, and market-driven way. So in closing, as promised, I go back to the analogy, so let me finish where I began. 2 bridges and a road. In 2026, Pontes will give us working bridges between DLT markets and target services. Appia is the road we will travel together to a tokenized European ecosystem towards 2028 and beyond. All CSDs are the interchanges that keep the traffic flowing and safely at scale and open to all participants. Our commitment at SIX and Iberclear is to build and operate those interchanges, neutral, resilient, and interoperable, so issuers, banks, asset managers, and investors can adopt digital markets with confidence. Thank you. That's it.
Thank you, Marco. We would have time for a brief question, as if there is one in the audience. Feel free to raise your hand. If that's not the case, I'll refresh.
You can also meet us outside anyway all the time.
Marco will be here all day, right?
Yeah, till the afternoon, and my colleagues are also
perfect.
Here later. Yeah. Yes.
That would be the alternative. But let me briefly refresh and check if there's an online question. Last time I checked, there wasn't, but we want to give everyone the chance to participate, especially if Marco's so on time.
Swiss.
You got a good watch.
Being early is not a good thing, actually, in Switzerland, to be on time.
No, we do not. We still do not have a question online. Marco, thank you very much for your contribution. You have been part of the stage now for over an hour, and we are very excited to have you every time. And perfect. Now, let me take the time for a very brief reminder. We have 2 more stages. I love you all being here, but I wanted to address that in the innovation room. We will have cutting-edge solutions, and in the roundtable room, which is a room that is in invite only, we have deep dives and interactive discussions. Each of these rooms has its own unique experience, I would say, and feel free to check them out. If you do not know how to find them, check our floor plan in the app. Yes, the app has it all. And you will find them relatively easily. If you cannot find them still, feel free to ask one of the staff members, one of the DEA members, one of the FSSC students, or even the FS staff will be able to point you to it. Also, the innovation room will be streamed, so check out that stream as well if you're into innovation room content. And now, without further ado, please welcome another very strong panel on the financial stack of the future, on how banks, public chains, and enterprise systems can actually connect to realize all of the promises that we have made during the day. And please give a warm round of applause to Tamara Schmidt, DEA's very own, and her esteemed panelists. And with that, Tamara, I hand over to you.
Great. Good morning, everyone, and welcome to our panel. So, the future of financial stack. how public chains, enterprise systems, and banks connect. And so if you look at the financial infrastructure today, it's no longer just banks and payment networks. We now have public blockchains, tokenization platforms, cloud-native systems, and programmable money, and all evolving in parallel. And the big question is, how do these pieces actually fit together? And who ends up playing the central role? And I'm here today joining by this fantastic group of panelists with very different perspectives. So perhaps you can start with a brief round of introductions. Tom.
Hello everyone, my name is Tom Chudi. I lead product development at Google Cloud for capital markets technology. We're building a few differentiated things to allow 24/7 movement and settlement of value for our partners. We're building a ledger, we're building a custody solution where we're taking care of the difficult cryptography, and we're integrating this very, very thoughtfully with AI features.
Hi everyone, great to be here today. I'm Nick Kerrigan, Head of Innovation at Swift. I hope Swift doesn't need too much of an introduction for this kind of panel, but we are the world's largest financial messaging provider. We connect 11,500 banks and corporates across the world, over 200 countries. We operate at considerable scale, so we see the equivalent to the world's GDP pass over our network every 2 to 3 days, and we do that in a really highly resilient way, so operating at 4 nines of resilience, 99.99%. And as you also know, we've been working really hard on improving cross-border payments. So 75% of the payments across our network reach the end beneficiary in under 10 minutes now, sometimes in seconds. And we're not standing still. We are uprating the existing rails, and we're also creating the rails of the future with a new blockchain-based ledger. So really pleasure to be part of this group today. Really exciting discussion.
Hello, everyone. I'm Marius. I'm from the Ethereum Foundation. Ethereum Foundation is a non-profit steward of Ethereum, the protocol, and its ecosystem. It's great to be here as a protocol for the first time. So I've spent a long time with BaFin and with crypto custody previously, but now I represent Ethereum, or the Ethereum Foundation, which hopefully also doesn't need any introduction. But within the Ethereum Foundation, I'm on the enterprise team. We act as a sounding board for institutional participants, actors, banks, anyone that is exploring the technology that need help navigating Ethereum, the blockchain, its ecosystem, and we try to be helpful in navigating those conversations.
Ivica Aracic is my name, so I'm CTO at Swiat, and where I'm investing my energy and time the last decade, so to say, is into bringing the puzzle pieces together that the regulated environment and regulated institutions need to scale digital asset use cases. And so basically it consists of having the infrastructure, and not only in the terms of just having some technology packaged and being thrown over the fence, but also looking how this shared utility in the form of a blockchain and DLT can be governed and operated at, let's say, European scale. And this initiative also has a name, so it's called the Regulated Layer 1. So that's one part. And the second part, so that we do at Swiat, is to provide tokenization and settlement engine. And let's say one of most notable issuances that have been done on our platform is the Siemens bond, the 300 million bond, done 2024. And additionally to that, so we also provide financial services in a sense of being crypto securities registrar. So crypto securities, it's a very German term, so it's under Electronic Security Act here in Germany, so EWPG. So that would be my side.
Great, thank you. So to set this stage, I'd like to get a quick perspective from each of you. So in one sentence, What will be the most important layer of the future financial stack? Tan.
I think that's a very difficult question to answer in one sentence. I think there's, like, if we look at the financial system today, the only thing that's very clear is that consumers and corporates alike like choice. There's a lot of choices, there's a lot of different technologies applied for different use cases. I think this is going to be very true in the future as well.
Nick?
Yeah, I agree with wholeheartedly with Tom that you can't answer that in one sentence, but I think the future financial stack is actually becoming clearer, and I kind of see kind of three layers to that, right? I think that there's going to need to be at the top a trust and governance layer, and that's not going to go away. That may look a bit different. You know, you could think about trust based on verifiability rather than authority purely, that kind of thing. I think in the middle layer we're going to see a tokenization piece, but also that coming together with AI, and particularly agentic AI. And then I think at the bottom, you're still going to need a really strong data layer. And the data piece, I think, is going to need to be rich and structured. And I think one crucial point, I think, about, if I then think about that sort of mental picture, if you like, I don't agree with people who say that we need to sort of start from scratch or tear everything down. I think we have many of these existing components, and we have many of the new components that are coming online, and I think the future's financial stack will be about combining those in the best way possible.
Yeah, if we wanted to do one sentence, right? No, I wanted to also say something nice about, say, Ethereum here, but I guess I'll keep it a little bit more conservative, because I agree with you as well. I think right now we're seeing a fragmentation of different layers emerging. I think it'll take time before we see convergence. I don't necessarily think we'll see just one layer emerge. I think there will be layers similar to how Swift came about that remain, say, credibly neutral, that people can interact with. That will, say, persist as, say, these larger, more credibly neutral layers. I think Ethereum, for instance, is a good example of a public layer that will coexist, perhaps with other ledgers and other layers that connect them. And I know that wasn't one sentence, but yeah, my takeaway generally is that I think that we will see convergence around some of the public chains and layers, and then we will see other layers that interconnect public permissioned environments, and that's, I think, how the future of the financial system will probably evolve over the next few years.
So I'm not going even to try to summarize it in one sentence, so I think I will also fail. So what helps me to think about like the future stack is actually the IMF asset model. Yeah? So it's very simple. So it just has like 4 layers. So it's a platform, it's the asset side, it's services, and it's access. And I mean, what we need to achieve in the end is to kind of consolidate and make it efficient at all 4 layers. And we also need also always to remember we are competing against something that is actually working in status quo, and that has been built for decades already. Yeah. And so there are a lot of puzzle pieces that need to be connected, but the first layer that you need to start is at the bottom, let's say, yeah, but you also need to continue going up. And the bottom layer is the platform. And the naked, let's say, the naked DLT, so to say. And if you look at the current state that we have in the market, so it's huge fragmentation. I mean, if it stays like this, then we can bury this and go back to that what we have, and then say, okay, it's efficient enough, so we will not top this goal. So the challenge is to manage it in a way, yeah, that these little small disconnected islands grow to larger islands. And not in a sense of I build a layer on top of it and then I try to create some sort of integration layer, because integrating a lot of fragmentation is, of course, very costly. So in the sense of growing larger islands and then integrate those and then create crystallization points for assets and then services and access follow. So.
Great. Yeah, so I heard a lot, a hybrid, right? A hybrid model, also many layers coexisting together. Okay, so Marius, let's start with the public blockchain perspective. Why should financial institutions trust public infrastructure like Ethereum for core financial markets?
They should trust public chains that can show that they are credibly neutral. They should trust public chains that can show that they're globally distributed, that there's no single owner. I think that's, say, some of the main reasons for why people should consider credibly neutral public blockchains in the first place. And so important for these public blockchains that exist is to, say, convey it to everyone and help everyone understand that these can be interacted with without no single counterparty being able to tamper with them or influence. It's a bit like when the internet came about, TCP/IP, that proliferated because it was credibly neutral, because it was open, because it was permissionless. I think we'll see the same for public blockchains generally. I think Ethereum has done a good job at living and adhering to some of those attributes. So I think that's going to be key going forward as well as fostering and protecting the security, the resilience, the credibility, neutrality that you need in order to operate, say, a fully permissionless public blockchain.
If it's from the institutional side, when banks tokenize assets today, are they actually comfortable with this public chain, or do they still prefer a controlled environment?
When we talk about regulated environment, there is like one universal homework that you cannot neglect, and this is namely risk management. And then if you have, let's say, a use case, and you need to do risk management in the context of this, let's say, use case in business. And then from this perspective, I would never kind of exclude like public permissionless or private permission, because it really depends on how you need to do this risk assessment. And if you now bring all properties that are required for a successful environment to thrive and scale, is like you need, it needs to be neutral, open, it needs to be utility, and it needs also to be compliant enough for the risk profile that you have for your use case. And for the first three, I would say public permissionless Ethereum is like the best example, like neutral, open, and not constraining or struggling innovation. So you see, like it's like an innovation jungle. So every day happens something new, but like in every jungle, you get eaten also easily. Like reading about, I don't know, 80 billions already being burnt or some bridges that do not work and things like this. And that's what I mean with the perspective of risk assessment. If you're just moving like $10 around, or if you have like a big risk appetite, like in the crypto space typically people have, then of course if you do your risk assessment and it will fit for the platform, you go for it. You have all the assets there, and that's it. But if you go back to the regulated environment, then this compliance optimized gets heavier. Because you need to do your risk assessment, and you need to know who's responsible for what, and it's totally okay to embed responsibilities into technology, right? But not everything can be embedded into technology, and for that rest, you need to know who's responsible for what. And even in public permissionless settings, you have governance. You have like people like Ethereum Foundation. You have code developers. You have the miners that decide if they're accepting something or not. And then we have also larger mining pools. So there is governance, but it is kind of grown bottom-up, merit-based, and is implicit. And it is the main thing, actually, I would say, that is keeping banks back. This implicit, merit-based, not really clear and not really written on paper. So what's actually happening there? And for this reason, the movement was started with permission blockchains and consortia chains, but they totally kind of constrained and struggled openness, neutrality, and utility perspective often also, And then it also did not work. And so what I think is the future for everyone to get more comfortable is to kind of always recall that it is about risk management and about risk appetites that you have for your use cases, and also public permissionless field to learn more how to support this risk management, and for permission field to learn more how to operate something as open, neutral, and as utility. Then, yeah. So I think that's currently, it's not fight like permission versus permissionless, so it's more like learning process that it is about risk management, and that you have different risk appetites and profiles, and that's still in a learning process, and I think we need a couple of more rounds to get this done.
Yeah, it's good that you mentioned the difficulty in have this to scale. Perhaps you can turn to you, Ton, from the technology side. Are current infrastructures ready for large-scale tokenized finance, or we're still missing any key component?
I think they will be getting better and better, right? So where we are today is the worst that it will be, but I agree with Ivica. There are different use cases that have different risk profiles and also different requirements. If we look at running global payments on a ledger, including account-to-account payments to be more independent from cards and all of the things that we heard about earlier, we need millions of TPS on a blockchain, not hundreds, right? If you want to do settlement, wholesale on a blockchain, you don't necessarily want a meme coin frenzy to freeze you for 12 hours and then for the transaction fee to go up 40 times, right? So the blockchains will be getting better, but I think there are very different use cases and very different choices that institutions, businesses, individuals, investors will be making which rail they transact on and how.
Nick, SWIFT's connected, trusted institutions globally. How do you view the public blockchain? So are they complementary infrastructure, or do you think they introduce any kind of risks to the financial market?
Well, maybe in answering that, I want to say, I pick up the point that Tom just made, because it's really important, right? There are many people in this room who run existing scaled infrastructures resiliently today, and we do that because we have to meet the expectations of our clients and of our customers, right? And those expectations, they don't just go away because we have another, funky new blockchain created, right? So we need to be able to ensure that whatever we deploy kind of continues to meet those needs and those requirements, and that has to be fundamental. I think, and I think Ivica made this point well. I think I'm sort of now at the point where I think we should sort of kind of reject this dichotomy that we've teed up between purely public and purely private. I think we need to get over that kind of thing, and we need to actually think about what roles do these different pieces of like technology and infrastructures created play in this new financial stack. And I think, it's about getting now blockchains ready for institutional adoption. I think, the communities like Ethereum and the EVM ecosystem have done a really good job at building, a base of developers and which is well supported, and that gives a critical mass there in terms of a core technology, almost as the allusion to the internet here. But in order for that institutional adoption to happen, we then also need to build on the features that institutions expect. And just to take one example of that, the blockchain world tends to talk sort of sometimes a bit esoterically about privacy. But as I talk to global institutions, when they mean a specific thing when they talk about privacy, they basically mean, I don't want anybody in the transaction that's not in the transaction to see the details of that transaction. It's a very straightforward thing that they want. And so that's the kind of thing that we need to be able to deliver if we're going to implement blockchain at a scale for global payments. On the other hand, they really like the idea that we can see the state and we can see that the record has been there and immutable. So there is work to be done, and I think it is happening to bring that kind of level of privacy combined with the benefits of the the blockchain infrastructure and communities that's already been created.
If it's you mentioned earlier the Siemens bond, and we hear a lot about tokenization transforming capital markets. So what actually happening in practice today, and where are we still in pilot mode? So maybe you can give us some practical examples.
Yeah. So as I said in the beginning, so a lot of puzzle pieces to connect. Yeah. So and if we kind of look back and we see like we climbed Mount Everest, but then if you look up, then you see another Mount Everest you need to climb up. Yeah. And if I would need kind of to enumerate all these items, then I would say like primary market issuance works. Yeah. So this is okay. Now what is incoming and what is work in progress is secondary market, DLT pilot regime. So there is a lot of movement and payments of different kinds. Yeah. So I'm also not kind of when people say is stablecoin better than central bank money or tokenized deposit, I actually do not care about these discussions because you need these are different trade-off constellations for different use cases, and you need all of them. And we also always try to stay open also on this. But we need some sort of payment. And then, of course, all these things that I mentioned about infrastructure itself. And the last thing is also not to forget, we have financial instruments on DLT, but they still feel like second-class citizen, yeah, even if they have the same properties. Yeah? If we just think about eligibility criteria for giving this somewhere as collateral, for instance, at ECB, right? So you fail right now. And I think we need to get this right. Like the platforms need to grow to larger islands. Governance needs to be clear. Risk management needs to be clear on these platforms. Payments need to work. Secondary markets still need to work. And eligibility criteria, so digital assets becoming first-class citizen, it also needs to work. And we are now like since a decade and more on the way. And I think 5 more years, then maybe we're there. And if you compare, for instance, how long it took to introduce Target 2 or Target 2 securities, it was like decades. And if you think how long SWIFT also took from 70s to become like the standard for interbank message transfer, so it took also decades. Yeah? So we still have some work actually to do to be able to compete against status quo. Yeah.
Okay, so it feels like we are building multiple financial systems in parallel. So blockchain, we have the bank systems, the tokenization platforms, and the real challenge might be connecting them. So perhaps to you, Marius, from a public blockchain perspective, should interoperability be built into protocols or handled by the institutions? So how do you see this interoperability going forward?
Very good question. I think there's a few different answers to that, depending on who you speak with. Maybe one short comment before answering that, and just as a side note and a shameless plug, because you mentioned privacy, we do have our privacy team here today, an institutional privacy task force. Just to say that I think also acknowledge that this is a very important topic generally. So at 3 p.m. we're hosting a workshop on this actually outside for anyone that's interested. And I think for interoperability, I think that's still fairly nascent, I would say. There's a lot of exploration both on the protocol level, but I think also among service providers. There are different layers that are emerging now, exploring what will be the prevailing standard, if any. And so I think it's a bit early to say exactly what will prevail. I would say there's a lot of exploration, both on the blockchains themselves, but also say middle layers emerging, basically connecting everything. And yeah, we'll see how that plays out. I think there's exploration that needs to happen on both, and it's probably likely going to be a convergence where chains need to meet, say, service providers, infrastructure layers, etc. I don't necessarily think it has to be only, say, the institutional players that come and build out those standards.
Nick, do you want to comment on this interoperability layer across all these networks?
Yeah, I mean, look, it will be no surprise that I'm going to say interoperability is fundamental, right, to achieve here, and especially if we want this new financial system to, to deliver benefits over and above we have in the existing financial system, where maybe when national payment systems were built, they then thought about interoperability afterwards, and I think we should recognise that we have the opportunity now to think about it at this relatively earlier stage and come up with better answers, right? So I do think it's really important. I think we should be looking to try and achieve native interoperability between, between chains, between infrastructures. I think that should be based on standards. There would be no surprise that Swift would say it should be about standards, right? But to be very clear, we're not going to be the ones who necessarily create all the standards. I think that would be wrong. I think what we need to do is actually have a collective effort where we bring together a lot of these parties and take on a number of pieces of important work that have done already. So, for example, we worked with ICMA, for example, to translate the bond data taxonomy into a use for tokenized digital bonds, right? And I think that's the kind of work where we can bring those things together. I think the other comment would be on this interoperability. There's a sort of technical aspect to the interoperability which we definitely need to solve for. There's also the piece about, if interoperability goes wrong, and we've seen it with hacks on bridges, right? Who is responsible, right? And we need to establish that. That's, I think, is to your point on risk management, Ivica, right? We need to ensure that the responsibility is clear on that, and that through governance, through things like rule books, these are kind of like the not exciting things that are very fundamental to the functioning of a financial system. And we need to kind of figure those out too, because I think you're still going to need to be able to have an established trust and governance mechanism around that.
Tom, how is your perspective? So you think the interoperability is a technical problem or it's more an institutional one?
I very much agree with what was said already. It's both, right? So if you look at somebody sends a stable coin and they want to move it to a different chain and make it a tokenized deposit, right? It's not just the technology that locks it up or destroys it on one chain and creates it on another one. It's also a business behind it, right? The reserve from the stable coin provider is going to move to the bank that now has the liability of the tokenized deposit. Same thing for assets and everything else. I think there's an exciting business opportunity in this. There will be key players that are going to be providing this interoperability between major networks. So for financial services providers, for intermediaries, this is a great opportunity. From a technology perspective, what we're focusing on is making it super easy for our partners to integrate with these technologies, and then make it super easy, reliable, and trustworthy to build the bridging technology itself, to make sure that everything can happen in a transparent yet very, very secure way. I also plug the privacy work that we're driving. We have a lot of researchers that are like key in areas like homomorphic encryption, areas like zero knowledge proofs, and so on and so on. So we're like very much agree with what Nick said about transaction privacy. This needs to be very much part of the discussion and part of the design.
Okay, so are we moving toward one connected system? Or...
I think we've got to avoid fragmentation through this. Obviously, innovation inevitably creates fragmentation, but actually we need to converge this towards a more unified kind of system, acknowledging that the future will probably be multi-asset, multi-rail, multi-chain, right? But I do think it's got to be a system that is more integrated and that works together more seamlessly. We're playing our part in this, so we're bringing the benefits of blockchain onto the Swift network with a blockchain-based ledger that we're collaborating with 40 institutions from across the world to implement. So we're definitely kind of trying to play our part in this. But everything that Swift does is inherently collaborative, right? And so we're a big believer in the financial community moving together.
So if I
sure
may add to it. So about interoperability, I mean, it is easier to do interoperability if you have larger islands. If you have a lot of fragmented islands, yeah, then it's of course difficult. So that's the first thing. And even if you have just few, let's say, larger islands, it's still a challenge. I mean, I spent a decade in a bank working in integrating banking systems within one single entity, and then you end up with 3 to 5 different platforms and 10 different flavors how people want to integrate and which requirements they have. So it will remain messy. So there should be no illusion, I would say. But to repeat one more time, so it's crucial actually to reduce the number of islands that we want to integrate. And about the standards always, follow the volume. Yeah? So those guys that have proven that they can create volume, create gravitas, and gravitas leads to a standard. Yeah? So that's the way how it works. Yeah?
Okay, so we are agreeing that we are moving to a more connected system. So Nick just mentioned some things which Swift is doing. And in this case, who is responsible for making this happen? Maybe Marius and Ton want to...
Yeah, I can kick us off. I think it was mentioned already, but it is a collaborative effort. I think both protocols, public chains, users of those protocols, and anyone that interacts with the technology generally needs to conform around certain standards, be that for the ledgers themselves, for the assets, or how you interact with them from an access layer perspective. So that needs to happen. Otherwise, I would say, why would we be here? We're kind of in the process of redoing the financial plumbing and infrastructure, and we have a great technology available to us. It would be a shame if we end up with, a similar fragmented banking system. So I think the aspiration to work towards something that is more interconnected, more efficient, should be shared by, say, all industry participants. Yeah.
I think I largely agree. We said earlier, or Ivica said that the ecosystem, some of them will have more gravitas, more gravity, and so on. I think this will come mainly from the value that the ecosystem starts to generate for the founding users, or the users that start transacting, right? And the higher the value, the easier it is to integrate more capabilities in terms of settlement, in terms of AI, in terms of everything else. The bigger that ecosystem will grow. For the standards to emerge, it's really, really important that they're credibly neutral and that the technology just works underneath, right? So that people don't have to worry about them. And so I think this is the way that things will develop. The ecosystems will grow commensurate with the value that they're creating for the joining members, or the members who are already on the network. And then the bigger ones will have obviously more say in defining the rules and the standards for the broader group.
Great. Okay, so let's zoom out a little bit. If you look 10 years ahead, I know that everybody is agreeing here. So perhaps what will disappear or becomes irrelevant?
Manual reconciliations and long settlement times. I think we've got to get rid of all of those friction points, right? That's the kind of benefits that the end customers, end clients want to see. I hope we will also get rid of the genuine, and try to express this in the right way, but I hope we also get rid of the buzz around AI, because I think AI will become actually core to this, because this isn't only a discussion about chains, there's a discussion about all of these kind of technologies being combined, and I get excited about the idea that the programmability that you get from tokenization could then work with AI agents actually intelligently managing them. That's where I think you start to see real excitement.
I very much agree with that. So blockchain gives us capital efficiency, right? You can move money and assets around the world very, very flexibly. The amount of working capital that you need goes down. Your clients are much more happy with the level of payment and settlement services that they're getting. So capital efficiency through blockchain is clear. But I think there's an entire kind of process redesign that's going to come as a result of AI. You look at marketing companies, they used to pitch an account, win the account, and then they used to do work, and then they would sell or propose a campaign for the account. With AI, they no longer have to do that, right? They can just build a campaign in an hour and they can go sell that campaign. This is going to be similar for finance. If your agency's public filings, they see internal bank data, they see Bloomberg feeds, and they see the stock of portfolios, positions, assets you have on ledger, very easy to make tailored hedging strategies to optimize the flow of capital and so on and so on. So we're seeing this already with some partners that we're working with, and this is going to be a thing that completely unlocks operational efficiency, and where finance processes might even have to be redesigned because things that were not possible because of friction and costs and so on suddenly become possible. So that's where I think this is going. There will be a lot more robots paying robots with all the things that we talked about earlier, things like verifiable proof of delegation, things like payments that they need to be able to execute autonomously. This may even increase the size or number of transactions that we're seeing by multiple folds. So this is going to be one area, and the other area where it's going to be quite significant is how do the processes actually change when a lot more is possible a lot faster.
Maybe I go on. So maybe turning the other way around. So what will not disappear? And I would say roles and responsibilities will never disappear. So no matter what you do technologically, you just kind of shift them around and you embed maybe few of them into technology, and then people forget it because it's under the hood. But roles and responsibilities, they never disappear. So they're always there. And but what I'm expecting to happen is that the platform layer itself is going to become some sort of commodity or utility in a wider sense, because people will recognize that it is not contributing to competitive differentiation anymore. So it's like for the benefit of all, and then competition happens on the layers up above, on asset layer and service layer and access layer maybe.
Yeah, I'll conclude by saying that I think it's from an infrastructure perspective as well, and now talking about blockchains, I think it's important that we protect, let's say, the credible neutrality of some public chains, so that they remain available to everyone, and so that they can truly act as global financial settlement layers. In 10 years from now, I hope that you don't have to think too much about it. I think hopefully a lot of that will be abstracted away, so that what the end customer sees in the end is just an interface, and then all the plumbing or the complexity happens in the back end, and you don't necessarily care anymore if you're operating on, say, traditional financial rails, or you're on a blockchain, or a combination of both, and what that looks like. So that's the 10-year vision, but it'll take a while to get there. Yeah.
Great, we are right on time. We heard different views, and it's clear that the future of financial stack won't be built by one player alone. We heard a lot about collaboration. Thank you so much for the great discussion, and also thank you for the audience. Enjoy the rest of the conference.
Yes, thank you very much, Tamara, and thank you to all of the panelists. I think this was the first time in my many years of seeing this conference evolve, and also the precursor of it, that someone asked what will disappear in 10 years, and you could see the visible surprise of the panelists as well. Fantastic moment. Thank you for that. I will remember that. All right, we are now, for everyone on site, taking a lunch break. But of course, also you on the streams, you can get something to eat, walk around, get some fresh air, stretch, and make sure to be back at 1:50. A big shout out to our sponsors, which you can see here behind me, who also make this lunch break much, much nicer. And see you then. My name is Marcel Kaiser, and Have a good lunch break. Bye. Hi. Is my mic on? All right, perfect. Welcome back, everyone. I hope you had a wonderful lunch break and your head is fresh and ready for our next keynote speaker. I'm already joined by Mark Rakmilovic and from Oracle, and he is giving a talk on aligning bank strategy and technical execution for tokenized money. He is Group Vice President, Product Management and Development of Digital Assets, and he'll introduce himself in a second, I believe. Mark, with that, I hand over the stage to you. Enjoy.
Thank you.
And give him a warm round of applause so that everyone outside knows we are live. Thank you.
Thanks very much. It's a tough spot right after lunch. I'm sure there are still, folks outside there, but we'll get started. So I'm happy to be here. Really thrilled to participate in the Digital Euro Conference. Thanks for inviting us. Oracle has been a core part of the financial ecosystem, a technology provided to many banks over the last few decades. For example, 24, 25 of, I think, out of 30 globally significant financial institutions are using Oracle technology in various forms, and probably multiple hundreds of banks around the world. We have been involved in blockchain and DLT technology as well for about the last 8 years. We have started with enterprise blockchain, first released in 2018 based on Hyperledger technology stack, and then evolved that to support digital assets more recently for the last 3 or 4 years. And I will share some of the learning, some of the insights that we had in working with central banks and commercial banks in this area, and a number of discussions about the challenges that they see in sort of coming up with the right strategy in this fragmented world of multiple forms of digital money, and how they can actually develop and deploy technical solutions that help them evolve across this kind of broad landscape. So, the landscape, of course, includes things like cryptocurrencies going back 10 years, and a number of banks are actually providing cryptocurrency custody services to their customers, which is a great, revenue source for some of them. More recently, we have seen tokenized deposits, tokenized securities, stablecoins, and in the central bank context, we've seen also CBDCs. We've been involved in some projects. One of the more visible ones has been in the Philippines last year, and a number of commercial tokenized deposit activities with some banks as well. All of those forms of money are generating interest, and for some banks, they have to decide which direction to go. Some may be providing cryptocurrency custody today and looking to move into issuance of stablecoins. Others are considering accepting stablecoins but not issuing their own. Others are still partnering around this space. For example, in Europe, 10, now 11 banks, I believe, have gotten together with this joint venture called Qivalis under sort of auspices of the Netherlands, trying to come up with a European stablecoin consortium, obviously, to counteract what's been happening lately in US with the Genius Act and sort of the upcoming avalanche, we think, of US stablecoins. At the same time, we see projects around tokenized deposits. Here in Germany, for example, a very visible one is commercial bank money token, CBMT, with DZ Bank, Commerzbank, UniCredit, Deutsche Bank, and a couple others maybe joining as well. We're actually participating in this phase 2 pilot rollout. Yesterday I was in London talking to some folks about the Great Britain or UK tokenized deposit project as well. So this is a multi-bank environment where multiple banks getting together to do essentially either shared or exchangeable tokenized deposit, on one-to-one basis across a consortium of banks. There is certainly multiple benefits. I'm sure people in this audience are familiar with many of them. The 24/7 capabilities around payments and settlements, atomic trades, being able to do instant settlement without manual reconciliation, automation of various manual processes that can help avoid or reduce errors, real-time continuous asset valuation for previously illiquid assets, typical in real world assets, RWAs. Reduce costs and time for cross-border payments has been a significant driver as well. So Many of those benefits are visible, but the question is, how do the banks actually deploy solutions beyond pilots into production environment to make them real? Because of the fragmentation of digital money, many banks are actually quite concerned about the loss of their sort of deposit and credit franchise, right? Banks mainly are in the business, commercial banks at least, to take deposits and based on fractional reserve system, turns them into loans, credit. Now, if the customers are going to, instead of those deposits, want to get stable coins, that requires one-to-one reserve. So a $100 reserve or bond, let's say, if it's treasury bond or whatever, allows them to issue $100 in stable coin as opposed to $700 or $800 in loans compared to tokenized deposits. So we see banks interested in moving with tokenized deposits because of this, right? It preserves the credit-making capability, but they do need to figure out how to move it from pilot stage to a production stage for those that have already been involved. And those that have not, right, how to actually create systems that support the stringent compliance, operational requirements, and the capabilities that will pass muster with regulators. As a payment instrument, tokenized deposits generally accepted by regulators as nothing significantly different from existing deposit structures. So in Germany with CBMT, for example, BaFin has essentially approved that as equivalent to existing cash deposits. It's only being recorded in a different manner, but that's just a matter of technical infrastructures that regulators are not particular about. But in order to do this, the banks have to figure out how to comply with all of the existing regulations. Regulations, KYC, know your customer, know your transaction, know your business, and many other things, sanction screening, AML, all of that, when it comes to implementing tokenized deposits. The opportunities are certainly significant there, right? They can deliver smarter financial products, faster payments, they can extend the regulated liquidity into this sort of a digital ecosystem world for their customers. But the question then becomes, should they go ahead with tokenized deposits or stable coins as well? The key difference, of course, is stable coins require one-to-one reserve. So you need to have a segregated reserve account capability versus a regular deposit DDA account against which you issue or mint the tokens. Then when you transfer them, the tokenized deposit cannot be transferred to somebody who is not a customer of the bank. So in the case of CBMT implementation, for example, different banks issue their own deposits as colored tokens. And then there is a conversion that happens, let's say, between one bank A and bank B token, so that bank B customer, when they receive a payment in a tokenized deposit form, actually holds bank B tokens that have been converted from payments that come in bank A token. Whereas with stable coins, you have full portability, right? And that's the biggest benefit of that. And then on the redemption side, of course, you have to deal differently with the reserves. The way that you settle those reserves with stablecoin, you basically have ability to reduce the reserve requirement one-to-one. Whereas if you're redeeming tokenized deposits, and in some cases, tokenized deposits can be redeemed transparently to the customer back to fiat, you simply have a credit back into the DDA account. Now, we think that for many universal banks, starting with tokenized deposits makes sense, both because the regulatory requirements are much simpler, it's a more controlled and more forgiving environment technically, and you can achieve significant benefits already in terms of atomic settlement, 24/7 liquidity optimization, automating treasury processes, and you can also leverage it as a strategic defense against your customers that are looking for some of the benefits of stablecoins in terms of faster payments, cross-border, and things like that. But there are limitations. On the other hand, with stablecoin and the upcoming avalanche, the banks have to make some decisions about what role do they want to play in the ecosystem. Do they want to be an issuer? And that means investing in the infrastructure and all of the regulatory approvals involved around that. Of course, it offers maximum control over their brand and maximum benefits. But many banks are not ready to take that step, so they are looking to partner with other banks, maybe like, as an example, we have with 11 banks that are partnering on Qualis. Or in some cases, they simply want to accept and integrate stablecoins for their customers, for their corporate customers who get paid in stablecoins, but they don't want to actually deal with the issuance side of it. Now, with tokenized deposits, there is an issue of fragmentation as well. So individual bank issuing tokenized deposit is going to be essentially working with their own customers. And if that customer needs to make a payment to somebody else who banks with a different bank, that tokenized deposit is not going to work because obviously, the KYC rules will prevent that. This drives the need for what we've seen as a multi-bank models for tokenized deposits. I mentioned CBMT, UK tokenized sterling projects. There's a few others as well. We're participating actually with the CBMT banks in Germany in providing the underlying ledger capabilities. The goal there is to make it interoperable across multiple ledgers and to bring the token actually to whatever ledgers corporate customers, industrial companies are actually using to transact their business, particularly from supply chain perspective, right? So if a company has a significant investment in a particular blockchain for supply chains, they want the money to come to them. They don't want to have to deal with a separate ledger and integrating payments from the bank ledgers. They want the money to be there. And CBMT promise is that that can happen because of interoperability based on those tokens. However, even if CBMT project expands, as there are some discussions into other countries within the EU and Euro world, there are still significant limits in terms of foreign exchange regulations, the jurisdiction requirements and limits of and so on. So we are going to see, I think, the emergence of a dual rail ecosystem with permissioned rails for tokenized deposits being broadly accepted in the next few years, and then public rails, of course, being used for the regulated stablecoins in the retail, cross-border, and kind of Web3 commerce. The value proposition we think that going to really matter for the banks is liquidity orchestration across all of those. So that it's not just enough to be able to provide the instruments and transact them, but the banks that are going to win are those that are going to do the best at providing capabilities to orchestrate how money moves between these different rails, providing optimization based on various factors, and managing that liquidity transformation in a manner that's most transparent and optimized for the corporate customers at least, and maybe even individual retail customers. Programmable settlement as a service is going to be important, and then compliance as a service. Obviously, there is a new world of compliance coming, and providing a lot of those capabilities. We already see, for example, travel rule kind of things, requirements have to be extended. There is other things in terms of jurisdictional requirements, limits, sanction screening, etc. Providing that as a service on top of the blockchain rails, I think is going to be things that banks can monetize and make some additional revenue from. Now the question then becomes is what is the required technical capabilities for the phase one? In order to protect the core with tokenized deposits, of course you're going to need to have the underlying ledger capability, high availability, and resilience of that ledger. You're going to need to have access control, segregated capabilities around different roles. Banks don't want to have people who administer the system, administer the user accounts, administer and conduct the financial transactions all within the same roles, right? So detailed segregation of those roles, granular role-based access control, and ability to support then enforcement of that through the smart contract, ability to support approvals, what's called make a checker or 4ICE kind of approval requirements with attestations on the ledger are going to be really important. Core banking integrations, one of the things that has been really a big challenge for many banks is to try to integrate their blockchain infrastructure, those that have invested into it, and some banks have done a lot. A few of the larger banks in particular come to mind. But the challenge that they face, from what we understand, is integrating with existing infrastructure inside the banks, the core banking system, KYC, all of the sanctions required checking, and many others. In the case of one bank, I think they told us there were like 40 different internal systems they had to integrate with, and that's been really painful. The banks also, those that have tried to play in the space, have also seen some regulatory action, and there have been some fines imposed on some of the larger banks, which is not pleasant, because of the gaps between those systems opens the door to various concerns from regulators. We think deploying a solution based on permission ledger for tokenized deposits is also going to build the confidence within the bank to be able to then move forward with broader capabilities over time, right? But it gives you a sense of how tokenized money works, what kind of integrations need to be in place, how you operate, monitor, report, and so on in that environment. So it's an initial stepping stone that I think is going to have far-reaching implications. The second phase then is to look at a controlled stablecoin expansion. But the stablecoin expansion requires dealing with public chains. In a public chain environment, you have very adversarial situations, right? You have people that are going to try to break the rules. And you're going to need to provide, both from a technology perspective and operational perspective, a lot stronger capabilities. Geographic redundancy across highly available node infrastructure, much stronger key management using multi-party computation or sharded keys, as well as HSMs. They are no longer an option, they are mandatory in that kind of environment because, let's face it, in a permission chain, you always have a legal recourse. You know who the participants are, you have agreements with the participants. If something goes wrong, you can negotiate, you can take legal actions, etc. In a permissionless or public chain world, there is no legal recourse in most cases. And so you're going to have to depend on the technology to protect you. You're going to need to have stronger capabilities to protect against market abuse and financial crime, reporting capabilities, and so on. Continuous monitoring, particularly if your token is going to be issued across multiple chains, liquidity monitoring, redemption requirements, and the rate of exchange. And so all of those things are going to be much more stringent, require more technology. Now, with things, there is a conservative approach to stablecoin issuance, which is based on a hybrid model, where you can protect yourself against some of the risks by issuing the stablecoin initially on a permissioned ledger that gives you more control, more auditability, more ability to prove to regulators that everything's been done in a proper way, and maintaining kind of books and records in a permissioned environment, and then creating a ROP token for distribution on a public chain. And so this is going to basically create a representational model on a public chain of a token that was initiated on a permission chain. That gives you the benefits of preserving sort of more controlled environment for minting, for burning tokens. And it preserves some options where once you have an instrument that you can issue in a permission chain, you can decide when and how broadly to start distributing it using public chains and using roping. So, this is fairly straightforward. We know from cryptocurrency world, how roping world, you can essentially mint a token, you go through all of the approvals, all of the attestations, you can then lock it and remint it on another chain. On the permission chain, it remains locked in the vault, so it cannot be transacted or touched in any way. It can then go through various lifecycle stages as a ROP token on a public chain, and then when it's redeemed, it goes back and unlocked in the vault in a permission chain where you can then burn it and so on. You need to have some infrastructure in place for that. And we've worked with some banks that have tried to build this infrastructure. We know that it's going to take a long time. If they try to do it from scratch, there are significant development costs. Some people have spent billions of dollars. There are significant interoperability challenges because this world changes rapidly, literally on a monthly basis. There is new interoperability functionality that becomes available. Some of it's valid, some of it's not. And then, of course, you have to deal with all of the risks measures. You have to address confidentiality requirements. Obviously, financial privacy is very important, and public chains are not really set up for that. And, of course, the compliance requirements as well. Oracle has been working in this space for some time with unified digital asset infrastructure capabilities that we've been providing on the permission side and now bridging that into the public chains as well with the unified governance platform that essentially provides enterprise hardening for the open source technologies underneath, and at the same time creates institutional wrappers in the form of smart contract frameworks that implement various regulatory requirements and supervisory requirements in this world. That helps to provide faster time to market, obviously, so instead of spending years building something, you can stand it up in a matter of a few months and launch products and services based on those tokens, lower costs and risk, and improved operational discipline compared to this fragment integration sprawl that some banks have had to deal with when they put together solutions from 5, 10, 15 different companies that provide specific point solutions, but not a unified platform. In the integration sprawl, you have to work as your own sort of system integrator, and a lot of things happen in those gaps that create risks and opportunities for breaches and so on. So our solution is focused on providing the core platform with multi-ledger capabilities, with Hyperledger Fabric and Besu, which is an enterprise Ethereum, with a compliance-focused smart contract framework, plus a reference token implementation for many forms of digital assets, from tokenized deposits, stablecoins, central bank digital currencies, bonds, and many others. Rich integration layer with API and eventing framework, and workflow-based orchestration. We provide universal wallet service that supports wallets on both a permission chain, but also with additional partitions for public chains. So you could have all of the assets and all of the different types of tokens managed within the same kind of overall universal wallet. And we've also been very diligently trying to follow the Bank Financial Settlements Unified Ledger principles in terms of interoperability, cross-ledger transactions that are atomic in nature. There is integration and acceleration capabilities in that space, including the workflows that I mentioned, streaming the data into Oracle database for post-processing, creating what we call rich histories that allows you to run anomaly detection, real-time supervision, regulatory reporting, and many other things, resilient transaction and workflow coordination as well. And then, at the database side, providing capabilities, leveraging GenAI, agentic AI capabilities to enforce the supervisory requirements, and then feed that back through the smart contract APIs into a closed loop environment where you can take actions on those. I'm going to pause here. I'm running short on time, but just maybe to go to the summary slide here. Actually, I just wanted to mention that we recently published an article in the DMI journal. There's also a lot of information on our blog, blogs.oracle.com/blockchain, where you can follow this up. And just in summary, we think that the bank should no longer wait for emergence of global standards. The time is now to start moving forward and launch pilots with tokenized deposit programs, particularly with some anchor corporate clients. Building interoperability is very important at the consortium level if you're participating with multiple organizations, in order to regain this orchestration capability, orchestration authority, literally, over digital money in all forms. And this is sort of the recipe for banks continuing to anchor digital money within the regulated ecosystem, as opposed to letting it escape into the unmanaged fintech world.
Thank you, Mark. Thank you, Mark. Yeah, I think as tokenized money moves from concept to implementation, a practical yet strategic and well-reasoned perspective like that from Mark is invaluable. Thank you a lot. And we also remain in the world of tokenization and have our first panel on the topic. And I'm already joined by Lena Grale. She is board member of the Digital Euro Association, and she will be joined by a great set of panelists, and it will be about tokenized money. Lena, I hand over to you. Enjoy.
Thank you so much for the warm introduction. So I'd like to ask my panel to join me on stage. Mark, you can come back down. We have Manuel Klein from Deutsche Bank, Heiko Nix from Siemens, and Metar Said from JP Morgan. Hi. Yeah, why don't you sit together? Yeah. I hope we're not going to bite each other. Are you all equipped with microphones? Maybe
we can share.
Maybe you need to share a bit. Perfect. So thank you so much for joining me. The topic of our panel is tokenized markets need tokenized money. Europe's roadmap from pilots to production. So we've already heard a bit about pilots from Mark. Thank you for your keynote. This is the 4th Digital Euro Conference. I'm listening to panels, and every year, I hear a lot about pilots. Every now and then, new pilots are announced, but today we want to talk about how to actually get out of the pilot phase and start properly into the production phase. Mark, I think your keynote has highlighted that there is a bit of a shift. We are definitely ending the experimental phase of things, but there are definitely still hurdles, still technical issues, operational issues, still islands going on, and still a lot of pilots. So that's what we want to discuss today. I'm really happy that I have such a diverse panel here, industry, banks, infrastructure. I'd like to ask each and one of you to introduce themselves for maybe just 2 minutes, if possible. And if you don't mind, please talk a bit about your focus in the tokenization world.
I can go first. Nice to see you all. I'm Metaj. I'm part of the Kinexys business at JP Morgan. I lead the Europe, Middle East, and Africa business. Me and my team are focused on adoption of our solutions. So our job is to face the industry every single day and answer questions on why this technology, what benefit this brings in, and what the business case looks like, etc. So very, very focused on definitely not being in the pilot phase. We've been fortunate to be an early adopter in this space, and we've definitely scaled way ahead of pilots. But key focus is to make sure that the industry is aware of this technology and the benefits it brings with it.
Hey everybody, I'm Mark Rakmilovich. If you weren't here for the keynote, I run a team at Oracle responsible for digital assets and blockchain from product development, product management perspective. We've been involved in the space since 2016-17, launched our first blockchain solution in 2018. And in more recent years, been involved in digital assets, in particular the central bank digital currency projects and some commercial banks, tokenized deposits, and so on. So I think from an integration perspective, we'll get into that later, but there's a lot of things we've seen that I'm glad to share.
Yeah, pleasure to see the room so full. I'm Manuel Klein from Deutsche Bank. So I had a team which we call market management for payments and digital currencies, with a focus on cross-border payment innovation that stems across traditional systems in the traditional world, with SWIFT innovating as well. But then everything related to digital currencies as well. All 4 forms of digital money, so retail and wholesale central bank digital currency, where the digital euro falls in, and then tokenized deposits and stablecoin as well. Nice to meet you.
Nice to meet you too all. Thanks for coming. Heiko Nix from Siemens, head of cash management and payments. So we are doing with the team everything incoming, outgoing cash and payments. So for us, it's important to lead this discussion as a technology company. We started quite early, I have to say, with Connexus, that time Onyx, by the way. So we have a little bit of experience with this, and it also comes from our nature. I'm actually coming from the IT side, and when I joined Treasury 6 years ago, I felt a little bit like an alien, right? Because this is really unknown. In the moment, I have to see more and more people with an IT background in Treasury. So that's why when we started it also, we had a lot of discussions, so why we are doing this, and we just did it because we could do it. So let's discuss this in more detail.
Thank you so much. That's a good start. So before we start with the first round of questions, I'd just like to remind the audience that you can ask questions to the panelists, either to one specific one of them or to the group of panelists. You can do so via the conference app, Swapcard, so feel free to ask questions and I'll try to direct them to the panelists. So let's start off with a bit of a reality check. Where do we stand right now? Heiko, I'd like to ask you first. Siemens has been a pioneer in tokenization. And the overarching question of this panel is from roadmap to production. Where do you still see the biggest friction points in this?
I would say 2 friction points. Number 1 is not a technical one. It is, I think, mindset. Yeah, mindset shift. I think the idea of what blockchain brings and tokenization is part of it is a little bit, the ideas behind. So tokenization, programmability, 24/7, all these features, they are new to Treasury. And that's why mindset shift is important to use it, to leverage this technology in Treasury, because I would say in Treasury we are not really used to working in that space. The second is really, and this is for me the biggest one, is reach. Whenever I do a payment, it's something between 2 counterparties. So when I join a stablecoin environment or any environment where I can make payments, it is important for me to find my counterparty in it, be it my vendor, employees, or I'm getting charged or can charge a customer. So that's why these 2, I would say, number 1 is the reach topic, and I still see there's a lot of fragmentation. And actually what we wanted to overcome with this blockchain technology and stablecoins and all this is going away from fragmentation, which we have in the banking sector today. But what we're actually doing, what I'm seeing is with every new stablecoin, we do exactly the same. We are just copying, that fragmentation into the 24/7 world.
Yeah, that's a really interesting perspective already. Mark, would you agree to that, or do you see similar hurdles or maybe different hurdles on this roadway to production?
Yeah, no, certainly I agree with, particularly as a user mindset. When we talk to folks in the banks in particular, and sometimes also in the corporate level treasurers and so on, they're still struggling to get their mind around some of the fundamental concepts and differences here. And one of the things we're trying to do from that side is to try to make it as transparent and straightforward. So one of the things we've been working on with our ERP team, when we integrate this solution, you want to do account payable, kind of payment, right? You go into your ERP system, you find some invoices that need to be processed, you go through, they get approved, verified, and then you go select whatever, payment, whatever bank, whatever currency you want. And we want the blockchain payment to be basically indistinguishable as much as possible. Maybe it's a different currency symbol, maybe there is some setup information onboarding that happened ahead of time, it's a little bit different. But the way that you actually execute payment on that invoice is as transparent, as compatible to the current fiat payment, if you will, on B2B side as possible. So that's one area. The other area, I would say from an implementation perspective, where we see significant challenges are in the integration space again. So the blockchain, particularly for permission blockchain implementation, if it's, let's say, tokenized deposits or central bank digital currency, also typically on the permission chain, the blockchain ledger infrastructure and all of the things that need to happen there are pretty mature. But payment does not happen just in blockchain, right? There is workflow, on-chain, off-chain, workflow orchestration, the KYC checking, the sanction screening, when you're issuing and doing an on-ramp, onboarding somebody. All of those things need to be checked against existing systems. And that integration is a lot of work. The frameworks around integration are fairly brittle. You don't want to do point-to-point APIs if you can avoid it, because you have to change them every week. So having a kind of a API infrastructure, but then being able to integrate using workflow orchestration is important. Ability to do atomic integration between off-chain and on-chain systems is critical, right? Because you don't want things happening and creating exceptions on one side and then causing problems because you have to then manually reconcile on the other side. I mean, that's no fun. We've been there before. We know how hard manual reconciliation could be. So we want to avoid it by ensuring atomic settlement, atomic connectivity, transaction support between off-chain and on-chain systems. That's very critical. And the third point, I think, is around implementation of supervisory controls. Where you see payments being done on blockchain today, they're using fairly simple-minded versions of the ERC standards implementations. Yes, I can do a token transfer from A to B, but what about multi-layer approvals? What about limits, holding limits, transaction limits? What about many other things that from a regulatory perspective, banks need to ensure there? What about administrative clawback if something went wrong? So adding those supervisory controls and being able to do them in an automated fashion within the smart contract framework is another area that I think is significant, and that's what we've been investing in.
Thank you. Manuel, I've been seeing you nodding a bit, especially on the part with the supervisory controls. I think that's an interesting one. Like, is Deutsche Bank worried about not being able to check limits, or what else did you talk about, like regulatory issues, when moving more towards tokenization? Is that an issue?
I mean, as you say, the integration into core banking systems is a big area of focus for most banks, I would say, that now also aim to integrate any tokenized deposit solution, for example, or also stablecoin for real transfers. I would like to step back a bit on what it is that we are actually talking about, right? So tokenized deposit platforms, we heard it from you as well. We have Connexus here as well. I'm looking forward to your contribution as well. Is basically a core ledger, right? So it's a core banking system ultimately where accounts are represented, right? This is what tokenized deposits are. It's basically bank accounts on a new technology, on a blockchain. You can also represent bank accounts in other databases or even a spreadsheet. Here in this case, it's a smart contract on a blockchain. And the rest, as you also alluded to, it usually sits off-chain, all of these other systems, right? So it's not that there's a token that can be sent to anywhere, that can be held by anyone. No, it's still an account with one particular bank, and that needs to be wired into all the other internal systems. Now, when it comes to hurdles, for example, the reach that you also mentioned, at the moment, this is really bank-centric infrastructure, right? So we have Connexist as a solution from JP Morgan. Deutsche Bank is looking into that as well to allow 24/7 availability of funds between accounts at the same bank. Now, that's obviously very different to payments, how they traditionally work, where you also want to send funds to another bank, right? So the multi-bank capability, for example, needs to be ensured. And this is where other projects come into play. So we jointly work on Partior, for example, which also operates on the shared ledger infrastructure. But the multi-bank solution is also still an issue, yeah, that every solution needs to solve for. Swift Ledger is looking into that. They also need a settlement asset, how to settle between the different banks. Project Agora comes into play as well, of the BIS. And it's complex, yeah? So tokenized deposits, I would say what we at the moment see is bank-centric, internal 24/7 bookings, yeah, between accounts held at the same bank. That's great. You can do already a lot with that. But the real breakthrough would be multi-bank connectivity, which is much harder, right? And this is why I think also still we are a little bit in a pilot phase, right? Beyond internal processing, internal book-to-book payments within one bank. And then come stablecoins, which basically sit outside of the traditional banking system, which is a type of money that so far did not exist. A bearer instrument that technically anyone in this world can hold. Now, if banks want to operate with these stablecoins, you also have to ensure that you do it in a regulatory compliant manner, obviously, right? So you cannot send it to anyone in this world where you don't know who that is. And that restricts also, I think, stablecoins from becoming a very easy way to reach anyone in the world and send those stablecoins to anyone in the world, yeah? And also here, I think, the industry is, I would say, much earlier than many would think, right, in terms of adoption, because the hurdles from an infrastructure perspective, from a regulatory perspective, they also need to be overcome. So, yeah, I try to bring in a bit realistic views on these topics. Yes, it's frustrating that we are still in pilot phase, right? Yes, we see some initiatives that are live now, but again, very bank-centric, right, which is all about 24/7 movements of funds, internal bookings, you could argue. And let's see whether stablecoins are faster than, let's say, multi-bank solutions like Project Agora, Swift Ledger, and so forth. Yeah.
Do you think, by the way, that I think Deutsche Bank's been involved with a CBMT project as well, right? That's a multi-bank tokenized deposit infrastructure environment, right, for multiple banks. Do you see that as a promising approach?
Yeah, I think it's one of the approaches which aims to solve the problem of multi-bank connectivity, right? Ultimately, what it does is it records interbank liabilities on a ledger, which says, well, the sending bank still owes money to the recipient bank, and then the question is, would the recipient bank already credit? But yeah, it's one of the initiatives that are discussed. Let's see where it heads toward. Yeah.
Okay, thank you very much. So we've already heard Connexist quite a few times now, so it's definitely your turn, Matej. I'm still with the very first question of this panel. So have we already moved out of the pilot phase? And Manuel has said not really, and there are reasons for that, but Connexist is already a significant player in the market and moves significant amounts of volume daily. So I'd like to ask you, on the journey of Connexist, where did you see the turning point from when it wasn't just a pilot, like a little project on the side anymore, but it was proper production mode and proper infrastructure?
My answer might be slightly different to what the rest of the industry says, primarily because we've started very, very early. So, in fact, not many know that we started a blockchain center of excellence 10 years ago, when the industry was questioning the very technology itself. So that was a good start, and then we played around with it for 5 years, and then almost 5 years ago we established Onyx, which was a formal business unit, and it was definitely the pilot phase. And then we started with industry leaders and design partners. I mean, you could call Siemens, the likes of Siemens, or probably Ant Financial, whatever you want to, but it definitely helped us understand that there is a need for money to move efficiently. Again, it's a big challenge for us as well, because we ourselves move $10 trillion every day. That's 30% of US dollars moving through our books. And when we look at our own flows, we can definitely see areas of improvement. And then you start questioning yourselves, like, how do you do that? Interoperability is great, but imagine if 5 years ago we went in the industry and said, we have a multi-bank, multi-chain, tokenized bank solution, let's get started. Nobody would even say yes. So unfortunately, pilots are the way to start. We all are very critical of pilots, but without pilots, how would you scale a pilot? So that's one point. The second point is, I think having design partners like Siemens, etc., really helped us because we built the basic product. We could move dollars only from one branch to the other. Then we kind of built upon it, saying, okay, if euros moved, does this help, etc. The fundamental question which we asked ourselves and the industry is, would you benefit if money moved when it otherwise couldn't move? If you move dollars on a weekend, does it help? If you converted dollars into euros on a Thanksgiving day, does it help? I think that was the biggest question for us, and when the answer was a resounding yes, technology is an enabler to it. Now, even the technology, I think that when the technology is the protagonist of a discussion, then the technology is still irrelevant, like it's not doing its bit. As much as the industry hates bank accounts and bank deposits, they're the most comfortable with bank accounts and bank deposits. You could be critical with the bank account, but you will end up having a bank account. You'll have hundreds of them. So what our product folks did was there's a need in the industry, but there's a resistance to behavioral change. Can you bring a technology variant to the existing behavior? So we put bank accounts on blockchain. We didn't put a stablecoin or a token. We put bank accounts on blockchain. Until date, we've moved $3 trillion just by putting bank accounts on blockchain. From our clients' perspective, oh, this is just a bank account. Then we went one step ahead saying, okay, you have 2-3 currencies. What can you do more? Then we added FX, because then obviously global multinational corporates have regional liquidity requirements. So I think for us, the key part was to start with some pioneering institutions, build on top of it. Fortunately, we were able to scale. And once you have an ecosystem, that ecosystem has a multiplier effect already. So for us, fortunately, we've kind of broken away from the pilot phase already, but in a good way, we are seeing kind of our school of thought being validated. Now the whole industry is also kind of working towards it. But I would always, being somebody who's been part of those pilots and who's seen it scale, you cannot be more overly critical of a pilot, because that is how it all starts.
Yeah, maybe I can add a little bit, it's important, coming away from slideware really to soft and hardware. Yeah, so because, many people talk about it, right? But very little have really, practical experience with implementing this. And when we actually started implementing a stablecoin, the JP Morgan stablecoin, 1 year after in the implementation, we ended up with a bank account on blockchain, because that was very easy to my accounting teams to say, guys, this is a bank account. It looks like a bank account. It smells like a bank account. It is a bank account. So that was very helpful in the transition, when I talk about mindset, to make that possible. So that's why, for us, it is a bank account. It has all the required bank account. It has even an end-of-day balance, because we need some end-of-day balances for the insurance and also for the accounting purposes. So even we have this to make it really easy of integration and migration paths, right? So that's why, yeah, that you have to do it. You have to just to do it. You have to experience it, and then you know how to use it.
But Heiko, I wanted to ask you another question about this. To what extent do you as Siemens even care what type of digital money the money you move is, as long as it's instant, 24/7, on-chain? It could be many different types of money.
The short or the long answer? No, I don't care.
You have 19 minutes. You don't care. Okay.
No, I really don't care, because it must serve the purpose. And I talked about the reach. Can I reach my counterparties? This is most. Can I do this efficiently? I think what's important is, and I think the discussion in the moment is very much focused on the payment side. I think we need to broaden that view and also talk about why we are making that payment. And this is part of the story. So we need to think about the end-to-end process. Why we are doing this payment, what is the purpose, do we need 24/7? And why is instant for us interesting? Because of finality. We know in that case the payment is made, and that helps us on the treasury side, but it helps also on the industry side. So again, I would say after now 5 years having experience with blockchain, not only on Connexus, also other banking partners provide such an infrastructure to us. I think we are beyond a blockchain. What for us is interesting are the features they came with blockchain. So I would say we are blockchain inspired, but I don't care about if it's blockchain or not, right? That's just a technology that enables this, what we want to do. Serving the purpose, this is important.
Yeah. But if you don't care,
Yes.
roughly spoken, and other big players in the industry also don't care, and then they also always choose to, when they end up choosing different forms of digital money, then how do they actually speak to each other? A question I wanted to ask to Mark, because in your keynote earlier you introduced the different forms of digital money, stablecoins, CBMT, whatnot, but how do you imagine a world where every company, not everyone, but like they use different forms of digital money, and how does it all connect in the end?
Well, I mean, I think for most, enterprise companies, or small, medium businesses and so on, at the end of the day, I think they're going to be similarly, not caring about the particular form of money as long as they can make the payment. They know it's going to reach the counterparty and it's all going to be proper, legitimate with finality and all of that. So what we see a number of banks actually looking at is ability to support omnibus wallets where they actually handle the blockchain element transparent to the customer. The customer is just issuing a payment, right? They don't even know they're paying, I don't know, dollar or certain dollar amount that needs to be transferred, let's say in euros or Singapore dollars or whatever. The bank can then decide based on routing optimizations, based on cost, based on time of day, availability, and so on, which rails to use. I mean, banks to some extent do that today, right? I mean, they provide that kind of optimization, and they charge for that service. I think with blockchain and omnibus accounts are going to be, in many cases, doing the same for customers that don't particularly have a specific requirement as to which rails to use. There is also, of course, a situation where, and this is probably not the place to say it, that there are customers, enterprise customers, who are looking to do those payments without going through the banks. And then they're going to care because they have to do the same things, right? They have to implement whatever KYC, sanction screening, and we're trying to provide solutions that kind of from an ERP and then digital asset platform perspective integration provide those capabilities if they want to perform some of those functions on their own, and then they need to be able to use some kind of optimization service, routing service, etc. for the payments.
Thank you. Another question I had, I'm not sure if Manu is the right one to answer or Metosh. I'll just address it to both of you. Yeah. I was wondering where the demand actually came from in the first place, because sometimes you hear people say this is very regulation driven, and then maybe if I would ask Heiko, he would say it's demand driven, the industry needs it. But maybe JP Morgan just had a really good idea and wanted to market it. So what do you think about that?
That would be a very bad marketing expenditure if we spend so much money and time behind marketing. I would definitely let Manuel go, but in terms of the demand, like I said, it goes down to a fundamental question of, is there a monetizable gap today? Of course, as commercial institutions, you have to look at commercial value to both sides. Is there a monetizable gap if this 100 million Singapore dollars was in Singapore versus in London? Just take a simple example. If you had $100 million of an obligation in Singapore on a Monday morning, you either send the money on a Friday afternoon, today you're converting it and sending it to Singapore on a Monday morning, or you're sending it on a Monday morning. There's at least $25,000 of net interest income, which today the corporate loses. So there's significant demand. Now, we have large corporations, we have fintechs, financial PSPs who move money, who depend extremely highly on pre-funding. Pre-funding is one of the biggest challenges in cross-border payments, as you would know. So there was definitely a demand, and then goes back to the point on how did we enable it. Today, when I send, for example, Heiko 50 euros, he sees 50 euros on his phone because somebody posted an entry on his account. Nobody gave him 50 euros. That's how money moves. When somebody posts an entry on a ledger, that's how money moves, which means if you could post entries on a ledger all the time, money will move all the time. Which means if you could post entries on multiple bank ledgers all the time, money would move between all the banks all the time. Of course, ideal. So Kinexys is a single bank ledger, so I can move money around on a JP Morgan ledger. Partior is a multi-bank ledger. Swift, I think, is enabling a universal. I think as long as you address the ledgers, the money will move. Like Heiko said, the industry couldn't care less. And there is definitely a demand because there's pockets of pre-funded billions, if not trillions, of pre-funded liquidity across the global payments ecosystem, which can actually be reshuffled, and there's significant monetizable gaps for the industry and for the institutions helping.
Yeah, I mean, what we have done over the last months and actually also like 1.5 years is talking a lot to clients whether there's demand for blockchain solutions, right? And I mean, maybe also coming back to what you've said, clearly there are some industry leaders that definitely want to experiment and also understand what blockchain can do, but usually when we talk to treasurers, they say, look, I couldn't care less whether it's blockchain or whether it's any other solution. And then, you know, the benefits that you can get from tokenized deposits or any other money on chain is, again, you said it 24/7, right? And then some sort of programmability. Now, what we came to realization is that at least many of the corporates that we talk to would like to extend their cutoff times to have more flexibility to send payments later, but not necessarily on a 24/7 basis, right? So the industry heads towards that, and clearly if you had an infrastructure that is up and running on a 24/7 basis, you also need to think about the liquidity impact, right? That needs to be steered as well. That would be optimal. But I think there's lots of hype around 24/7 availability. Maybe it's not yet that much required, right? And then programmability is clearly also a big aspect, where we see, you know, also multi-bank capability as the demand that we see from our corporates, right? So we also have our internal cash pool engine that can orchestrate cash pools and cash sweeps and provide a lot of automation. And clearly a bank can, you know, provide more and more on their own platforms. But I think what we hear a lot from our corporates is the multi-bank connectivity again, right? Where there's logic maybe even sitting in corporate systems or in ERP and TMS systems. And then APIs can, you know, fill the gap to provide very efficient payment instructions and then also account statements. So I think it's not a pancreas for everything, right? Blockchain and tokenized money, that should not be forgotten. Most clients that we talk to don't say, I want it on a blockchain. They say, I want to have more flexibility. I want to have more logic, maybe in an external system, an internal system. And it could be that, you know, an internal blockchain for tokenized deposits is the right choice. Maybe others as well.
Yeah, I would support this because we should not always think about, you know, what problem can we fix with this. We should also think about what are the opportunities that are opened, right, by such a technology. And when Naveen gave his first presentation in 2021 to us, right, to blockchain technology and what you have done so far, we had actually really no clue what to do with this, but it sounded so fantastic that we had to implement it. So that's why that was quite convincing, obviously. So, and since then we have developed a lot also in co-creation. We developed a lot of features which we are currently using on a day-to-day treasury business. No? So not just looking on problems, also looking at what opportunities are opened up.
So we
I just wonder on 24/7 basis if, you know, what we're beginning to see is that, you know, humans don't do 24/7, but AI agents do. And AI agent enabled systems, I mean, like we see that across, you know, supply chain, ERPs, many other things, may want to do transaction at 2 a.m. because of certain issue, whatever that needs to be handled. I wonder if that's something that the banks are looking to address.
Yeah, I mean, I can start. There's lots of hype around AI agents and stablecoins at the moment, definitely, right? Because stablecoins are this at least technically globally fungible money that anyone can hold as a bearer instrument. Yeah, very, very interesting developments, I would say. I would say representing a bank, not something that we can very easily touch because we need to ensure that the stablecoin transfer also fulfills the regulatory requirements. So we need to know who the beneficiary is. We need to convey all the address information to screen and so forth. That is also something that I think is yet to be answered, how those transfers can be done very much in a regulatory compliant manner. If it's just peer-to-peer between AI agents that don't even have a jurisdictional nature then maybe that works. I don't know. I'm not an expert here from a legal perspective, but yeah, it's definitely a trend that we see in the industry. I'm quite sure. Yeah.
And especially for stablecoins, I remember our prep call last week. It's also an interesting question to what extent the stablecoin hype is quite regulation-driven and maybe a bit less demand-driven than other initiatives.
I think it's a weirdly interconnected influence which the stablecoins have had. For example, if you take the amount of stablecoins in circulation today, most of it is US dollars, and then that kind of has moved Europe into action, which has resulted in many conversations with many treasurers. Then that cycle has resulted in establishing that there is a need for money to move outside of traditional banking hours. So in a I don't know, weird is a word, but in a very convoluted way, the whole stablecoin hype actually questioned the whole industry. Do you actually need this? And the need was established, and then the bigger question now is how do I meet that need? And as if you can see, obviously there's a lot of action from a lot of banks in Europe of late, and that probably is an indirect result of that chain of events where now large banks are now speaking to the industry much more and saying, do you care if it's a stablecoin as long as I'm able to move your money 24/7? So then the banks would then start looking at a compliant way of meeting those needs. So if you were to indirectly attribute a benefit of the whole stablecoin hype, I think it was a blessing in disguise for the whole industry. Would the entire industry use a stablecoin or forms of money? I think there's many dynamics to that. Digital money obviously is going to be is here to stay. I think there's no denying that. Are stablecoins going to be super relevant? I think forms of those would be super relevant. Some of those forms might not be at scale. As long as I think commercial bank money will still end up being relevant somehow. Now, if that money represents a tokenized deposit, a deposit token, or a consortium-backed stablecoin, it could be anything. But I think as long as it's commercial bank money, it ends up being scalable. The non-bank issued stablecoins, I think, will still have a role to play for specific use cases. It's also then on the industry to figure out how these kind of interoperate. Interoperability is not that easy. I travel quite a bit. The chargers don't interoperate these days. Like, I think we just conveniently forget that there's many aspects of our life which don't interoperate. We found a hack. So I think the industry will find a hack as to how to stitch together all of these disparate infrastructures behind the scenes so that the users actually don't care. But I think stablecoins and the regulation in the US have had a convoluted impact on the entire 24/7 blockchain world.
So we only have 4 more minutes. And before we end, I would like to give the audience a quick outlook, because we wanted to originally talk about the roadmap to tokenization. Mark, maybe to you, if we wanted to ensure, theoretically, that 2027 was the year of mass adoption of tokenization, what do you think is the one technical standard or maybe one rule book that would need to be implemented on a large scale?
Well, I think probably the biggest barriers and impediments that people see is interoperability, multi-bank, multi-ledger, and I think the standards that are emerging in that space are going to be my pick for kind of, where to focus on. So there is work that has been done over the last couple of years on something called Secure Asset Transfer Protocol, SATP, moving through IETF standards and also ISO standards body. We participate in the technical committee 307 that's focused on blockchain technologies. There are subgroups there. And with some partners we've been promoting. I think it's almost complete, and it's soon to be moving into an RFC standard space, right? So it's basically, if you remember, in the early days of internet, when you had to struggle with sending email across disparate systems, I mean, you're kind of in the same state right now, right? But there were standards, RFC standards, and now you just don't give it a second thought about how to make sure that my email gets into your email box, even though the systems may be disparate. I think that SATP protocol and things based on that, maybe there is an evolution of that over time, is going to be that kind of enabler for cross-ledger atomic transactions. And so that's going to, I think, be my vote for the next, let's say, 6 to 12 months from a standards perspective.
Manuel, would you agree to that, or do you think it will be a very diverse world, very colorful, everyone has different standards and they somehow need to agree to each other?
I mean, in my head, there's two scenarios. Either every bank builds their own ledger and their own network, and then you have to stitch them together, maybe through solutions like Pontes from the ECB, or Finality as a settlement asset, or other initiatives. London Stock Exchange, LSEG, also has an initiative. So stitching different ledgers together that will also work on different standards, right? Or the industry really comes together and tries to build something together, including the settlement piece with central banks together. Now, the latter is more complex, obviously, and requires buy-in from lots and lots of different industry bodies, banks, central banks. The project is Project Agora of the BIS. Let's see whether that flies and whether that will actually come to realization. But these are the two ways that I see tokenized deposits eventually coming to mass scale, let's say. And then there's stablecoins, where I'm also still puzzled of how quickly that uptake can be realized, and whether it's really a B2B flow in the masses, right? Because you have to switch your deposit into a stablecoin first. You have to go through an on-ramp institute. Now, banks could play that. Will banks play that? When will they play that, right? Then you need to have regulation around the world. So it's relatively early stage, I would say, for mass adoption here as well. So yeah, there's different paths forward, but nothing that might lead to a very, very quick solution, I would say. Yeah.
I would have plenty more questions, but I already see the timekeeper. No? Okay.
Feel free to do so.
I actually think what Manuel just said, speaking in the two scenarios, was a really nice way to wrap up. There are different ways to go, and next year we'll probably meet again at the Digital Euro Conference, and then we can discuss again and see what materialized and what not. So I'd like to thank every single one of you for sharing your thoughts today. I really enjoyed this panel. Thank you so much.
Great job, Lena. Thank you very much, dear panelists. Pleasure. We seem to be still in the pilot phase, is one of my key takeaways. Another is that we are in some disciplines also trailblazers. And that is in fact important to know in the face of European sovereignty. And our next keynote speaker has also that particular European sovereignty in his title. Please give a warm welcome to Ruben de Beers from Senacor Technologies. He will speak about a resilient cloud stack enabling European sovereignty. Ruben, welcome. I hand over to you. I'll get you a microphone real quick. And with that, the stage is yours.
Thank you. Yeah, well, I'll speak today about a cloud stack and how to build a cloud stack, a real sovereign cloud stack with providers from Europe. And maybe I'll quickly start with why we need sovereignty. So we, in our payment bubble, might know this already, but if you give as reasons that it's just the risk that you might have, or that Russia or Iran or cut off the international payments. That's like if you talk to your family or friends, that feels like a bit far away. And so I'd like to start with a little personal story. And so this is a cocktail bar in my hometown that we sometimes visit. And my wife and a friend were there, spent the night, and at the end of the night they wanted to split the bill. And how do you do that in Germany? One pays by card, and then you transfer peer-to-peer with PayPal, obviously. And so my wife transferred the amount by PayPal, and the transaction was blocked. So it took a few weeks to find out what the problem was. And obviously it was the name of the bar, which is Cubana. And so somehow the name was obviously in the transaction details, and that's probably the reason why this got blocked. And so while this story might be somehow funny, it's also what we already heard today. Other people are having real problems, like judges from the criminal court that are cut off international payments because they are on the sanction list of the US. So this also shows that we are kind of dependent from external jurisdiction. And of course, if you think about payments in Europe, you don't want to have that. So what has this to do with cloud? And that's the main topic of my talk today, about cloud services. So if you build a new payment system today, a new software application, you'll probably do that in the cloud. And if you do that, you will obviously, or more often, do it with US hyperscalers, AWS, Azure, or Google Cloud. And so why do you pick those three? Well, they are reliable. Yeah, they do offer the services that you need. You will find developers that have the experience with those platforms. So it's the easy way. And also, those providers did a good job in being compliant with European legislation, to comply with GDPR, to have data locations in Europe, to follow Europe's legislation, and so on. So you can actually use them, but then you're still dependent from US jurisdiction. Because in the US you have the US Cloud Act. So when a US authority requests data from a US company, they will have to deliver the data, even if it's stored outside of the US within Europe. So you have a legal conflict between US jurisdiction and the GDPR, and that obviously you don't want to have if you build a payment system in Europe. So let's look at so the question is what's to do, what can you do in Europe? And so there are a lot of cloud companies, which are, some of them are well known, others are not, but if you look on the map, there are pretty many that offer cloud services. So can you use these to build a payment system? And so this is this is where I will be a little bit more technical. I tried to keep it simple, but if you have like a typical application stack that I show here on the left, which is you simplify it, you have some kind of load balancer which transfers the loads to some services. They have a service layer which is managed by Kubernetes, which scales the services to your need. Then underneath you have a database cluster and some event service and logging services. So this is like a very simplified, typical stack of your application. And if you look at European cloud providers, this is not a problem. They can all provide you with these services. So, but if you go a little bit further, you often want to have something like a private cloud, which connects your company's on-premise systems with the cloud services, so that your application is actually not in the open internet, but only in the virtual private cloud. And then things like a secret manager, or optionally also a content delivery network, or a service that provides you with metrics. So these services are already a little bit challenging, which means that some providers do offer them, others do not. So you have to look into that more closely. And what gets challenging is if you go further. So if you want to build a payment system, then you often need hardware secure modules with a certain specification. And then what gets really complicated if you go large scale. So when you go large scale, you have multiple regions which you want to connect, where you want to have dedicated connections between the regions, where you have multi-regional services that you then need for your content delivery or for your database. And these are the topics that with European providers are more difficult. And then finally, if you have some general services that you will often need, is that you have your services should be multi-availability zones, also have a certain SLA that you need, and you might want to choose your database technology to your needs, and then developer experience and cloud auditing. These are all topics that are a challenge. So this is just the rough surface, let's say. But so the issue here is if you go to one of the US hyperscalers, you get all of this out of the box. That's no problem. So, but if you go to a European cloud provider, then the first ones, they are delivered. The others, you have to look into it, and some you don't get. So what you can do is you can close some with other providers. You can pick other European providers that have specific services, for example, for hardware secure modules or for dedicated connections between regions. So you can close the gap there. And for multi-regional database, well, that's your operations team that can close the gap. So to wrap up, if this was too technical for you, to wrap up, you should just remember, like, there are 3 messages. The first is, if you build a standard application with standard logic, that can be done in Europe cloud applications very easily. If you want to build a more complicated system, then you have to look into the details. You have to look at each of the services in detail to look if it serves your purposes. And third one is, at the end, the devil is always in the details. So you really have to look at the details of the service requirements, and go into technical details to do a pilot if the services that you have really, the services that the cloud provider gives you, serves your needs. So, good. So the next topic was, what about the gaps that the European providers still have? Are they? So I think that they will close them in a few years. So also, if you look at the US hyperscalers, a few years ago, they were also not eligible for financial service companies. So we had a project within a German bank that wanted to work with cloud services, one of the hyperscalers, and this was also challenging because the security requirements were not met. They also had topics with hardware secure modules and encryption keys. Compliance requirements were not met with the data location, with data access that had to be prevented, and integration with on-prem systems. So some of similar topics that we had before were also a problem with US hyperscalers a few years back. And within that project, within the project time, so we had a project with the German bank and the US hyperscaler together in order to close the gaps. And so this was, at the end, this was possible. So bottom line, if you do this with European providers, this will also take maybe a few years, but they will also close those gaps. So if you want to go into more details, so one website I want to refer to is, it's not really, I'm not connected to that in any way, but comparison.cloud, they give a good overview of US hyperscalers compared with some of the European providers in more detail. But then I would also recommend, if you want to really know it, they also just scratch the surface and you have to do a pilot and really look into it. And so yeah, that's actually already to conclude. So in the end, European providers, they can deliver a resilient cloud stack. They are able to do that. So there are some topics where you have to go into more detail, where you have to find where you find solutions with other providers. But it is at the end, it is possible today already. So if you want more details, I'm also happy to connect. We at Synacor are a provider for financial services and also payment in the payment industry. Have a long history there. Also have partnerships with US hyperscalers and some of the European cloud providers, and also have technical staff to do those projects. And also we are very proud that we have the ECB as one of our clients. They selected us as first-ranked tenderer for one to build the CP component for the digital euro. And so we are happy that we can support this project and to get a European resilience in the next years. So thank you.
Ruben, fantastic. Thank you very much. We are well on time. If there was a short question, that would be completely fine. But if that's not the case, Ruben will be available for you here. I will guess the rest of the day, right?
Sure.
Perfect. In that case, thank you very much for bringing some clarity into the topic of European sovereignty. I mean, this is what half of this event is also about. I think it's incredibly crucial, and it's great that you brought up the cloud topic. I think you're the only one today who did.
Thank you.
All right, perfect. Please give it up one more time for Ruben. All right. Now, on-chain currencies always raise a lot of fundamental questions about utility, about governance, and about their general structure. Our next panel, titled Euros on-Chain, Roles, Use Cases, and Guardrails, moderated by VIA Sciences' Daniela Bobak, will bring clarity into exactly these fundamental questions. Please give it up for Daniela Bobak and her panelists. The microphones are turned on. The stage is yours. Hey, Patrick.
Thank you very much, Marcel. So the euro is increasingly appearing in blockchain-based financial systems through stablecoins, tokenized assets, and emerging payment infrastructure. This raises a fundamental question. If euros move on-chain, who actually operates the system and what roles will different actors play? Like Marcel said, I'm Daniela Bobak. I'm head of business development and ecosystem at the German Blockchain Association, actually. That's the head I'm having right now, called Blockchain Bundesverband e.V., and I have the pleasure to moderate this amazing panel. And before we dive deeper into this, I would ask my panelists to briefly introduce themselves. And I would say, Patrick, maybe you give it a first start, please.
Thanks, Daniela, and hi, everyone. Can you hear me okay?
Yes.
Okay, perfect. So sorry to not be able to join you on stage. Would have loved to come, but unfortunately an emergency stopped me. Hopefully next year I'm back in Frankfurt. So hi, everyone. My name is Patrick Hansen. I'm Director for EU Strategy and Policy at Circle. Circle, for those who don't know, is a global financial technology company, primarily known to be the largest regulated stablecoin issuer in the world. So we issue the largest regulated dollar token, USDC, the largest euro-denominated stablecoin called EuroC, and also the largest tokenized money market fund, USYC, out of our regulated entities. I particularly look over our strategy, our regulatory setup, and our expansion in Europe, and I'm looking forward to discussing all of these interesting topics with you guys.
Thank you. Tony, maybe you as well.
Hi there. My name is Tony McLaughlin. I am the CEO of a company called Audimax, and we are a clearing system for tokenized money, which perhaps I will explain later.
My name is Alexander Brunner. I'm a senior advisor of Via Science. Via Science is a US-based Web3 data security company. Originally, they developed a Web3 infrastructure that has military-grade capabilities for data security for the US Navy, US Air Force. So no crypto initially. Since end of last year, we integrated the payment functionality of stablecoins. Our first partner is Circle, so happy to see you, Patrick. And we're working on Stellar. And I'm based in Switzerland. I'm overseeing the European market. And I'll be a bit sharing a few thoughts how Americans are approaching the topic of stablecoins versus maybe the European approach.
Hi, Jan Sell, CEO of Kivalis. We are building an EMI out of Holland, which will issue a euro stablecoin and is backed by a consortium of European banks, including the likes of ING, UniCredit, BBVA, BNP Paribas, and so on. And I might give a European perspective on how we build a stablecoin and why.
Thank you very much. So let's start with a question for every one of you. Maybe an easy one, maybe not, I don't know, you will tell. Do we need euros on chain, actually?
Well, I guess I can start with that. I would say, I mean, if we are talking about the blockchain basically provides a number of efficiencies around pretty much any business process that involves two or more parties that don't trust each other. And if you look at financial processes that can be improved with being put on chain, like for example cross-border payments or treasury management operations and so on, there are a number of efficiencies there which can only be captured on chain at the moment, given the way the technology is going. And if you sort of want to capture those efficiencies in financial markets, you need a euro there if you're operating in euros. In fact, I mean, it plays into the longer or the bigger narrative about European strategic autonomy as well, but maybe we can get into that later on.
Okay, and what is your take on that? Are we solving a real market demand with that, or are we still building infrastructure ahead of adoption?
Can I try to take part one and part two at the same time? So I think a first principles argument is that a blockchain is a venue for commerce in the same way that a high street or a physical marketplace is a venue for commerce. And if people who transact on those venues don't have access to regulated money, then they will still transact, but they will transact in unregulated money. So our sovereign currencies have to occupy the spaces that people want to do business. They want to do business on the high street. They want to do business in a physical marketplace. They want to do business on Ethereum. And so we must provide regulated financial services to these venues for commerce. Otherwise, we create a tremendous vacuum. And unfortunately, that's what we've done. Through an abundance of caution, we have inhibited regulated financial players entering these spaces. and that's created oxygen for unregulated finance to flourish. So it's I would say it's whether it's about sovereignty, whether it's about the regulatory perimeter, it's an obligation to enable regulated finance to transact on these new venues.
And would you also confirm that it also have to be in euro? Because, I mean, we have lots of US dollar on chain already.
Absolutely, because European citizens should have the right to transact in euro if it's their choice. So if the regulated instruments are not provided on these venues, then don't be surprised if someone transacts in Tether if they haven't got access to regulated euros. That's not the fault of the person doing the transaction. They want to conduct a financial transaction and they're using whatever is available. So the market failure is if regulated financial services does not turn up on blockchains. That's the market failure.
I think I would just add to that. If you look at on-chain stablecoin transactions at the moment, I think I saw a study recently that put the number of European transactions at about 36%. At the moment, those are all happening in US dollars, or those all minus the 0.2% that is in euros at the moment. So there's obviously a need.
Maybe I'll try to answer from a more practical term. If you think, when was the last time you used stablecoin to buy anything in Frankfurt? Have you used anything? I'm sure there's no one in here has used stablecoin so far. So Europe, so far, I'm not sure if there's a need for European stablecoins by common people or the normal citizen. Stablecoin has been used in crypto trading mostly. I'm sure Patrick Hans will address that a bit more closely. But what we've now been seeing, and we just did last year, a pilot in Haiti where we've been paying out through stablecoins to mothers in need, and now also to the staff on site through stablecoins, because it's much better than using cash and shipping physical bills. So the reality in emerging markets where you have a much larger unbanked community, there it is real. And they, on top, like US dollar, I think the driver, what we've been seeing so far is a lack of a good enough banking infrastructure helps with adoption. And obviously, if you have inflation or an unstable local currency, the US dollar is an attractive alternative. And that could potentially be for the euro as well. But I think a lot of the adoption we'll probably be seeing, and I'm happy to talk about what we're seeing now coming from the US, I think in emerging markets will be the battleground for stablecoins in a retail space. I'm not talking about CBDCs.
Okay, thank you very much for adding this. If we imagine an on-chain euro ecosystem, we could think of it as a stack. The form of money itself, settlement infrastructure, and financial market integration. Patrick, this is a question for you. Stablecoins have already become the settlement asset of crypto markets, right? Do you see regulated euro stablecoins playing the same role for tokenized financial markets in Europe?
I think so. I mean, only time will tell after all, right? But I think we're heading there. We really believe that ultimately, currently, this entire industry, including us and the other panelists, are building a new internet financial system. And if we succeed, we fully believe that capital markets, including traditional capital markets, will come on chain. How will that look like in detail will depend on market factors, regulatory developments. We see encouraging signs for now, including in Europe. I mean, you have those DLT pilot regimes, for example, where tokenized securities are already settled on chain against euro stablecoins. We're supporting some of these teams, right? And already today you can buy, for example, a tokenized money market fund and settle with EuroC, our euro-denominated stablecoin. That is not happening at scale though yet. And there are some also regulatory developments, clarifications that will be able to enable that at scale. Currently, there's the markets integration package being discussed at the EU level. And we still do think there are some barriers for euro stablecoin settlement in it's quite technical, but in the CSDR, so the Central Securities Depository Regulation. And also, we believe that currently there's not enough clarity in order to be able to use e-money tokens as collateral in some of these capital markets. So I think The market first has to come on chain. We need to see the liquidity there. Some of these regulatory barriers need to be removed. But ultimately, I do think that e-money tokens will be the preferred model here for the majority of the market. There will be other tools, deposits, maybe on-chain CBDCs as well, but I think for the large majority of the market, stablecoins will be the preferred choice. And I actually think it's a great sign that Jan and team are building an e-money token with the bank consortia behind and not necessarily a tokenized deposit. I think that's a strong backing of e-money tokens as the future of settlement.
So thank you very much. You have also answered my second question actually right away. I would just jump to Tony then. Many people argue that stablecoin ecosystem risks become fragmented across issuers and blockchains. I think you have taken a different position there, right? Can you explain why you believe fragmentation may not actually be the long-term outcome for stablecoins? And where does UBIX come into play, if they come into play there?
Okay, it's a bit of a softball question, but I'll ignore the opportunity to sell my company. I won't do that. Look, back end of the 1960s, credit cards were invented, and they replaced store cards. So previously there was store credit, which is a special purpose way of accessing credit in one department store. And then credit cards were invented, and that's a more general purpose way of accessing credit that can then be used on multiple stores. But believe it or not, there was a time when there were only a couple of credit cards, and they were US dollar credit cards. Now just imagine we're back in the late 1960s, and people are observing that market structure. They might say things like, wow, there's a power law that means there's going to be only a couple of credit card issuers, and everyone in the world is going to use dollar credit cards. Now, that was ridiculous. That's ridiculous with hindsight, and it's ridiculous when people say that thing about the same thing about stablecoins. So we live today in a world of there are 16,000 card issuers, and there is zero fragmentation. You can go with your Deutsche Bank credit card to New York and shop in Macy's, and Macy's doesn't give a damn about Deutsche Bank's balance sheet. Someone from the US can travel to Malaysia and stay in a hotel, and the Malaysian hotel doesn't give a damn about the issuer's balance sheet. So the truth of it is that we've seen this movie before, and here's what's going to happen. The world will turn, the clock will turn, and you can test this thesis. We're going to have a many-to-many market structure. There will be many issuers of tokenized money. That tokenized money, there will be stable coins, and there will be tokenized deposits, there will be tokenized money market funds. There will be many issuers. The issuer needs acceptance, and the issuer cannot build its own acceptance network. There will be a mutualized acceptance network. In the history of payments, here's the example. Circle have Circle Payments Network. This is American Express. One issuer building a proprietary payments network. The alternative model is Visa and MasterCard, which links together many issuers and many acceptors. My company is the new Visa for tokenized money, which links together many issuers and many accepting parties, so that Kivalis does not have to knock on the door of an African PSP to get acceptance. That would be a ridiculous thing for Kivalis to do. So here's what's going to happen. There will be a many-to-many network. There will be a mutualized acceptance network. And every bank and fintech on the planet will offer a wallet. And that will be a pluralistic market structure with many currencies, many issuers, and there will be thousands and thousands of issuers of tokenized money and zero fragmentation. Is that controversial enough?
That's a very good answer,
Bombshell?
I would say. Thank you very much for this. I would have another one for you. You also described stablecoins as potentially functioning like negotiable instruments in the financial system. Is that correct? What would that mean in practice for how they circulate between institutions?
Can you ask somebody else a question? Because I was just talking there for like 10 minutes.
No, but you're doing really well. The others are having their time. Trust me for that. That's my job.
So again, there's nothing new under the sun. If I'm an issuer of a promise to pay, if someone in the audience gives me 10 euros and I write a piece of paper, I owe you 10 euros. That piece of paper can start being traded in the room. It can be negotiated. Or someone can come back to me, I'm the issuer, and they can claim the money. So if I write, I owe you $10 or 10 euros on a piece of paper, or I inscribe it on a block of marble, or I write it in a relational database, or I put it as a token on a blockchain, its fundamental nature hasn't changed. It still means I owe you 10 euros. USDC is I owe you 10 euros on a blockchain. But it's not fundamentally different than to be written on a piece of paper in terms of its its platonic reality, in terms of its like idealistic reality. So it just so happens that in the history of humanity, we've had many turns of the wheel of technology. We had paper, we had relational databases, we've had checks, we've had credit cards. They all exhibit the same market structure. Many issuers, many redemption agents. Now here's the lesson to learn with stablecoins, because people treat stablecoins as if oh my God, we've never seen these things before. Here's the lesson. Stablecoins can be processed exactly like checks. You should be able to this is something you can't do today, which would make the market structure infinitely better. You can't take a stablecoin to your bank and deposit it into your bank account directly like a check. When that happens, the stablecoin market structure gets much better because the bank or the fintech acts as a KYC provider of a wallet and converts the stablecoin into cash. So the way that Kivalis and Circle and everyone the way that this thing happens is when every bank and fintech offers a wallet, and you can receive any stablecoin into your bank wallet, and your bank credits your account. And this isn't science fiction. This is checks. So all I'm asking for, or all I'm suggesting, is that we take this 21st century technology and make it equivalent to 19th century technology. It's not a hard ask.
I like that. Jan, do you want to add anything? On the other hand side, I have another question for you.
Well, I mean, that's partly exactly what we're building on the Kivalis side, right? We have a consortium, that's an open consortium. We have, at the moment, 12 banks, and the number of banks is growing. And many of those banks will end up also providing access to the token via their own bank accounts, and via their bank accounts for their clients. So it will hopefully end up in exactly that scenario.
Well, it wouldn't end up like that if those banks only accepted Kivalis tokens. The way of that would be trying to create a closed loop. The real way to get hyper growth is on the accepting side. In Visa rules, there's a rule called accept all tokens. So the real way of doing it is that your tokens can be accepted by any bank, and your member banks can accept any other token. Otherwise, that is a way of creating walled gardens.
Yeah, I mean, we're definitely not aiming to create a walled garden. We're simply building the infrastructure to put the euro on chain, but being built from inside Europe. So I guess the difference being to Circle, and looking to use the network of banks we have in the background to make that token more and more usable and used across Europe and across the world, really, because in the end, everywhere where the blockchain is used for financial transactions and where the euro is used for financial transactions, we want to build that bridge, that interface between the euro and the blockchain.
So will markets converge around one form of digital money then, or will we see stablecoins, tokenized bank deposits, and CBDC coexisting?
Well, I think if we were talking about the euro, for example, I think we see it as all part of the same kind of financial stack. I think Marike will go into detail in this later on then one of the later panels. But in short, I think at the moment what we have in Europe is the ECB building a digital euro on the retail side, which you can think of as kind of floating on top of the stack, and then you have wholesale CBDC at the bottom, where you'll have wholesale banks will have access and use that as a settlement layer, but neither of those are currently at least envisaged to be on-chain, right? There will be a different form of ledger. And so in between the two, there's a gap, which will be filled by stablecoins on the one hand as a payment token, and then tokenized deposits or tokenized money market funds more on the yield side, most likely. But so it's a kind of, I think it's a monetary stack that all interoperates and will interoperate.
Thank you for this answer. Maybe a question for all of you. If we look to the US, regulators are increasingly starting to treat stablecoins more like financial assets. For example, allowing broker-dealers to treat them as regulatory capital. Does that support your thesis that stablecoins are becoming part of the core financial plumbing?
Yes. Stablecoins shouldn't be Frankenstein monster money. They should be normal money, and that means cash equivalent. And cash equivalence means you should be able to convert it at par value into other forms of currency. And the economists love this term, which is singleness of money. Singleness of money means the issuer doesn't matter. So we have to get to a place where the issuer doesn't matter from the purposes of the receiver. Again, this is exactly what we've achieved in cards. When you take your Deutsche Bank into Macy's in New York, they don't care about Deutsche Bank. So there's a lot of focus on issuers at the moment and the regulation of the issuers. But the end result is cash equivalent stablecoins where the issuer doesn't matter for acceptance.
Thank you very much. Let's have a look on the infrastructure and real-world integration side. Digital money alone does not change financial systems unless it integrates into real operational environments. Treasury, liquidity, corporate finance. Alexander, a question for you. From the infrastructure and systems perspective, obviously, what still needs to happen before companies and financial institutions can realistically integrate on-chain finance into their operations?
That sounds like more a question for Tony or Jan to answer, but maybe I'm just going to try to change a bit at altitude and see where adoption is. I think I've been listening to a lot of panels this morning, and there's a lot of clever people talking lots of things about, central banks, about how to integrate it and risk, and a lot of integration and fragmentation skills. The question is always, where's the adoption? That's sort of my first comment I made. And I can't help feeling sometimes that there's limited enthusiasm in Europe for stablecoin adoption on multiple levels. I sometimes feel, maybe Jan, you can contradict me, the banks are doing it somehow, but with lesser enthusiasm. And I'd like to contrast that with the US. And I think what we see is this, the current administration has realized that there's geostrategic power to stablecoins. If you listen to Trump in the first administration, he didn't like Bitcoin. He said there's only one beautiful currency, it's the US dollar. And now under Scott Bessent, they realized, hey, stablecoins are basically an extension of US dollars. And it has another benefit for the US. You can refinance your debt, because Circle, I think, has become one of the biggest treasury or money market funds in the world based on that. So there's a clear interest from the government and administration to push stablecoins. And without being able to share too many details, but if you think where Americans see opportunities when it comes to stablecoins, we see, when you listen to the administration, you see multiple level of initiatives. First, they're still running a global network of bases, of military bases that are mostly run in the cash infrastructure world. They clearly see opportunities moving that into stablecoins. If they do that, you would have global adoption through 300+ bases in a single instance. That's one approach. The other thing is the US Treasury, and that's one thing you saw, is like with US aid, they're highly critical, or they think there's a lot of corruption in the system, the way the donation work, the humanitarian aid works. they're really looking into that. How can we use stablecoins? So coming from more the adoption side, I think what America has realized, and sort of maybe Europe has not, is that this could become a new form of money we've known before in a new shape and form, but making it programmable and more traceable adds benefits if you want to control your money flows. And I think from a geostrategic approach, and I think watch the space the next couple of months, you'll see some major announcement from the US government how they're going to enforce stablecoins. And maybe just the last observation, and sort of alluding to your question that I can't really answer. I'm a former banker, but I think Europeans get caught up in the questions: what type of stablecoin is it? How we can integrate it? How can we license it? What kind of regulatory framework? I've heard this dozen times this morning. Once the regulatory framework is more clear, we're going to move faster. I think this is all just saying we don't really know, because we don't really have a clear strategy as Europe from that. I'm telling you, America has a very clear plan. And I think once they start transacting, there'll be surprises on the European side how fast it will happen. And maybe just a last observation, because often we're comparing ourselves to the US, is when you look at what has China built in recent years, they have, I strongly suggest everyone to look up, there's a Forbes article about the global and payment treasury system. It runs fully on blockchain. It has trillions of transactions of yuan every day. The whole WePay is now at the backbone, cross-border payments on blockchain. So all the things that Europeans are often thinking or talking about actually have been built and are being built. And as I think the question going forward is, where in this geostrategic landscape does a euro stablecoin fit in, and what does Europeans want to do with it? Is it something between banks or the cash leg of tokenization and all that? And I think this will force Europeans to reconsider in a short time how to move. And I've been talking to some of the community here, and everyone is hoping, actually, one of the things I've heard is like, we hope that America moves, then Europe will move too. So let's see if that's a go-to-market approach.
Well, I'd like to just jump in on the comment about the banks, because obviously we're quite close to the 12 that we're working with, and that's an increasing number that we're talking to say actually there is quite a lot of movement there. There's quite a lot of interest. We're working with each of the banks also bilaterally to try to help them work out how they use stablecoins, because they're all at different stages in their digital assets journey. But some of them are quite advanced and have quite advanced thinking about what kind of use cases they would use the stablecoin for. But in the end, it's going to be an open stablecoin that will be used by, like I said earlier, by anyone who uses the euro. And from a geopolitical perspective, right? If you look at financial flows of the euro in the fiat world, it makes up about 20 to 25% of global cross-border payments, of global reserves held, of bond issuance globally. But in the stablecoin space, it's 0.2%. So there's a major delta there, which I think we need stablecoins from Europe, in Europe, euro that will to fill. And I think that they will happen, and it'll come. I'm definitely less bearish on Europe than you are.
Thank you very much for adding this. So that's today's reality: institutions and corporates. And Alex just mentioned it already. But we're also seeing new types of users emerging. Patrick, this is a question for you again. Stablecoins are increasingly used by NGOs and foundations. At the same time, we're seeing agentic AI entering finance. How do these trends come together? What is your opinion on that?
They're quite different things, right? So NGOs, AI, completely separate topics here. The only thing that I would mention is they ultimately use or choose stablecoins is due to just the infrastructure benefits that stablecoins offer, right? And I think that has been discussed here. It's a global, cross-border, digital, programmable infrastructure. NGOs might, and we have had pilot projects with some of these large humanitarian organizations. They might choose it because it works cross-border, instantly, digitally, right? And AI agents might essentially flock towards stablecoins because they are 24/7 programmable money. And ultimately, I think that's where the value proposition comes from. And maybe to the earlier discussions of euros and dollars and currencies, I think that as we think about in the internet financial system coming on chain, ultimately, be it NGOs, be it corporations, financial institutions, they will rely on a wide array of currencies and blockchains. So the same way that the corporate treasurer here in Frankfurt, where you all are, uses dollars to pay some suppliers, whatever, in the US, uses pounds to pay suppliers in the UK. The same way, I think a future on-chain corporate treasurer will use the euro to some extent for some transfers, will use the dollar to pay other suppliers, right? And so I think that's an important thing to keep in mind, especially in Europe, where the narrative around, we should build guardrails around foreign currency, stablecoins, etc., is very strong. I think we should all keep in mind that what we're building is a global infrastructure here with globally liquid and accessible currencies. And I think the key that will also build strong euro stablecoins is actually integrate with these globally liquid, globally accessible markets and not the other way around. I personally do not see any future where we will get strong euro stablecoins without being heavily integrated with these globally liquid, accessible on-chain markets. And that's the first step, I think, for euro stablecoins in European projects to grow, is tighter integration into these global flows.
Thank you very much. So you have built already a beautiful bridge to the next topic, digital sovereignty and ecosystem structure. We may end up with several forms of digital euros at the same time. That's my take on that at the moment. Stablecoins, tokenized bank deposits, CBMT, we have heard that phrase before. Potentially a digital euro as CBDC. How important is digital sovereignty when building the euro's on-chain ecosystem? Do you expect this ecosystem to evolve through collaborative infrastructure between different actors and countries? Or could we eventually see winner takes most dynamics similar to other digital platforms? That's a question for all of you.
Can I give it a go?
Of course.
I agree with your comments that it starts with strategy. It starts with strategy for, the difference between what America is doing and what we tend to do in Europe is America is acting out of national interest, and it's not dumb to diversify demand for US treasuries through stablecoins. So humbly, I suggest to you, here might be the components of a strategy for Europe which are in sovereign interest. Part one, banks and fintechs in Europe, there are 5,000 of them. They should offer wallets to their customers so that the foreign stablecoins coming into Europe are captured in our banks and fintechs. Those banks and fintechs should convert those dollar stablecoins into euros, moving the money from the American balance sheet into the European balance sheet. This is point number one. Now, when every bank and fintech in Europe has a wallet for catching the American stablecoins, wow, the same wallets can be used for euro stablecoins. And so then we have an acceptance network in Europe for any kind of euro stablecoins to be circulated. So this is point number two, which is we have a universal wallet acceptance network in Europe. The third point is we can play the same game as the Americans. Kivalis tokens should be accepted by our export part, by the people that we're importing from. So my t-shirt, my shirt probably is made in Vietnam. I didn't buy it, it's not an Italian shirt, okay. The importer should be able to pay for this t-shirt, for this shirt, with the Kivalis Euro token. And then imagine you're in the predicament of the exporter in Vietnam. You've now got a Kivalis Euro token. Well, that exporter might well want hard currency in portable format and something which is not dollars, because maybe I want to be diversified against the dollar. But that exporter in Vietnam needs to be able to turn that into Vietnamese dong whenever they want to. So the other point there is that we need to build global acceptance for Kivalis stablecoins. How do we do that? Well, we have believe it or not, the raw material already exists. So I don't know, Manuel Klein was here before from Deutsche Bank. Deutsche Bank provides euro accounts to hundreds and hundreds and hundreds of foreign correspondent banks, including banks in Vietnam. There's no problem with a Vietnamese bank accepting a euro stablecoin because it can be cleared through Deutsche Bank. And by the way, that Vietnamese bank will love to accept the Kivalis token because when they convert it from euros into Vietnamese dong, they will make FX. So if we want to win the stablecoin game, 3 components: catch the foreign stablecoins into bank and fintech wallets, convert them into euros, have a universal acceptance network in Europe of wallets provided by banks and fintechs, and build a global acceptance network for euro tokenized money.
That sounds like a strategy, I would say. I hope all the right people are listening right now. Do you want to add something? Yes,
maybe just, it seems your strategy is perfectly thought out. I really love listening to you. And maybe I'm just going to take a step further into adoption. I think what we've been seeing, and also Via is backed by Bosch and BMW, and one of the discussions we're having, and it's unfortunately still a bit of a discussion, is in this new world where we have much more autonomous vehicles. I'm not even talking about agentic AI, but literally autonomous vehicles. Obviously, in-car payments, making payments payable through charging, and would be a perfect use case for stablecoins because you have programmability features. Well, you can have different, subscriber modes even for parking. So there's a lot of that, and there's a lot of general interest and thoughtfulness about that. But I think that would be one of the things, if Europe sees this as an opportunity to say, hey, we're shipping those cars worldwide, we're going to equip them with wallets, we have this upcoming EU ID wallet, we integrate that and we try to create adoption. What I have to say, and maybe to your point, the Americans are always thinking about adoption and distribution first, because that's where money's going to generate it. And here the discussion is often what's the regulatory correct framework and structure and infrastructure. And the Europeans love talking about that for hours. While the Americans will say, hey, how can we make use cases? I'm telling you, there are use cases coming out of the US Department of War and Treasury in the futures. And Europe should be thinking, where are our strengths? How can we embed, and to your point with Vietnamese banks, and having wallets as part of the future flows we have, and maybe even as a counter or an alternative to the MasterCard Visa payment, but unfortunately I have to say this geostrategic thinking is sometimes a bit lacking in Europe, and we have components where we could add this in and have real clout and market forces, and that would be a way of creating adoption.
Thank you very much.
If I might just add a couple of sentences here, what I sometimes find in Europe, especially on panels and in other fora, is that people think that stablecoin adoption could kind of be forced top down to merchants, to institutions, to holders. And what we have been seeing, or what I have been seeing also following our euro-denominated stablecoin now for a few years, is that the most important ingredient to stablecoin growth and adoption, and also to the later fact that some merchants around the world will accept it, that fintechs and neobanks will build integration and wallets for it, is usage and liquidity. And this is something that requires really bottom-up, nitty-gritty work with the players that actually use and transact with stablecoins today, right? Not in 5 years, but today. Even if you look at the largest financial institutions, they want to build rails for the stablecoins that are actually being used. And so look at MiCAR, right? We have now 20 issuers with over 20 euro stablecoins. But why aren't most neobanks, banks, etc. building rails for these? Because not many people use it. And that's why we have taken the approach for EuroC as one example, to go where the users and the holders actually are and build them and try to build the most liquid, accessible, and interoperable euro product. So we're talking, to the different DeFi platforms, to the different CeFi exchanges. And by now we're seeing some growth. It has worked, right? EuroC has grown 10x since our MiCAR announcement 1.5 years ago. And it is now already the most widely accessible euro stablecoin. But what I sometimes miss in the European discussion is they're trying to build the market the other way around, essentially top down. But you have to build it really from the bottom up, where users are today and where the demand is today. And that will lead to institutional adoption later on, in my opinion.
Thank you very much for adding this, Patrick. Unfortunately, we are already out of time. So there was a lot of experience and expertise here on stage and virtually. So thank you very much to all of you. It was really insightful, I would say. And I would ask the audience to please give a round of applause to our wonderful panelists.
Thank you. Thank you, Daniela. Wonderful. You see on my left-hand side that we are getting changed because the format is slightly changing as well. Our first fireside chat of the event is coming up, and it has an ambitious title. But before we get to that, I would like to remind you that we have 2 other stages as well. The innovation stage, where more of the cutting-edge topics will be discussed, cutting-edge technology, and of course the invite-only roundtable room. If you booked a slot in the roundtable room, that's great. You'll probably check it out anyway. The innovation room is of course free for all. It's also for the dear audience online. It's available. You can just switch the streams, and you will see that. But let us get to our fireside chat. It has an ambitious initiative in its title. It's a DEUSS, a pan-European project to drive SME financing via tokenized bonds. And please welcome former MEP Andrej Kovarczyk, I hope I pronounced that correctly, and Sebastian Becker, MD of the German Federal Blockchain Association, to the stage, please.
I hope so, Marcel. Thanks a lot. This is the Bundesblock double feature. You heard my colleague Daniela sorting out the stablecoin world. And we'll now do something that Patrick just mentioned from his digital elevated American viewpoint here. The nitty-gritty bottom-up work of what can we do to help not only drive European economies, but also European sovereignty. But first, Andrej, please introduce yourself.
Thank you. Good afternoon, everyone. And well, thank you, Sebastian. Thank you also to the organizers for having us today. My name is Andrej Kovarczyk, and as it was mentioned, I'm a former member of the European Parliament, elected in the Czech Republic. In the European Parliament, I was very much working, and maybe don't know, maybe sometimes it's popular, sometimes it's unpopular, but I was one of the negotiators of markets in crypto assets regulation, on transfer of funds regulation, and also the DLT pilot. So yeah, whatever you like or don't like on it, now you know who is behind it. And currently I'm part of the Deus project team and consortium that is developing this, and I think this is also what we will be discussing today. Thank you.
Thanks, Andrej. And maybe you can explain a little bit, you know, the thinking about this, what is now the Deus project started 5-6 years ago. Where does it come from also in terms of the political framing from the EU Commission?
Exactly, it's definitely not a new project. It has been first in a pipeline or in heads of some of the colleagues involved in the project for already some time. I think it really started to have attraction in, well, I would say 4 or 5 years ago in this very specific situation. I think if you look at it, let's say from the economic point of view, we're talking about the post-pandemic period when there was a lot of efforts and also a lot of policy making on EU, but also member states level, trying to sort of revive European economy after the pandemic shock, with a specific attention paid to access to finance for small and medium-sized companies. This is also the segment where Deus is focusing, and obviously there is this technological part. So sort of a development and evolution in a DLT-based technology in blockchain sector that is underpinning sort of the policy idea. And I think on top of it, also something that is, I think, more visible now as we speak, it's actually the idea of introducing DLT-based technology into financial services and make sure that the tokens, as we know them today, are not only tokens representing money and used for payment purposes, but there could be other classes of financial assets that can be tokenized in the market. I think all these three things put together is actually where the project is currently today.
That means, and we all know the pace of European, funding projects. Your idea was developed relatively early, and now with the funding that you secured from Europe's budget, you have now developed, let's say, the technical foundation to help with SME financing. We all know that secondary marketplaces are right now, a fashionable thing. So maybe you can say a little bit about what the project is doing right now. And I think you're coming to the end of your first term now of European financing in summertime, correct?
Yes, that is correct.
And we talk about the DLT pilot regime as a framework for the project.
Absolutely. So there's a number of policy initiatives that are actually the concretization of what we discussed in terms of the policy and economic trends behind the project. The project itself is actually focusing on building a DLT-based market infrastructure that will enable small and medium-sized companies to issue tokenized bonds to access debt financing for their projects. That's I think in a nutshell the key idea. The project is really focusing on the matter, so the technological side also, but also the functionalities of the market infrastructure. But obviously, in order to actually leave at some point the pilot stage in which it is right now, it would have to have also other functionalities and features that would be interesting for potential investors, for potential customers, including financial services providers that will, for instance, secure the distribution channels, et cetera, et cetera, et cetera. So this is, let's say, on top of what should be the building block of the project, which is the market infrastructure, the technology side. It should also be opened and ready for what we expect to become other trends and standards on the markets, such as AI-driven agentic trading, accessibility and availability to settle the transactions in other tokens like stablecoins or digital euro, for the matter. We are digital euro conference, so I think this is also the idea, and obviously to provide other possibilities of secondary trading that I think are not at this point available or standard for regular bond issuing.
Let me ask you about the political ambitions behind a project like DEOS also from the Commission's point of view, because a few hundred meters or a few kilometers south from here, you have the offices of 21X, another secondary marketplace that started with the DLT pilot regime, but they are backed by venture capital. So what should be the difference between, let's say, a truly pan-European marketplace and a company that takes the normal private financing route?
I think there's a number of features that is actually giving the DEOS project the European label, apart from the financing, obviously, meaning that it should meet and comply with some of the policy ambitions that the Commission is putting forward. First of all, I think this is exactly what you mentioned. It's the idea to create a pan-European infrastructure, meaning that if you look at future ambition, that would be not only linking investors and their or the companies and their potential investors from a specific state or a region, but really allow for cross-border financing. So ideally, let's say Polish company looking for investors from Netherlands or Scandinavia, or a Spanish company looking for investors from other parts of Europe. So idea like that. And I think this is also what the Commission and the European institutions are trying to promote. So really build a truly European single market, where we also see that the financial services are not locked in a specific environment of a member state. That I think is one of the ambition. The other ambition, which I think is fair to say, is that the entire project is a sort of a build on layer one European blockchain infrastructure that has been invested in and created and is run by European Commission, or now the private consortium with the European Commission involvement. The DEUS project is actually layer two on this blockchain. So this is also actually to make sure that there is a promotion of Europe-based infrastructure, that there is a use of it, and I think somehow it, in my view, also fits the very idea of this European sovereignty, technological sovereignty, and strategic autonomous that European institutions, and I think many member states, are trying to pursue right now, given some, let's say, negative global trends that we see in past years.
I have no idea what you're alluding to here. Of course, investors tend to also invest locally because they might understand the needs of a German automotive sector SME better if they are based here in Frankfurt. If we imagine a truly European approach where a Scandinavian investor is interested in this little factory in Portugal, do you think agentic and further automation trading can help with this? And what's the role of agentic AI and agentic automated trading patterns are playing for DEUS right now? You have lots of universities on board. You also have Alastria as part of the consortium, so you have all the experience that is needed, right?
Indeed, there's experience, and there's also like technical universities that are part of the consortia, where I think they already have teams that are very much look into different applications of AI-driven technology, AI models, etc. I believe personally that AI will transform, among others, also the area of trading. But I think just maybe starting back from...
Let's talk about matchmaking rather than trading in that context, maybe.
Could be in this sphere, but exactly coming to your question, I think what makes people invest locally, it's sort of a trust, but also I think local knowledge, so that they know what we are talking about. I think this lack of information and lack of trust, this is something where the agentic layer or the AI layer can actually help overcome this for the investors, and they may be more looking into first different opportunities to invest, but obviously looking into potential yields that they can get, and for DEUS as a market infrastructure. We will not at this point focus very much on the trading itself. That will be done by the partners of the project. But I think what is critical at this point is actually make sure that the infrastructure is ready for that. So there is a good interface, there are data available that the agents can actually tap in, but at the same time that the infrastructure is resilient and secure enough in cybersecurity dimension, that whatever happens from outside in terms of external access, it's not actually hampering the functioning of the infrastructure. But obviously, this is the idea that the team is actually currently pursuing, and make sure that whatever happens in the future, the infrastructure is ready for that, and is actually open to external possibilities like the trading. But I think let's build it step by step. I think it would be really good to start with local investments and then come to the cross-border trading. That's also the idea of European institutions. We saw it in many reports, people calling for openness of financial services, etc., etc. But we also see in general, for instance, if you look at the advanced capital markets like Netherlands or Sweden, very much they very much invest locally. So I think it's good to start with that, but obviously not leaving from our perspective the idea of having a real cross-border European single capital market.
If we look at the bigger picture now, there is certainly lots of tailwind for the Deus idea, European sovereignty, 28th regime, harmonized landscape. The economy is certainly not booming, so SMEs will need alternative means of financing rather soonish. Plus, people might be more tempted to invest in their region instead of, financing foreign strange governments' treasury bills. So which kind of partners are you looking for right now, coming close to the initial 3 years period of public funding?
We're definitely looking for, I think, different type of partners to actually make sure that the project is able to leave the pilot phase and start the real market live phase at some point. I think built on the public funding and public involvement, there is definitely one group of partners would be institutional partners that can actually help the infrastructure like Deus to be relevant, important, and also trusted. I think this is important, and also help even then the private partners actually to approach the project more easily. Looking for partners in financial sector that will use this infrastructure for their own activities. Also giving alternatives to the clients that they are already catering with financial services. But also I think, and last but not least, we're definitely looking for partners in the SME sector who will be actually using this infrastructure for issuing their bonds, accessing finance more easily. We can also look, for instance, in the defense sector. We know that a lot of companies there currently have or suffer difficulties when accessing finance in Europe. Alternative infrastructure like Deus can actually help them to bridge this issue. And last but not least, obviously, the distribution channels and the investors that will be interested to join. So I think there's a number of groups of potential partners, but I think key would be to have a relevant institutional partner that will help us to overcome this pilot phase.
Before we have to wrap up, let me get back to that sectoral question, because the project is now run by the Czech Ministry of Industry, and you have also team members from Poland. And in Germany we have Rheinmetall, and Comrade Pappberger is trying to acquire another 10 or 12 companies to grow and to form a European champion. I assume the situation in the eastern part of Europe is totally different. There are lots of SMEs also in the defense sector. Is this also shaping your discussions right now, these zoom into specific sectors? Because certainly there is not a European-wide unified sectoral landscape. It differs quite significantly.
Of course, that's true, and we also know that in different regions, SMEs have different issues to access finance. In some countries, it's much easier. In some countries, it's very difficult. The economies of member states are different. But I think I mentioned the defense sector specifically because obviously not only there is a priority in let's say economic industrial terms and obviously the security terms. But I think also the defense sector itself is changing. I mean, you mentioned Rheinmetall, of course. I mean, there are always like huge companies like that. But what we see in the landscape, we see it in the region, in Poland, in Czech Republic, the companies in the defense sector are also those companies who are actually innovators. They are working on a specific piece of technology that by default at the beginning doesn't necessarily have to be a military technology. If you look at the drone industry, I mean, there's a lot of small companies, innovative companies in that area that are actually working on number of uses of drone technology. But it happens, one of these use cases is actually military use. So if that happens, we know that a lot of companies like that, if they start to consider the projects to have a military impact, they start to suffer from these difficulties to access finance in Europe. So I think it's not only talking about defense sector with these huge national champions, but I'm looking at it as a very diverse landscape of small companies that are specific in a niche technology which has a military use, but they actually lack the alternatives to access finance and finance the project in the future.
So thanks a lot, Andre. Also at a personal level, that's what we dream about, a politician becoming an entrepreneur once your term ends, and also helping to strengthen Europe at various fronts. And certainly from the perspective of the German Blockchain Association, we will continue to support you and also inform about the updates of those European lighthouse projects such as DEOS, and also thank you for shaping our regulatory landscape. Yesterday and today, I think the common sense is this helped a lot, to get things moving, especially in difficult times. That's something we often forget when we talk about the adoption of DLT and digital assets and blockchain tech. The last 5, 6, 7 years have not been, let's say, normal. So thanks a lot for the patience in the audience here and online, and invest wisely in the future. There might be more opportunities to do so locally and regionally, and thank you for having us to Digital Euro Association, and back to Marcel.
Thank you.
Thank you both. That was quite insightful, and definitely a different, a different take on things and a different topical orientation here. Thank you. I do not have much to add except for the fact that we have a 30-minute network break, everyone. Grab a coffee and move around a little bit. And of course, network. See you soon. Welcome back from the break. We just did a little instruction with the tech guys that they should ring the bell again for everyone to note that we'll continue. And we'll continue with the second last panel of today. It's a panel discussion on a vision of Europe in 2030. The digital money stack, that's to name the full title. It will be hosted and moderated by DEA's very own managing director, Konrad Kraft, who amazingly again took the long way to join us today. So please give him a thundering round of applause. And dear panelists, please also join the stage already. The microphones are turned on.
There we go.
And
thank you for
hand
that
over.
Warm welcome and hi. It's a pleasure to be here again, discussing a very important and visionary topic with visionaries that we've assembled that are well equipped and experienced to discuss this topic. The digital money Avengers, so to speak, I would like to call them. But it's quite an important topic that we're going to discuss today. It's really about a gaze into the future about what digital money might look like in Europe. We do know that there's many forms that are currently competing for our hearts and wallets, and they are going to perhaps give us a better insight into what the future might look like from the digital money stack as it evolves and continues to evolve quite rapidly across the globe, but in particular in Europe. So with my luminaries before me here today, I'm happy to take us through this topic in a very systematic fashion, but also a very creative one, because of course we are looking into the future. Who knows what 12 months down the line looks like? But we will nonetheless attempt this task. But before I do so, I'd like to give each of my panelists a chance to introduce themselves, perhaps starting to my immediate left. Marika, please, after you.
Hi, very nice to be here. Thank you for the intro. I like the term Avengers of Euro for 2030. That's really cool. Marieke Flamand. I'm actually on the supervisory board of Kivalis and on the board of a few other companies. I do advisory work. I also write a newsletter called Currency of Power, where I look at geopolitics, digital assets, and what might actually be happening in the world that we're living in. I'm a former crypto and bank exec. I won't name the names in the company I've been in, but yeah, I've been deep in the space for quite some time.
So thank you very much for having me here. I'm not sure I'm one Avengers, but for sure I am surrounded by Avengers there. It's very great to be surrounded by such people. I'm Thibaut Pellet. I'm working at Worldline, and I'm heading the virtual asset and tokenized payment. So very much looking at the whole stablecoin stack and which offer from the PSP perspective, issuing and acquiring side, and also at the digital euro level and what we could bring.
So my name is Stephan Ludwig. I'm from Deutsche Bundesbank. I'm leading the team for the architecture and implementation of the digital euro service platform, so the main components for the digital euro, for the retail digital euro. And I'm in this project since around 4 years.
And my name is Ulrich Binzeil. I was at the ECB the last years on payment and market infrastructures. And I left the ECB in June last year, and now I'm a professor essentially.
Great, nice transitions. Well, maybe perhaps staying with you, Ulrich, let's jump straight into the question. The digital money stack in 2030, what does it look like? You've published some recent work about how certain actors influence the public narrative around retail infrastructure and payments and the like. What do you think the digital money stack might look like? What will it comprise of? What do you think which parts of the debates are neglected, are distorted. Give it to us.
Yeah. No, exactly. If you speak about the future and where this industry will be in 5 years' time, the debate is, of course, very confusing, and it's confusing for a number of reasons. I mean, the fundamental economic reason is that this is a network industry, no? And in network industries, you know, there are multiple industry equilibria possible. So, you know, there's always, at the end, market concentration with some solutions, some providers dominating the scene and potentially generating a lot of money. And, yeah, there are lots of past dependencies. And if you have multiple equilibria, by influencing, you know, views, you can steer where you go, no? So if I have a product, I will say, of course, this product will prevail in 2030, because then I may convince people to look at it and to, you know, kick them into achieving the network effects and using my product. So that leads to a normally confusing debate. There are two other problems. One problem is the correlation of expertise and vested interest. It's a very technical industry, and those who know it, who really understand, are those who work deeply in it for a company, and they're not paid, you know, to say the truth. And those, you know, us in central banks, we have some good half knowledge maybe, or regulators have maybe a good, I don't know, less than half knowledge. So that makes it also difficult. Then there is another correlation, which is a negative correlation, typically between whether your product is in the money or out of the money. So if you have an out of the money product, you will make a lot of noise about it, no? Because the only chance to bring it back is to exaggerate and to make people look at it. While if you have a good product, which likely will come or is successful, maybe you don't want to talk about it because you don't want others to look at it. Or if you are, you know, a super now profitable company like Apple and Apple Pay, you don't want to attract scrutiny from regulators, you know. So there's a negative correlation between noise made and maybe promising, not always, but that's another problem. And then all this, of course, leads that it's also to the fact that it's this highly regulated industry where, like everywhere in finance, not everywhere, but in many parts of finance those days, regulatory changes can make the difference, you know, for where the industry ends. So you have heavy incentives to work on public opinion and on legislators. And again, you know, those people who have the firepower also to do so are typically the incumbents with a lot of money. So I think this debate is always confusing. And then you ask them, where do we go? So we cannot find the answer in the public discourse. We have to think carefully ourselves. And yeah, but I think there's consensus that a lot is ongoing, that in 2030 things will look different. And big questions, digital euro conference, will the digital euro have gone live? Will it be successfully deployed? How many users will it have? That's one big question. And I would answer it still positively. I want that this network effect, and here the public sector has advantages to reap the network effects because it can regulate, you know, it can have mandatory acceptance. And then, of course, all the crypto and blockchain things will also happen, I'm confident.
Okay, interesting. Maybe talking to the public sector directly, from an implementation perspective, what sort of stack do you think is necessary to, you know, see the future stack actually come to fruition, so to speak? What has your experience been, Stephan?
So you ask about pros and cons, and I think there are a lot of difficult things we still have to manage. And if we are looking to the future, I think a lot of things will get managed. I'd like to have one example is the open standards. Yeah, so if we are a couple of years ago we were sitting at the ECB and thought about like how to get a rule book, really a rule book to compare the new rule book that is developed by the ECB, to just take a comparison, and all these were pretty private. Yeah? And on the other side, if you look at this European digital identity, for example, if you know the project, yeah, they have a website where everybody can have a look at the details of the plannings. Yeah? It's not that the code is exposed and the technical details, but to have this common interaction. Yeah? I think this is really a good sign, and I think for the digital euro we will go into this direction. Yeah, this is a good, positive thing. And I think a big problem is what I have not heard today at the moment is about fraud protection and detection. We know that this is a big topic as soon as a payment instrument is live. Yeah, there will be fraud. It's definitely true. Yeah. And because this digital euro, I'm talking about the retail digital euro, yeah, this is not at the balance sheet of the banks. Yeah, it's a European thing. It's owned by yourself. And on the other side, we don't have the possibility at the moment, because privacy is first, to have a really fraud protection. So we are in the middle, and who is taking care of the customers? And I think we have the customers who said privacy is the first point, and we want to have privacy in the digital euro. I think as soon as this is live, and as soon as we get the first fraud cases, yeah, they will decide, okay, I want to be protected. I want to be protected. It doesn't matter what information do I have to share with others. So, yeah, I think we will evolve in the future.
So an evolving stack. So what I'm hearing is identity is one part of the stack. Fraud detection is another. Of course, we know about the political discourse and regulation and what we've mentioned there. Marika, maybe over to you. Is what you've heard complete in terms of what you envision as a stack for 2030 in Europe? Or do you think that there's something that's missing, or many things that are missing? From the private sector perspective, perhaps, what do you think?
So I think it's a different way to think about it. But the way I think about it for what will the future of money look like for Europe is two angles. One is actually, what does the world look like in 2030? And I think, imagining a world where real-world assets are tokenized and they float around very differently, that's definitely the direction we're taking in. The other part is actually an AI agentic world. I think that's another thing that, given the speed at which things are going, I think it's another thing to imagine that. So on one hand, it's like, let's imagine what just the future looks like. And then the second part of the question for me when I think about what could be the future money stack is actually, what's the role of the euro? And what do we want the euro to play as a role within that? And I think within that, very often we tend to think like within Europe, we don't need anything because we actually have already very good payment rails. That's true. But I think the real question is, what role do we want the euro to play on the international scene? And therefore, what's the stack we need for the role we want to play on the international scene, knowing that the world is going to be tokenized, whether it's through AI agents, whether it's real-world asset tokenization, and so on and so forth. So that's that. And I think, it's also fair to recognize our origins as Europeans. The euro is not the dollar. We've been actually unified with the euro, and politically that's what actually unites us. And I think when you think of it that way, we're still a very fragmented market. We have, a fragmented bonds market. We have actually very different cultures and very different economies and so on and so forth. And that means actually the way we construct this digital stack for the future we want to envision, which I'd hope is actually a very strong euro also on the international scene, needs to take all of that into account. And so when I look at all of that, actually I think a way to build a tokenized money stack is to think, we need a wholesale CBDC, because actually we are in a place that if we don't have something that anchors us, commonly, then we might actually be fragmented. And slight parallel on that, but when I see today many different jurisdictions building their own stablecoins, I'm worried, because it means we might have a French stablecoin and a German stablecoin. I'll let you decide which one you think is better. I'm French, no judgment. But I think we might get into that place, right? And then we might actually fracture the euro. So let's say we need a wholesale CBDC to actually anchor us and have actually this last lender of resort that is the role of the ECB. I think within that, then there is very often, and you framed it, debates around, is it CBDC, is it tokenized deposit, is it actually stablecoin, is it digital euro? To that, I would say, depending on the users, it might be a different form, right? And I think we heard from Tony earlier, like actually, all of that is multi-issuer, multi-acceptance. In the end, it will not really matter. It's just like, who's the end user of all of that? Again, it's just tokenized money. It might be different form, might do different things, might be programmed slightly differently. And so if you build the stack from, bottom up, wholesale CBDC, it anchors us. Tokenized deposit might be helpful for banks to do big transaction to big transaction. I think stablecoin have a huge role to play, in particular if we want to have a role internationally and if we want to have a role in the AI agentic commerce. Otherwise, we might not exist as euro players. And I think, other forms of money could also evolve within that, right? So I think that's probably, I've learned stuff here listening how other panelists think about it, but that's the way I try to think of like, what could it look like? And therefore, what do we build? But it starts from a vision. We need a vision for what do we want the euro to be, what role would we want to play, and what does the world will look like tomorrow?
Yeah, quite comprehensive and well thought out answer, I would say. Of course, it's the digital money stack won't exist in a vacuum. It'll exist in a context. And I think that's a very important place to start. Like, what do we envision Europe looking like in 2030, and then what stack would facilitate whatever vision we have? So there's a couple of things I want to come back to there, but I just want to go to Tybalt in a second. What's one layer, perhaps, of the many that have been mentioned here right now, Tybalt, that most people think will come together organically or will somehow evolve by itself, but probably won't, and will require deliberate, action and intervention from all actors or certain actors.
Yeah, maybe just before answering, because I really like what you just said, actually, and I believe it goes also with the paper you released recently. Like, there is no unique answer. There is a stack with different form of money for different use cases. Whether it's the settlement of tokenized asset, whether it's cross-border, as you said, and we could go up to the pyramid, up to the retail as well. And I believe this is important that really we understand that as a player in the industry, that the world of tomorrow will be, we could say in a sense, more fragmented, but I would say different stack for different use cases. And I really believe that we should not try to put, square in circles. No. That's so I wanted to come back on this because I feel it's really very relevant. To this point, and it was addressed a bit also, for me, to your question, the end consumer is very important, and my concern is that we might lose the end consumers, because here we are all experts, but if you try to talk about the money stack to your parents or someone not in the industry, trust me, they don't even know what is the difference between commercial money and central bank money. So when you start to say to them, no, but trust me, you have money on Stellar and you have money on Polygon and you have stablecoin, but you have EURC and EURD and EURO and EURCV and EURI. Let's make the experience and you will see. So for me, there is, of course, a question of interoperability. This was the one I wanted to bring. Because the interoperability, we tend to see it, I would say, quite a lot from the different schemes, of course. So moving from one part of the stack to the other, which is important. There is also the interoperability between the blockchain, if you look at the stablecoin, which more and more we see on the market, and I would say almost it has been tackled, especially with the issuers, etc. So that's a good thing. Still, there is one link for me which is missing on the stablecoin part, which is the interoperability between the token itself, where I feel it's all still quite a struggle, because you have the issuing, what you call the issuing PSP, so the one issuing the stablecoin, and you have what we call the distributing, a bit similar actually to the digital euro, we could say. Not all the banks will issue their stablecoin, but at some point, I believe there will be some convergence, just like we've seen in the in the age of internet. and we will need to tackle this issue of the interoperability between the token itself. So we make sure a stablecoin is a stablecoin in the stack, and we don't need to understand EU or CV, EU or Z, blah, 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 blah. I've already done the list.
Yeah, so it's becoming more complex now. So there's multiple stacks for multiple use cases in multiple versions of the future, right? So it's really starting to sound a bit sci-fi-like. But nonetheless, I think I want to stay on the topic of interoperability or perhaps coexistence. So we often hear about the fact that different types of private and public money are going to coexist for different potential use cases, etc., etc. So I wanted to ask, by 2030, is Europe's digital money future really about coexistence between public and private forms of money, or increasingly about how public, private, and other tokenized market infrastructure, how they interoperate? Because we heard about Appia and Pontes earlier today. You were talking about the anchor. So is it more about the fact that the public sector is going to play one particular role in the stack, and then everyone else plays on top of that, or is the public sector going to take a more leading role than we initially anticipated, especially around discussions around strategic autonomy, etc., etc.? That's an open question, but I'll start maybe again with the public sector or previous public sector parts of the Avengers.
Yeah, the public sector should care. I mean, the public sector takes two forms maybe in this business. One as regulator, and then as operator, and both functions are very important and are assumed. And they, in the old world, they have shaped this industry, which is in a certain way in between regulation and central bank money, everything that develops in between. And in the new world, this has to emerge exactly. Of course, as regulator, the public sector has appeared in, I don't know, through MiCAR, which is a bit a strange regulation, of course. And then also it appears now as ECB going into wholesale central bank money, somehow associated with DLT. So the public sector is moving, and that's what it should do. In digital euro, one could say the public sector also moves with technology as everybody else has been moving, just already starting 50 years ago. Then, of course, the public sector, some in the industry tell to the euro system, are you crazy? I mean, how can you do that? Move into electronic. If we have done that, that's enough, But I think the public sector is very relevant in this. And I mean, both regulation and public supply are well justified in this industry. So both should be transposed also into new forms of money, including the front end, the instrument, the wallet.
Okay. Anything to add, Stephan?
I would like to refer to your comment at the beginning. I think there are so many players in the market, and I still see this that it will not work if we get thousands of tens of thousands of different stable coins from the US. In Europe, I'm not quite sure who is then taking care of this one and who is paying for that one. I think it's this payment product is an alliance of many different parties, and therefore I think it's at least a good role that there is a central body, which at the moment is the EU Commission or the ECB, who is orchestrating it. It's not that they implement everything or do everything, but they are orchestrating it. I think this is necessary in this really diverse payment market.
Okay, maybe something to Marika, and maybe a bit of a curveball. But if you were sitting inside of a commercial bank at this point, and you were enlisted as being part of looking into the future for 2030, what would you need in order to lean into the future of digital money and to position yourself as a front runner in the stack in 2030?
And I think that's a very good point, because actually what's happening with all those technologies, sometimes you need to fast forward and think what could the world look like, right? And when you actually think from within a bank, what's your duty as a bank? It's to serve your customers, to make sure your balance sheet is solid, to make sure you have profits and not too many losses and so on and so forth. And therefore, that's why it's also sometimes very difficult to innovate in something that might actually cannibalize you. And stablecoins are a perfect example of that. In a way, if you are sitting today in a bank and you look at stablecoins, you might be a bit fearful, right? You might think like, oh my God, this is actually going to take away our deposit. To which I would say, flip it. Don't look it that way, but actually think of what is it that you should build to actually participate in that world. And what does the bank of tomorrow look like? And the bank of tomorrow might look a bit different, right? The bank of tomorrow might indeed be a wallet, and actually, tomorrow, and that might empower better users, right? Which means as a user, I can hold digital asset in a wallet, and then I can choose different sub-services where I get my credits and my loans, and I can have actually more granularity that I can into what I can do, admitting that there's good UX for that. But that's actually possible. And if you stretch that world, then maybe yes, maybe banks become actually more narrow banks, and it means that we are less in a fractional banking system as we are today. Is it a bad thing? I'm not sure it's necessarily a bad thing, right? But it means that the role is changing. And so I think it's like thinking that way to start, innovating, to not be caught off guard. Because it reminds me in my days when I was in a very large UK bank, and at the time, my role was to actually create from the ground up a digital neobank. What I was hearing every day was, oh no, those digital neobanks, they'll never make it. They'll never be regulated. They'll never have enough customers. Get what? Revolut just had a banking license, and there were 75 billion. And they have hundreds of millions of customers. Well, not hundreds yet, but it's coming up, right? So I think you cannot ignore what's happening. You also cannot ignore the pace at which things are happening. And so that's very important. And maybe to close the loop on this, private-public debate, I think actually that's where the private sector is good at innovating. The private sector is good at taking risk, imagining a better future, and a future that looks different. And the public sector role is actually to make sure that it doesn't blow up while the private sector is trying to do all of that. So those are roles that in an ideal world are complementary and come together. Another big difference is that very often we underestimate that the public sector is very regional. We think as Europeans, we think as people from our own countries. The private sector is actually very often cross-border. And so we'll have also a different mindset on that, which actually come at a different angle. And it matters in the context of the future money stack, because today, and back to what I was trying to say at the beginning, it starts with a vision for what do we want the money of the future to look like. And actually, I think for once, that vision cannot come from the private sector. That vision at the sovereign level has to come from the public sector, imagining actually a technological shift that's happening within that.
Yep. Well-rounded answer again, but that also leads me to maybe Tybalt. If we're looking into the future of the future user of money, what do you think has to be true for digital money to feel normal? Because we heard earlier that it must be digital money has to be integrated into people's habits. I think it was Jan from MSG that said that. What needs to be true for digital money to feel normal in real-world payments, not just pilots, etc. So we're talking about the customer now. What exploration do you have for the 2030 version of the users?
I would say very simply that we stop calling it digital money and we just start to call it money. I mean, we don't care, it's digital money. And that's a bit the paradox. I mean, if you take the stablecoin, that's a bit the paradox of stablecoin that I explained sometime. I said the stablecoin will succeed when the stablecoin will disappear. I mean, as a consumer, once again, here we are all experts. But as a consumer, do you know, commercial money, central bank money? No. If it's going through TIPS, CSM, well, no. So my point, and I will be very brief on that, it will work when we stop calling it digital money and act just like if it was a new money. No, it's just new channels new networks, as you said, on which the money is being used. But and again, the money is not the end. The money is to do something. It's not the end. So it will disappear, I would say, when we stop talking about digital money and we just talk about the use case, the value proposition, and why would you need to pay, and to make sure that you can make those payments with the right form of money. But as a consumer, actually, you don't care. Transparency, yes.
So money is just money, basically. And it's increasingly digital, but it will just be money, right? So I just want to touch on something very briefly, and this is a precursor to the next panel, in fact. And I know I'm getting some beady-looking eyes from my colleague up there, not to steal her shine. But strategic autonomy is on the lips of everybody, especially due to recent current events. How do we make money, or let's say the strategic role of the euro sovereign or resilient in these times, right? So strategic autonomy, how do we achieve that? How do we make that concrete? What does that actually mean in practice? I think I'll put that to everybody. Let's start with Ulrich, if that's okay.
We live in a world which is not getting better, in the sense that the rule of law, international law, democracy is all going a bit down. And Europe has not been on the side of those who improve their global power, quite the opposite. We become more and more dependent, including in the fields of payments, and therefore we should not give ourselves up, no. That would be too early. We should really, fight for that also in the area of money. And I would see, two immediate things. One is obviously the digital euro, which we should now, push through, make a meaningful digital euro, not one which is undermined by industry lobbying. So it's very important that the legislation, is finished now soon in a meaningful way, and not in the way of the Navarrete proposal. Then we should, forget it, because that is just an attempt to derail digital euro. So that, and then the other thing is, maybe we should look at MiCAR again. We are all very excited about stablecoins, US stablecoins, and we should ask ourselves, why? That was mentioned in the previous panel. Why is the share of European stablecoins, MiCAR compliant stablecoins, so low? And I think here, once more, Europe has thought a lot about regulations. We were the first, we have regulated. There's a sort of Laffer curve in regulation. Or Laffer curve is taxation. You increase taxes, your income goes up, but if you increase them further, it goes down. If you have 100% tax, you have zero income normally, because nobody will work. And in, I think, digital infrastructure and asset regulation, this Laffer curve is one where you cannot, if you regulate too much very quickly, your regulation becomes irrelevant, because there will be no products under this regulation, because it's a very competitive global space, no? So, for example, the debate around remuneration of stablecoins, if in the US there is under Genius Act question mark, we will see. But if there's some form of remuneration possible and not under MiCAR, okay, too bad. There will be no large-scale MiCAR compliant stablecoins. Even if you are convinced that you are on the right food, you will not have positively impacted the world with your regulation. So I would say, let's be pragmatic and give European stablecoins a chance, not start worrying. They don't exist, but we worry heavily about financial stability implications. Let's do it the other way around. They have to become a bit bigger before they can do harm. So let's revisit MiCAR, and it's easy, I think, to find a few things there which would make a difference if we relax them in the interest of our impact and strategic autonomy.
Okay. Oh, this is got a round of applause there. Oh, one applause at least. I'm not sure what that was for. Was it for MiCAR or was it for Navarrete? Okay. Okay, cool. Anything from your side, Stephan? So we are running out of time slightly, but I'd also just like to remind everyone to please send their questions through if there are any already. Stephan?
Yeah, I would like to go a little bit more into the detail of this digital euro. So we are dependent on on large scale companies, but for at least for the retail digital euro, we are thinking about having our own servers, our own hardware totally in Europe, own connection lines in Europe. We have to have a software stack on top of this built in Europe, and for example, for the coding part, also sometimes not seen because there are a lot of other products already there that we could use and just integrate, but we really code everything by ourselves, which is really good. However, everybody of you know that there is a lot of different layers in the ground that is not available from European markets, because other markets, and especially the US market, is way ahead. And there are only, if you're thinking about mobile phones, there are two providers. We have to use them. We can't go around. But we want to make it secure, and for sure, as I told you about these different layers, as soon as there is a possibility, we are at the moment, we will try to integrate those pieces such that we can exchange them for a European solution if there is one.
Okay, Tubalt, maybe.
Yeah, I will try to be very brief. For me, two things. The first one is a vision. I really feel that what is missing in Europe and even in our mindset. A concrete example, for instance, the question for the stablecoin is, and we have it those days, is not, okay, how do I put stablecoin, for instance, the payout? How do I do payout, stablecoin payout? Which merchant is interested, etc., etc. The question is already a level deeper. What would they do with that stablecoin? And I have the feeling that sometimes we lack vision, so we are trying to be reactive, and we just say, okay, stablecoins, so we make payouts, but you don't even know why, and you don't even know what the value it will bring. So for me, that's the first one, is really a vision, because when you have the vision, you have the value behind. And the second thing is just do better products. I believe, we cannot hide behind the sovereignty. Why the people are using an iPhone or some electric cars from China now, etc.? Just because they are building better products. So a consumer, they won't use a product because it's regulated, it's cool, or because it's sovereign. No, they will use a product because it's better. And I think in the Europe, sometimes we are a bit too reactive, and it goes with the lack of vision. But we should not try to be more sovereign just by the regulation, but also by building products that the consumers actually want to use.
Great point, and that was, maybe Marika.
Yeah, so geopolitics. We're being squashed, and it's wartime. The US basically is trying to replace the petrodollar and has a very clear view that stablecoins can actually enable to do that, and that stablecoins can continue to enable dollarization of the world in a very, very, very powerful manner. Just one small example, when Facebook announced that they're doing an RFP to integrate stable coins that potentially can touch 4 billion people, we're not talking about Libra, DM creating their own, they understood that they should not do that. They will distribute whatever is out there. And today what is out there is dollars. So that's the vision of the US, very clear, need to replace the petrodollar, and for that, nothing better than stable coins or crypto dollar. The vision from China is equally very compelling and actually stands from sovereignty. They understand that if they don't have a parallel system that they can control, then they're going to be at the mercy and the control of the Americans. And we're in between. And so we have in our hands the duty to do something, to do it very fast because things are moving, and to basically act to make sure that we don't end up squashed. Because the biggest risk is that yes, it is technical. Yes, it is complicated. But it's not that complicated. And actually, we have a ton of talent, and we have a ton of people who have the willingness and the will to do things. But we need to believe that we can do it. We need to have a vision. And we need to really want to participate for tomorrow's future, which I think will be pretty more the panel after. But it's urgent.
Definitely. I think there's a good round and a holistic answer to that question. In fact, we just have a minute left, if I'm not mistaken, Mr. MC. Can we maybe take a round of questions? I think that we did have a good look at what the stack in 2030 looks like. It's anyone's guess, but certainly centered around a blend of public and private money, reformed regulation and the ways in which we bring these products to bear. Somewhat homegrown solutions, but then also a vision for the future in terms of locally grown good products as well, because people are not just going to use it simply because it's homegrown, so to speak. And then, of course, understanding our positioning globally. So that's also very important. Do we have any questions that we could take from the audience? Nothing at the moment? We do have.
So first of all, thank you all to the panelists. It was a very cool discussion. I have one question to come back to the very last point that was made about better products. My question is very simple. What would a better product look like come 2030, considering all of the things that you just mentioned?
Yeah, this one is tough. No, but a better product for me comes from understanding the issue and trying to find a solution to an issue and not an issue to a solution. And for me, it's really in this way. So it's, to be concrete, more discussion with the clients coming from the issue and not from the stablecoin, for instance. Okay, we have stablecoin, what do we do? Okay, but what is your issue and how we can solve it? Maybe it's stablecoin, maybe it's tokenized deposit, maybe it's digital euro, we don't know. But really talking with the client and the expert, but really from the issue. It's quite basics, I would say. It's not rocket science, my answer. But the truth is, I have the feeling on the market, we're not doing that much.
I think we often today, like, money is just money, right? So we're making all those complex things, but actually when I go and I pay my bread, it doesn't matter what is underneath it. And today we already deal with a lot of complexity behind money, but we've simplified it. I think that's exactly the same thing that it needs to happen. And to your point, which I really liked, was like stablecoins and all of that will win when we stop talking about it. It's just like a euro is a euro, a dollar is a dollar, if the euro still exists. But yeah.
Well,
the Avengers are optimistic.
Yeah. On that note, I'd just like to thank everybody for their inputs, great insights, and feel free to take the discussion offline. And yeah, we get one more panel before we round out the day. And thank you very much to everyone for joining us today.
Yeah, thank you, dear panelists. I'm always amazed at how high the quality is still late in the day. I think we can be really proud of that. And I am also very certain that this is true for the very last panel of today. Marike just built a really good segue to the last panel, saying we are being squashed. And I'm certain that this will be discussed by the last panel of today. Please welcome with me Executive Director at the Digital Euro Association, Anne-Sophie Gógl, and her panelist, Anne-Sophie Kappel. We have two Anne-Sophies, that was my bad. Please welcome Anne-Sophie Kappel and her esteemed panelists on the topic of geopolitics and digital money as a closer.
Okay. Thank you, everyone, for still being here. I know it's late. Either this was what you're waiting for, or you're just tired and don't want to talk anymore. In any case, we'll try and make it worth your while. We heard it's wartime. I think geopolitics is right on top of what we just discussed. We're going to neatly fit into that. Joining me on stage, I will let you guys introduce yourselves. I'm very happy to have you all. Please, Menno, take it away.
Sure, I'm Menno Broos. I'm the project lead for Digital Euro at the Dutch Central Bank.
Hello, I'm Ruben de Beerst. I'm a partner at Singapore.
Hi, everyone. I'm Sonia Davidovich, Senior Digital Currency Expert at the International Monetary Fund.
Hello, and I'm Martin Hallen, working as a director at the Bertelsmann Stiftung on technological sovereignty and resilience in Europe.
Wonderful. So to sort of build on what was just said, and throughout the day, honestly, we know that we're living in a time where money is not just issued. We're talking about distribution, governance, access to infrastructures, all of this. So this occurs across multiple different layers. It's not necessarily a bad thing that we have multiple solutions, multiple providers. Comparative advantage is a good thing. That's how economics also work. The problem is when interdependence turns into dependency, and when dependency becomes a strategic problem. So that's what we're here to discuss today. When Europe is facing a strategic problem, at what point does that come in? We've heard China is weaponizing their CBDC or other ways of doing that. The US is replacing their petrodollar with stable coins. Big tech is willing to distribute that. So it's really about when who controls the choke points, let's say, in money and payments, and when does that turn hostile, when politics come into play. So besides the rhetoric on strategic autonomy, let's strip away the policy language and all of that and really look at sort of like what the real problem is that Europe is trying to solve here. Martin, if you take away all that language, all the rhetoric around strategic autonomy, what is the vulnerability we're talking about? Is this digital dollarization? Is it market concentration? What is it?
I try not to leave too many with nightmares tonight when you go back after the setting of the event. No, I think if we take it all, basically the core, it's linked to the last points made at the digital money stack discussion. The digital money stack is based on a technological stack and in types of geopolitical volatility. Just yesterday, a study came out that we now have 56% globally of authoritarian regimes instead of democracies, and a transactionality that we are not familiar with in Europe. Suddenly, everything that we believed was basically infrastructure that was enabling us to generate value becomes a coercion tool and becomes a tool of dependency. And of course, many of the asset holders and also the financial or the insurance ecosystem are familiar with traditional ways of coercion. I mean, we are seeing this play out during the Iran crisis at the moment, where, of course, in the past we were worried about Putin turning off the gas. Now the LNG discussion starts also coming from the US, that maybe the shipments won't be coming on time. And in the digital stack, we have a similar story. We're not looking at sanctioning of actual regulators we have in Europe or former regulators. We're looking at very concrete coercion. And for those of us who openly read what is being put out there currently, not only by the Chinese government, but also by the US government with the new cyber strategy, for example, we have to be very aware that the notion of Europe being squashed, if we don't play our cards now right and strategize with a clear vision of what we actually want to build on top of, a stack that we also own, then we have big problems. So there's hope. I maybe mentioned this in some later points, but we need to be very aware that indeed it's quite an urgent situation.
Yeah, I think political coercion, we all know this, we've seen it in energy, in trade, we're seeing it right now. Money and payments obviously affects all of that, right? It touches all of these areas. Maybe Sonia, from a global perspective, do you therefore believe that the European concern here is well-founded or maybe a bit overstated? Which one?
Well, I'll let others be the judge of, because that's a very subjective assessment, whether it's, I bet everyone in the room will have a different opinion about it. But maybe from my vantage point, like working with the global membership that the IMF has, I do think that Europe can be looking at selective strategic autonomy. That's what I would say, because it is not conceivable that Europe will be able to completely divest and be completely autonomous of existing global structures. I mean, we're talking about, I heard a presentation about European cloud providers. I mean, let's face it, they're only 15% of the total market. The overwhelming rest of 70% or more are actually the hyperscalers. And that's not going away simply because it's such a resource and capital intensive infrastructure that requires a lot of upfront capital investment. So I don't think that we will see a future, at least not in the medium term, where you will have Europeans will be able to catch up with those hyperscalers. What is more conceivable, I would say, is that you will have for resource or compute intensive applications such as AI, that you will have a hybrid model of foreign and European providers, and that Europe safeguards the critical pieces of the infrastructure that are more sensitive, so like security, defense, like digital identity, for instance. This is where Europe can actually impose rules, even in a hybrid cloud model or like in a hybrid infrastructure model. Europe can dictate what the rules of engagement are in such structures. So I caution everyone, and it's also not conceivable that there will be like a complete AI stack, or that we will be completely, and this is what the panel actually before us said, they will be completely, or Europeans will be completely able to detach from software solutions or the ecosystem more broadly that technology providers across the globe typically collaborate, especially for public structures, public chains and such. So I think that it's better to think about what are the areas that are critical, that are sensitive for Europe, and then focus on those. How can we safeguard those critical areas that matter to Europe, and try to regulate or impose rules on those hybrid models that will emerge as a potential solution? Because, as I said, I don't think that there will, like, at least in the near future, be a European hyperscaler that just like takes up the vast majority of the market share for compute-intensive applications.
So you don't necessarily view dependency as a weakness?
No, I don't actually. I do believe that the codependency that might exist and that might scare people and frighten them is actually not a bad thing, because you're using the competitive advantage that you have and you're collaborating to create something that's much more resilient and much more scalable than if you were to do it alone. Because I just don't believe that, I mean, just like all of us, right? Like, why do we need to work in teams? Simply because all of us like bring something to the table that is of value for the project, for the product that we're building, right? And so such is the case for any infrastructure or a solution that we're trying to build at the European level. Let's leverage what others have already built instead of reinventing the wheel and trying to replicate the same thing with less resources, less manpower, less time, you know, if we're talking about time pressures, and try to just identify the areas where we want to be in control and protect those so that we don't feel like there's infringement on like what really matters, what really is important to the European sovereignty, digital sovereignty.
I see Ruben nicking or like nodding his head along already. Do you think that the same thing applies? Do you think that dependency is not necessarily a problem unless it's not well managed?
Well, I would agree with you that it would be difficult to build a European hyperscaler from now to tomorrow or something, and I also agree that we don't have to do that, because like the US hyperscalers do have a lot of services that we actually will not use, for example, for a digital euro. So if you mentioned AI, for example, and other compute-intensive services. I wouldn't talk about that we need that as a European hyperscaler, and that we should invest on that. So, but on the other hand, if we talk about payments and about the infrastructure that we have for payments, then a dependency becomes real at some point, and there is where you of course can build on European infrastructure.
Menno, then turning to you in terms of infrastructure and control of infrastructure, controlling monetary flows, where do you see the strategic problem or risk arise most prominently?
So I like the thinking about codependencies and that some things we shouldn't probably do ourselves. Just like I don't see the US produce good wines in the near future. Or chip machines. No, but this codependency is fine in many areas and has always worked and doesn't change with just one president in the White House. But I think the dependency in payments is particularly big, and there from our mandate, from the central bank mandate in safeguarding efficient payment systems, I think we've seen early on that the money that we issue, the public money, banknotes, is being used less and less. And then if you add to that in the digital realm, at least in the card business, you are very dependent on the US, and obviously that becomes an issue not only for central banks but for regulators, that you do have to solve. So yes, you cannot solve everything. I mean, we cannot also solve the cloud by ourselves, but payments in particular is something where I think we should just assume that MasterCard has a kill switch, and we need options to circumvent those.
Yeah, but then another dependency that comes to mind, right? Semiconductors, right? Like no matter what area we're talking about, like semiconductors is like huge dependency on Asia and the US. So what are we going to do about that? Like nobody can tell me that we can think seriously about payments if we're not considering the dependency on semiconductors. Like forget about the cloud for the moment. You could say like, oh, we're just going to run our own data centers. We're just going to keep it all on-prem. Fine. You can do that. It's not impossible. Like it might be that you're running like huge data centers and you're keeping a tight grip on it. But then when it comes to semiconductors, you again have a dependency that you just cannot wish away. So instead of trying so hard to, again, like I'm repeating myself, but it's much more better time spent on thinking about what are the most critical and sensitive elements of my infrastructure. In payments, for instance, digital identity, the European, and I really applaud the EU for launching, come January 2nd, the digital identity system. That is one where I would think like, oh, let me see how I can like protect that from infringement, foreign influence. Because like, no matter what we discuss, like we can find a dependency and we're not gonna be able to just say like, oh, we can control that fully within our own borders. It's just inconceivable. The moment also you connect your payment systems to a foreign jurisdiction, or you have vendors that work with other vendors abroad. You see what I mean? Like we can spin this any way we want. We're gonna be identifying a dependency on a foreign jurisdiction, on a foreign company, and there's like no risk management framework of this world can help you eliminate that dependency. So rather than trying to eliminate it, see how you can integrate it, see how you can mitigate the risks that come from third parties that are outside of your jurisdiction to the best of your ability. Obviously, not all risks can be mitigated or managed. When they happen, how do you deal with them, right? So those are the kind of things where the energy is better spent on thinking about than trying to just eradicate all the dependencies that exist. I know that that's not the view of this panel, but I'm just saying like, think about more critically what really matters to me and focus your energy on that.
I think to each their own view, right? And we're also in Europe, we're facing a bit of a tension between we want openness and resilience. We want global interoperability, but we want a sovereign fallback in case fragmentation like increases, right? I think Martin, you wanted to say something about what Sonia said.
I try to be provocative, but at the same time respect also the
wake
positions.
Everybody up.
I do think we have to ask ourselves also a question whether or not dependency is something that's actually beneficial if there's a massive power asymmetry. And then you're very suddenly in a situation where you have to shift your own kind of paradigm of saying, if this is dependency, isn't it much rather something where I have to learn the language of power and making myself indispensable? And then very quickly, in geopolitical terms, you're ending up, from a European point of view, saying, what are the other counterparts that I'm very dependent on me? In Europe's case, in the US case, insulin. If we were to close this tomorrow, then suddenly you would have a massive thing. Should we do this? I'm not advocating for that. But I think this is the language of the times that we need to start learning. And one thing I also want to put in here, because without criticizing what I think is a legitimate concern of not being able to reduce all of those dependencies overnight, because it's a complex, very difficult situation that Europe has found itself in. But it's also recognizing that we're repeating ever and ever again, from a technological point of view, an innovation paradigm that we all grew up with and that we've been socialized with. Around Silicon Valley, the hyperscaler model, fast to market, break things, let's go, vertically integrate everything, without having ever considered that this will be politically linked to a very transactional regime that right now is standing against a lot of the core values that we hold dear in Europe and that are in danger. without being ideological. It's just a fact from the evidence that we are observing. And this being said, where does this lead us? So basically, it goes back to this point that was made in the previous panel of what is the vision, technologically speaking, of where this technology serves our societies, our way of life, and not the other way around, and then to retro-engineer steps where we believe there are pain points that we should actually protect very clearly. And we see a lot of reactiveness that, in my mind, is role-playing as proactive strategy. That's a big problem that we're currently having. And lots of the points I've heard in the afternoon today here, I think you share this concern that there are no overarching holistic strategies there. And I do think that we need this proactive strategy and also link it then to some core principles that I've heard here as well around interoperability, open source, and instead of maybe being first to market, being first to be trusted in very volatile geopolitical times where we have an actual moat around that and to play that out also very clearly. And very last point also here, I do think that it's very, very essential to make sure that this codependency situation that you described rightly so at the beginning is not something that we try to actually play around with because we are not courageous enough to maybe also face some hard-earned truths that the paradigm that we lived through right now and that we used to extrapolate maybe into the future of how we actually strategize is no longer working, and that we actually completely rethink how Europe could actually use its assets in a way that is way more strategic. A little rant.
Maybe just directly to that. I was hoping it would be more provocative, but okay, I'll take it. We still have 20 minutes, so.
Just warming up.
I know, right? Just getting started here. I just wanted to say that, yes, you're right. Like, Europe shouldn't be hiding behind the veil of like, oh, codependency, we should just do our own thing. But like one competitive advantage, if I may say, that Europe has compared to other countries when it comes to stablecoins, for instance, digital assets in general, is MiCAR, that many countries look up to as a blueprint of something of their own regulatory frameworks that they want to set up, right? So that's something that Europe can pride themselves on. It might not be the best regulatory framework that exists out there, and certainly, it has to stand the test of time. And Ulrich mentioned just earlier today that if you want to achieve that strategic autonomy as a country, you need to make sure that even that regulatory framework that everyone looks up to is flexible enough that it allows for innovation, it allows for mistakes. I mean, beautiful things have happened out of mistakes. Grand innovations have happened out of mistakes. So there has to be enough foresight. I know it's very difficult from a regulatory standpoint because the ultimate goal is to protect the consumer, protect the investor. But there has to be a safe space for mistakes to happen where Europe can explore and European companies can explore oh, what about this euro-denominated stablecoins? I found this perfect use case and I want to test it out. And there are many sandbox models or innovation offices or what have you. It doesn't have to be I don't know how fancy, but just creating this safe space where companies can, explore what it is, the use case or the problem they're trying to solve through a particular solution is something that is critical if we're talking about strategic autonomy. And that is something that, where despite the fact that MiCAR can be considered a competitive advantage that Europe has over other countries, but are there any gaps or are there any changes that are required to that regulatory framework to produce that enabling environment for innovation to thrive, for mistakes to happen and to learn out of them and build a better, more sustainable, robust future for European digital asset systems, payment systems in general?
I think what do you say, right? We have space. We should have space to innovate and to try things. Europe is trying out sandboxes or I think pilots to production. We've had panels on this today. We all know that at least there is some effort made in that respect. There is a lot of initiatives actually at the European level. We all know that. One of the most prominent ones is the digital euro, right? The question is whether all these initiatives, do they add up to a coherent strategy, or are we sort of looking to solve pieces of a puzzle without a clear priority? So the euro system has set one clear priority, that is the digital euro. rather than probably being quite general about this. We heard Ulrich Binzel say that the digital euro, yes, is a good thing, and we want the digital euro, but not along the lines of what Navarrete says. So that's the digital euro rapporteur at the European Parliament. So, Menno, turning to you, obviously I'm already staring at you. What does that mean to you? Do you think that an offline first digital euro or offline only digital euro would actually address the autonomy gap that we're perceiving here? And for that matter, would an online digital euro do that?
Well, like we said, there are so many gaps to fill. So you have to really look at what is most prominent now and most urgent. I do think that from my perspective, I'd say something resilient that works also if other systems are down is necessary. And then in the short term, that will likely be the offline digital euro because that would also work without internet connection. So that adds resilience to an economy and to a payment system where we currently have cash, at least in Germany. But in the Netherlands, that's much less and less a resilience option. So it really depends on which gap you want to fill. I think if you look at a more strategic level and you look at because we're quite negative about Europe, but if you look at our strong points, it's SEPA and it's our account-to-account rails where we are much more efficient than the US and much better for consumers. So if the digital euro could also be an instrument to promote a SEPA for cards in a way, I think then you can really fill a lot of gaps at the same time. So that's not necessarily now on the table because I think the regulator still has to decide on whether we have one full package or whether we go for an offline versus an online digital euro. But you hear in Brussels a lot about interoperability, and you hear a lot about what problem is the digital euro trying to solve. And I think it's really up to the regulator to now come with this coherent strategy that I've heard also in this panel. And the euro system will make sure that we provide the infrastructure that fits into that strategy. I think that's what we have promised early on.
Certainly, I think that is what has been promised. Ruben, do you also think if Europe had to build one thing concretely to turn the whole strategy for strategic autonomy from, like beyond, make it more than a political discussion, what do you think it has to build? An infrastructure or something else?
So if we look at the payment methods that you have in Europe, so there are a lot of local solutions that we already have, but always when it comes to cross-border, we are dependent on US alternatives most of the time. And so the problem that we have here is that it's really fragmented within the European countries, and each of the local solutions, there is no incentive to make it a European product. And so when you look at the last years, there's never been like a real European scale project. Like Wero is like the first initiative that goes into that direction. And I think what you really need to bring the solutions together is to have like on the banking side that you have like one similar API into the banking sites, let's say, something like that, and that you can build really a payment product on top of that is European scale. So this is what I think what is still missing, so that you can really have a European payment product at the end. So.
Maybe just to add that this is a phenomenal opportunity for Europe to leverage the digital euro, the digital identity system that's coming online, TIPS. Like these are all elements of a digital public infrastructure, similar to what the India stack is, nothing but that. Aadhaar, the identity system, UPI payment system, and a digital rupee. So sky is the limit in terms of what you can do once you have such a DPI in place. And they're actually exporting that model to the rest of the world. There are countries that are implementing the India stack within their economies. And I think that's very, very powerful. The previous panel talked about, sounded like a war zone a little bit. And I'm just not a big fan of that kind of rhetoric, because it immediately it adds it drives a wedge in between countries, and it's very very reactive, driven by events. I think you mentioned the political regime, that should be completely independent of that. Like, I mean, why we're talking about strategic vision for the medium term, long term. So that is completely independent of any of the distractions that are happening now. I'm calling them distractions. It's probably for some people like much more than that. I get that. In the current moment it is, but what I'm trying to say, use the opportunity of building the core elements of a DPI, of a digital public infrastructure, and try to see whether there are other takers globally that might implement such a system. It's a unique opportunity that Europe could leverage to its advantage. So a little bit of competition it's a good thing.
Martin, I saw you.
I think I'll try to connect to that. I agree with you on the point that Europe should not try to outcompete big tech everywhere, but we need to be much smarter and much more subversive in kind of setting incentives for the rails that they might actually be working on. And there are ways of doing so. The financial sector is one particular one. In the health sector, we have other alternatives. Defense, by the way, also a very interesting use case for that. But I think what we also need to make clear, and that's the distinction to the India stack, for example. I'm one of the co-authors of an influential study around the Euro stack last year, and we made a very specific case that the DPI approach of India is not the template that can be used based on European fundamental values and principles because of the coercion and oppression risk that comes with these systems, even in India with the Hindu movements that we have there. So we have a fascinating use case with the Aadhaar system, the identity system, with the data spaces, with the payment mechanics that are there, and I negotiated also with delegations that came to Brussels in this regard. Fascinating use cases, very different approach in Europe that we're currently investigating. And it's much more, again, a question, how can Europe build its rails, its digital infrastructure that is much wider than DPI to actually enable wealth generation also on the continent with meaningful strategic partnerships, not as an exercise of isolationism or protectionism, but actually as an invitation for cooperation around something that might be a third way, because we don't want to choose between what currently seem to be two paradigms that we see as very dangerous, because they might squash actually the way of life and also our industries as we are talking about them. And where does this lead us? I mean, maybe I take one Indian approach that I like much more than the DPI approach that they've taken, is what they've done in the 70s and 80s around generica in the pharmaceutical industry. What is the technological generica of good enough that we might need in some sways of our industries so that we at least have something to offer? And at the same time, also what can be done by incentivizing also from a policy point of view, but also from an economic point of view, what we actually currently are perceiving as a hindrance, which is our decentralization, which is our kind of splintered ecosystems, and underline that actually by making them interoperable, by using the standards in highly regulated environments like the financial industry to build alternatives to a hyperscaler approach. And this is something that when you look at it from a cyber point of view, in times of global conflict, has way less attack vectors than centralized hyperscaler models, which we are seeing in times of drone attacks on AWS data centers directly in the Gulf just a few weeks ago, are true alternatives. So those are the approaches we have to do, and those are approaches that are not something that resembles what we are used to. Those are approaches that work with data stewardship, with interoperability standards, with also ecosystems that need to be built, and a clear public but also industry responsibility to build these guardrails that then can actually have a fighting shot. And in some areas, and I finish with that, like the financial, insurance industry, health industry, there are ways of doing this relatively swiftly. And again, the window to enable that is very short, because the politicians are desperate for political wins. That's one thing. And again, I have to say it out loud, the coercion and also the very transactional reactions behind the scenes in the tech sphere, unfortunately, are running contrary to many of the arguments that you made, because they're extremely dangerous at the moment for democratic structures and the electoral process for us to actually keep our systems running.
I have to say, now we're getting somewhere with the provocations. I like it. Let's keep that up. I just wanted to say that I don't think that it's coercive to say like, hey, we build a really robust and viable infrastructure. Here's how you can build one yourself based on using the blueprint that exists. I don't think anyone is out there saying you have to use this and it has to be exactly like that and you have to use the vendors that I prescribe. At least that is not the case that we're seeing for countries that have adopted the India stack. But again, as I said, competition is good. So why can't there be an India stack, a Euro stack, a Kazakhstan stack? I don't know, like other countries that are building their own stack. So for countries that do not have the resources or the strategic vision to build their own, can then replicate what others have already produced, and they can choose from a variety of solutions that are most suitable for their specific context. And this is where, and I think that when we speak about coercion, it means that these countries are imposing the exact same solution as an exact replica to their country context, and that just doesn't work. And I don't think that that is the idea behind countries deploying something along the lines of the India stack in their countries. They're just happy that they have a blueprint to work with. They're extremely grateful, and I don't think that the logic behind deploying, or at least from India's vantage point, I mean, I can't speak on behalf of the country, but there's no such thing as like forcing that country to use a specific technology provider or use a specific solution and like that way allow like some form of coercion later down the line. It's more about like, hey, we genuinely want to help you achieve something within your jurisdiction, and here's how you can do it, more as a blueprint rather than like a one-to-one carbon copy of the infrastructure.
But I don't think you're necessarily disagreeing, right? I think maybe the
just trying to
phrasing
make
is
it
a bit
amusing.
different.
It's the last
Fundamentally,
panel.
you're agreeing, right? It's actually just a wording thing. It's also mainly whether we should focus on outcomes, essentially. We shouldn't focus on like centralizing control, whichever way that might look like. I'm sure from a central bank perspective, actually, I think you would agree with me that it should be about outcome and not control. But please feel free to jump in there, Menno, if you do disagree.
Well, you should look at the network as such, and you don't have to control the whole network, but you have to look at the dependencies specifically in that network and where you don't have the control. And I think there in payments, it's very clear that no single country controls the card networks. And there is a global standard, but it's really to the benefit of a few big tech companies. So I think there you could team up, and if we get to a European standard at the POS, at the point of sale, maybe that could be a blueprint also for other countries. So in that sense, I think countries can learn from each other. Yeah.
I do think that countries look to Europe for some guidance and to see how things can work as well. Regulation, MiCAR is also a prime example of this, right? What then is actually missing here? What's the gap why are we having this gap? What can we do to actually fill this gap in practical terms? Maybe Ruben, you want to jump in terms of implementation. What can we implement?
So I think to solve this, for the point of sale example, if we stay there, so the current problem is the fragmentation across Europe, I would say, and to have really a product that works at point of sale, I think there are three things that you need. The first is the integration into the banking sphere has to be like standardized across the countries, because we see like local solutions in each of the countries which are very popular and work, but they never work at European scale. So we have to have a standard on that side. That's one. The second is if you just have the APIs that are there, just a regulation, then you have nothing. The second thing that you need is a product on top, because otherwise nobody's using it. So you need like that hasn't to be one brand, but at least it has to be a similar working product that works for if I go to France or to the Netherlands or whatever, that always works. So it needs to be like some kind of unified product. That's the second thing. And third, what I would also agree is with the innovation that you would have, you need partnerships, public-private partnerships in order to build on what we already have, and also to have opportunities for more innovation.
Say Europe gets this right. Say we manage this. Who wins and who loses? Open to anybody, but feel free.
Well, I think consumers can win and merchants can win, and they're on the same side of the coin in a way. So that will be very helpful. I think geopolitically Europe can win as well. We don't solve the whole coercion problem, but at least a part of it. I'm not sure. I think it would also benefit incumbent European financial institutions, but it could also benefit neobanks and other players. So there, of course, it's really up to the market to decide who can win from this.
Martin, do you think the euro could be winning here?
I do think so. I do think so, because especially when you talk to institutional investors outside of Europe, they're quite bullish. But they're also wondering what Europe is doing at the moment and not getting its act together, of actually playing out this strength and also talking, again, the language of power. To a certain extent, a ruthlessness also of knowing what the priorities are that need to be set, but also a mindset that underlines that we're not starting from scratch here at all. While there are dependencies and layers of the stack that are pretty brutal, there are opportunities in others. And again, to not be too lazy and fall into false dichotomies of deregulating for the sake of innovation, but much rather anticipating what the next innovation cycle 5, 6, 7 years in the future will be, and to double down on that. And geopolitically, the world will be volatile to the extent that we've never experienced. Our grandparents have experienced that. Maybe in some regions, our parents have experienced that. But this is something that will happen, and how can Europe position itself in its financial system to have this type of resilience, but also in the debate around European champions or those partnerships or those structures we want to build. And while I don't believe that there will be a European OpenAI or European big tech, I'm convinced that if we play our cards right, there will be champions with a big European imprint on interoperability standards. There will be champions of migrating from legacy systems to new systems and making them weave together to actually be competing with the entities that today we think are completely not something we could compete with. And this has still to come. It's a mental shift, it's a mind change shift, but also it's a narrative challenge, I think, for us to leave the reactiveness of like, oh, let's adapt and let's see, how we can do it, to this more bold stance like, okay, wow, this is so much uncertainty. Let's try something out of, our comfort zone, and especially in sectors that are highly regulated, that have an incentive to make that happen because they're actually monetary values to be made, and in my deep conviction around trusts and trust assets, huge markets to be opened that Europe could actually single-handedly also control.
I will give everybody an opportunity to ask questions now because we have 1 minute left, and I'll give it to you since you powered through with us all the way to the end. Any takers? Any online questions?
Not as of right now.
Okay, then actually, before we start open another kind of worms, I can ask about capital investments there and what the market will look like in a few years. Let's just leave it at this. Everybody can keep talking about this afterwards. Anyway, thank you everyone so much. Thank you as well. So I think, I'll hand over to Jonas again.
Thank you.
Yeah, thank you, dear panelists. Just very briefly before I hand over to Jonas, I wanted to personally express my sincere gratitude for everyone who was a part of today's event, to, of course, the audience, to the team that made all of this possible, of course, up there, the tech guys, the invisible guys of making everything possible right here. I think it was very smooth. I learned a lot, and I am humbled by how excellent everything went. I'm truly grateful to be part of this. Thank you all. And Jonas, you can be proud. I hand over to you for closing remarks.
Perfect. Thank you very much, Marcel. And so I'm having a challenging situation to stand between you and the wine reception. So I promise I will be very, very short. Just want to say a few thanks at this point. So first, thanks to all of you for joining and to make it until the end. It was really a pleasure. I guess we all had very good, very insightful discussions. So I guess you really enjoyed the day. I really want also, because we're doing this obviously again, if you have feedback to the conference, we send out a form, if it's good or bad, please come to us as a team. We always want to improve.
And I'll ask you thanks. So first of all, really a big thanks to you, Marcel, as the moderator once more. So big round of applause for him. Of course, I also want to thank all the sponsors. Without their support, just events like that would not be feasible, because in the end, of course, we also want to have some good food, to have some drink. So I'm really, really thankful that we have a lot of great companies here. So maybe a big round of applause for them as well. Yes, and then last but not least, it's really about the team. So I really want to thank everybody from our team at the association. It was really a team effort. I really loved it that we had that we led this and had also a lot of the last round of applause really for the whole team to make this possible. Cool. So enough for now with the content discussion. So if you want to continue the discussion, then you can join the just a wine reception for the next hour outside. So there is wine and just here in the foyer. And of course, if you want to follow us as the association, just follow us on all the channels online. We're active on LinkedIn. We have a newsletter. We try to be pretty active in a lot of domains. Of course, also if you're interested in the work we are doing, into memberships, anything, just approach us as a team. But don't want to do a complete advertising block here. So again, thank you very much, everybody, for joining. Thanks for being here in Frankfurt. Thanks for being online. And have a great evening and enjoy the wine and the rest of the day. Thank you.